Happy holidays, everybody. We're back. We're your hosts here. I'm Scott Willis, joined by Thomas George. Buckle up for the next 6+ hours. We're going to be hearing from some of the smartest strategists and CEOs on what's going on in the economy and all the commodities that matter. So here we go. It's time to start Commodity One-on-One.
The marathon, let's go!
All right, everybody. a little taste of our first guest is we have a special first guest coming up. But first, we have to thank our sponsors. We wouldn't be able to do this without them. So got to give a quick shout out. Starting up, we got 314 Research, the next generation of investment research, home of the full cycle trend ETF. If you want to learn more, you got to visit them at 314smi.com. Then we have Goehring and Rozencwajg, natural resource investors. You can find their best-in-class forecasts at gorozen.com with a Z. Next, we got Blokland Smart Multi-Asset Fund, a one-of-a-kind fund invested in scarce assets, high-quality stocks, gold, and Bitcoin. Bloklandfund.com to learn more. West Red Lake Gold Mines, ticker WRLG, restarting the high-grade Madsen mine in the heart of one of the most prolific gold districts in North America, Red Lake, Ontario. Next up is Power Nickel, ticker PNPN. They're developing what is turning into the polymetallic discovery of the decade. Ecora Resources, ECOR, royalties on high-quality assets targeting the critical metals of tomorrow. Hot Chili, ticker HCH. Hot Chili owns one-of-a-kind water rights and is developing the largest copper project not owned by a major miner. And lastly but not least, Hilltower Resource Advisors, expert insights on commodity markets. Visit hilltowerresourceadvisors.com to learn more.
All right, so we got warm pies right up. Let's go!
Let's get them in. Warren, brother, welcome. Great to see you.
Good to
Warren,
see you guys.
Thank you for starting the marathon. You're always great with this stuff. You run so fast. You set the pace. You set the pace.
Yeah, your stamina is incredible, man. 6 hours is, man, hats off to you. Absolutely.
Oh, man.
10 a.m., 4 p.m. doesn't matter.
Come on. First off, Warren, thank you so much for always starting this off right. Warren, 314 Research, shot caller, as a commodity shot caller, it doesn't get more elite than 314. Heading into 2024, your outlook for oil was a wide range-bound market. That's what we got. And a bullish gold tape clocking through 2,500. That's what we got. Let's first tackle oil. We entered 2024 at $70 per barrel. Strategists were uniformly bullish, as they always are, and that's why we lean on 314 a ton, because you bring that balance to oil outlooks. So you guys foresaw the high vol that others couldn't. Could you take us through the framework of analyzing oil, right? Because I think that's very different than others, because you really do take a balanced view.
Yeah, absolutely. Coming into the year, our view was that, to be very specific, we saw a wide range. We thought oil would top out around 90. We saw that as a soft ceiling. You go back and check the tape on that. We saw that as a soft ceiling that we would hit at the end of Q1. And the downside of that range, we thought we could get as low as below 60 on Brent by around this time of the year. So in this last month of the year, we thought would be pretty rough for oil. And that was our outlook. But like always at 314, we try to lean on models and indicators and stay objective, let the data guide us. And so that was the framework we used to be bullish entering the year, was that we saw there's so much hedge fund short positioning in the market. OPEC, the deal, all the emergency cuts that were in place were still in place, and that's kind of what I think is the big issue going into 2025 is how that comes back. And so our view was just very basic meat and potatoes. The market was in a deficit, a prompt deficit. We saw that through backwardation. We thought the economic recovery would continue, so you'd see a decent demand recovery year. We got decent demand recovery. Throw in some geopolitical risk, and that's kind of how we got to that 90 number at the end of Q1. But since that time, it's really going back to June with OPEC coming together and saying, look, we need to get this oil back onto the market. So they basically said, starting in October, we're gonna put roughly 200,000 barrels per day increase every month starting in October, and that has been the real issue, the dark cloud hanging over the market in the months since that. So for the second half of the year, and I still think that's to give you a little bit. I know you only asked to say what's the framework going forward, but to me, that's the big issue that we have to deal with in 2025.
Fantastic. And so, with respect to demand, Warren, I think this is kind of one of those interesting bits where we're seeing China, it's really softening. Maybe you want to talk about the structural outlook, because this is critical, right? How do we think about China? Is it a clean baton handoff to India? Like, how should investors think about this? Because that's clearly an area of concern.
Yeah, I think that demand is the problem with China is something we talked about before is you have so much EV adoption and penetration there, which has taken an edge off demand. So if there was on the demand side, I think everyone's kind of been waiting for China demand to resume the linear path that it was on pre-COVID, and we haven't seen that. It just hasn't come back as strongly, and so. It is increasing, but again, it's been tepid, and that's what got OPEC, I think, wrong-footed. Really, is two things. Number one, I think that OPEC increased production after the Russia-Ukraine war kicked off, and I think almost everybody expected to see more declines out of Russian production back following that, and we haven't really seen that. And then OPEC also expected to see China demand come through and bail them out. And because of the EV adoption and really just structural changes that you're referencing, we haven't gotten that. So now what we have going to 2025 is a situation where I think it's really dangerous for people who want to be long oil. Now, I'm not a person that says oil is dead. It's like it's my background. It's my starting point for my career. But I mean, like you said, I have to call it how I see it, and I think it's going to be a rough five.
Well, Warren, like that's we've always respected that, and I'll be honest, you've nailed it. We've really leveraged that view, and we're gonna make this super interactive. We've got guys on YouTube asking questions. So Owen Anderson, Warren, how does your framework your oil framework account for geopolitical risks? Is there a way you think about mixing that in the framework?
Yeah, I mean, our model has physical market indicators, inventory indicators, futures positioning, and technicals. Those are our four broad categories. So you don't see geopolitical risk expressly listed there. So I always say, and this goes for every market, that we build conviction on fundamentals and we manage risk on technicals at 314 Research. And so that technical component of the oil model is where geopolitical stuff, quote unquote, shows up, in my opinion. So you see it through price. If price is starting to behave in a bullish way due to a geopolitical issue, then we'll see that through that part of the model. And but what I would say is this: is that if you go back through the history of geopolitics, most of those spikes are fades. You fade those spikes because unless there's a actual hit to supply, which is like maybe 1 out of every 10 geopolitical spikes is actually something that you get a supply reduction. You just fade it, and that's kind of so, and that's how that is built into the technical component of the models. There's some mean reverting factors that show up in those periods.
Great, sage insight right there. With respect to gold, again, this top two. These are the top two commodities. You nailed them both for 2024. Gold, absolutely got it. How are you positioned heading into 2025? How do you think about the Fed and global central banks and would it be as good of a year as 2024?
I don't think it's going to be as good, but I still am bullish on gold. We thought that gold would blow past 2,500. It did in 2024. I think we're going to easily get to 3,000. I do believe that we've entered into a new secular bull market. These bull markets, if you study them historically, gold becomes like a must-have fixture in balanced portfolios. That's the message of history. Like if you go through the whole history, there are a lot of periods where gold's kind of dead money. But once you enter one of these secular bulls, which I think we have, pro-cyclical deficits unlike anything we've ever seen, so many different issues coming to a head globally, I think you need a debasement asset like gold to be in your portfolio. The only fly in the ointment to me, which I know you're going to ask me about for gold, is the competition it's getting from Bitcoin. I do think they fight for the same spot in portfolios. And so it's the one reason why you might hear a little bit more hesitation in my voice versus last year when I'm forecasting gold for 2025.
Yeah, Warren, I gotta kind of hit on that because that's actually let's talk about the biggest difference when you think about that competitive landscape is these plethora of ETFs and they blow them by 60 billion. Like this is legit. Like, I'm just thinking big picture, you come into your advisor and now he's got before it'd be like 2%, put it in GLD. And now he's like, well, why don't I do 50-50? I'm just not sure at a big level, do central banks just kind of eclipse all that stuff? Like maybe just how you guys are thinking about that competition, so to speak.
Yeah, I think that for the most part, central banks are going to tend towards gold in my view. And we've seen central bank buying was really the first leg of this bull market. But I think at this point, we're starting to see GLD flows and things like that. Like that baton handoff was taking place. And then now Bitcoin has just blown up, obviously. And so with all the new adoption of ETFs, I think it's safe to say Bitcoin, it is now becoming, we're right here in the midst of it becoming an institutional asset. Institutional asset means that advisors, the risk is not owning Bitcoin, the risk is not owning it. So like before it was, I'm afraid to touch this thing because there's downside risk. And now I'm going to underperform if I don't own it. And so once you start plugging in a 1% allocation in all these portfolios, it starts to crowd things out. And I think gold's going to be one of those assets that, it takes a little bit of the edge off this secular bull. It doesn't make me negative on gold. I just think that it could be a little bit less than previous secular bulls.
Well, there's this aspect of Bitcoin that's kind of funny, right? Where you get things like kerosene, like MicroStrategy that simply don't exist.
There's not a gold fund doing
right?
that. Yeah.
It's fascinating, right?
Yeah, I mean the younger generation that's just getting into investing, they probably think gold is just boring, don't get it. So there is a generational divide, but I think that the younger generation's winning, honestly. Me personally, I'm partial to gold. If you're looking at my portfolio, it'd probably be more, I'd have more space for gold than Bitcoin, but I also would have some Bitcoin, a small allocation there as well. So, I mean, I get it. I'm probably more of a boomer in that way, but the young kids just gold's not doing anything for them. They want the real gains.
Yeah, exactly. And the kids wouldn't even know what to do if you told them go pump gold. They would be like, "What?" They wouldn't know how to pump those.
Yeah, what do I say?
Bitcoin, man. That's a tried and true pup, man. They know how to push that.
Yeah, for sure. My just real quick, Thanksgiving last week. Now this is a sentiment check for Bitcoin. My 11-year-old son announced at the Thanksgiving dinner table, "Dad, the best investment in my mind." He said, "Dad, I think the best investment is crypto because it never goes down." And I was like,
That's
Ooh, you know what? It's better to be a bag holder young. I always believe that. I just believe like, you know, it's like you just need to take a loss once in a while, and then you kind of you know what risk assets are. But
well,
could be right, man. Like,
I totally encouraged him. Like, I'm like, look, because he's been, the kids all know this is what I do. So they all want to invest and learn to invest. So I teach them like just basic stuff, like how to read a chart, all the basics, and give them a little bit, some paper trading accounts and let them blow it up, you know, and maybe even a little bit of real money, let them blow it up. The best tuition you can spend is that money you lose when you're young in the market.
Oh, for sure. No one ever forgets that moment.
No.
And you learn from it. Warren, I want to jump to a macro question for you that's been on top of my mind. So as you look at the weakening housing market, you guys have put out some great stuff on what you look at to determine whether the housing market's weakening or getting stronger. If you look at weakening housing fundamentals versus an economy putting up stronger growth than expected, is your base case still a soft landing, or is the probability of a hard or no landing still possible in your mind?
Yeah, our base case is a soft landing still. I think that, in truth, I think we kind of have soft landed in many ways at this point in time. You know, this is what a soft landing looks like. This constant ebb and flow between worries of recession and inflation. That's kind of what a soft landing, how it comes about. Now, our source of truth for the economy is the housing market. I think that if you understand how a recession comes about, you understand it's going to come through Fed tightening. Fed is tight in my view. I know there's a big debate around that, but I think the Fed is still tight and reducing from a restrictive position. And that shows up first in interest rate sensitive areas of the economy, including housing. So if we're going to have a recession, you're going to have job losses, and those job losses are going to originate in that section. So we see weakening in the pipeline for the housing market. The question for 2025 is going to be, will the Fed ease enough, and will that show up in mortgage rates enough to kind of stave off what's those job losses that we're watching for? Now, I say this, I bring it up. A lot of times I'll say things like, hey, sub 80,000 single family new home starts per month. That's a recessionary trajectory. But the word trajectory is doing a lot of work in that. It means that if we stayed at this level for a consistent and persistent period of time, maybe 12 months, maybe 18 months, you would have job losses. But, you know, that's everyone wants to jump to the end of the book without reading the whole story. We got a long and a lot of possible intervening factors between here and the end. So I'm still on the soft landing bus, but it's our job to find risks, call them out, and have a framework to sort through the chaos for our clients. And this is our framework.
Great. Fantastic. Now, Warren, it's been a hell of a, you got the shot calls right, but a big year for 314, a wildly successful launch of your first ETF, hopefully more to come, but huge. You guys are just shy of $500 million, man. It's just incredible number.
Hats off.
Ticker is FCTE, and it's utilizes the firm's proprietary full cycle trend strategy. I want to ask, so I'll put up a graph in a little bit, but the strategy has an impressive long-term track record relative to the S&P 500. Could you take us through just the framework of that strategy, and B, how that stock selection process works? Because, you know, I think there's this pendulum thing happening where you've had these 100 plus stock, ETFs, et cetera. This is super concentrated, 20 securities, which gives you full, active tilt, right? But yeah, would love for you to take us through this.
Yeah, I mean, you and I have discussed this before in the context of your funds and stuff that we're trying to do at 314 is like, if you're going to do an active ETF, you need to have an active bet. Most of the stuff that's out there is like a benchmark hugging vehicle, and that's what's going on. So the beauty of an ETF is you should be able to be concentrated, trade around, and save on taxes. And so that's the wrapper that sits in around this full cycle trend model. We've been running the model for years now at 314 Research. We had clients, we turned the portfolio over, as I referenced, about 3.5 times a year. We had clients come to us and say, hey, we love the model. It's beaten the market for 3 straight years. And we want to be able to invest without turning over and generating so many gains. So that's where the ETF came into existence. And the way it works is we have the S&P 500 stocks. We narrow that down to 100 stocks based on our proprietary quality screens. We're looking for quality stocks. And then we overlay trend on top of that. We grab the top 20 quality stocks by trend. And I'd say, there's a lot of work that goes into this. You can read the white paper on one of the white papers on our site. We give it away for free. But one of our key insights for the quality universe is that you want to look for quality stocks, long-term uptrend, short-term pullback. You can buy pullbacks when you're fishing in the right pond. And that's what we're doing. And we're cycling through that process every month, selling 6 stocks, buying 6 new stocks, 20 stocks in the portfolio. And I really believe, I know that this strategy over time has worked. And I think that we're in a late cycle environment, despite all the moves we've seen here in the last couple months. And the most important part of a late cycle environment is protecting downside. And that's really means getting into quality and sticking with quality, not getting pulled out of your discipline and moving into low quality companies at this part of the cycle. So it's been a great launch. The preview, I'm allowed to talk about it still for a little bit. We have another fund coming out based on our asset allocation model. That'll be early next year. So you can keep your eyes out for that. But for now, full cycle trend, that was our first one. And it was so much grassroots support for it, made sense to roll with it.
Amazing, Warren. The performance has been fantastic. The model as a whole through time. And so the ticker FCTE, and that it's you guys are just shy of $500 million on the way on the march to $1 billion, man.
There we go. You'll get
congrats on all the success, man, and thank you so much for always leading the big conferences. I appreciate it, man. Thank you.
Much appreciated, Warren.
I love doing it. I love working with you guys, and 2 of the most real people in this business that I've come across. You come across a lot of different types of people. Y'all are a couple real ones, and I always want to help you out whenever I can.
Oh man,
we appreciate it, man.
So
The
much,
real ones got to stick together. Yeah. We'll all get where we need to be, right?
Exactly. Warren, thank you so much, man. And you guys, if we've got all the links about where to find Warren's work and the backtest stuff. Just it's all of the history of the strategy. Warren, thank you so much. Here's hell of a 2025 and a Merry Christmas, man. Thank you, Warren.
Merry Christmas.
Yes, absolutely, brother. I'll see you.
All right, guys, Commodity One-on-One. We're just getting started. We have more great guests coming up. Don't go anywhere. We're going to take a quick break. We'll be right back. All right, everyone. Welcome back to Commodity 101. Hope you enjoyed that first guest. Next up, we have James Seyffart. He's an analyst at Bloomberg LP. He's doing the ETF game better than anyone else, so let's bring him on.
And
let's talk.
Bitcoin. He's the Bitcoin king.
Yeah,
Bitcoin
don't forget
king.
Bitcoin. Don't make Tom mad. He's Bitcoin king. We got James, Bitcoin king. What's up, brother?
What a run, man. Brother,
What's
you know
going
what? I
on,
still
guys?
remember the first time we did this way back, man. Dude, I'm so happy, and you crushed it every which way. Congrats, man.
Yeah, I mean, last time we did this, I think we were still talking about whether or not we were even going to get them. But here we are.
Bloomberg, and your work, man, on, for those who don't know, you should know, we're bringing two big shot callers here. Warren and the Bloomberg team, led by James, and, what you guys did for Bitcoin with respect to handicapping, that was incredible work, man.
Yeah, that was value add to the market, right?
No one was doing that stuff, man. Congrats, man.
Thank you very much. Well, people were doing it, but a lot of people just thought it wasn't going to happen until late on. Then everyone got on board and said it was going to happen.
You guys were putting numbers behind it, right? I mean, you can be right and wrong, but still provide a helpful frame, lens, and you were doing that.
Yeah, we went up to like 75% in early August, and then they've ultimately started trading in January. But for the most part, when we went to 75, nobody else was in our camp. Everyone was kind of in this 50-50, whatever range.
Got it right. And now we're getting sold on the ETFs, so a lot has changed.
Yeah.
Well,
let's get right in.
Probably
All
are.
right, so James, you gave us some good charts. If you ever think one works with what we're asking, just let us know. We'll throw that up. Okay.
Sounds good.
All right. So looking back, it's clear Bitcoin ETFs played a big part in the run to all-time highs. Will Bitcoin ETF flows continue to be very important for the foreseeable future, do you think, to the price?
Yeah, I mean, this is like one of those things. It's like you just mid-curve it. The answer is yes. I mean, if you're going to see, I do have that one chart. It's like all blue, and it just shows the cumulative flows into U.S. spot Bitcoin ETFs. They've taken in $31 billion since they launched. I mean, our expectations was like the first year we thought maybe 15, maybe 20 billion would come in. Obviously, we've been blown out of the water on that front, and with our predictions on those flows, for the most part, amongst like most TradFi type analysts like us. We were the high end. Obviously, there were plenty of Bitcoin maxis out there screaming that they're going to see hundreds of billions of dollars flow in like right away. But for the most part, this has been exceeded pretty much everyone's expectations. Even if you talk to these issuers, it has exceeded their expectations. So I mean, anytime you have that kind of money pouring into a product that holds an underlying asset, in this case Bitcoin, it's undoubtedly going to impact the price. And there are going to be times, as you can see here, there's peaks and valleys along the way where there's going to be money pouring out as well, and that's also going to impact the price. The one caveat I will say is some of the biggest holders here are hedge funds, your Millenniums, your Citadels, and likely what they're doing, one is they're just trading it, but they tend to be sort of pseudo market makers in many ways. And they also will use these to do the basis trade. So they'll go long the futures because there's a little bit of a premium in the futures that roll every month. And so you're going to sell those. And then to offset that position, you're going to go long the ETF. So there is some of these flows that has come from just simply the structure of the futures market and the futures curve. And some of that flow coming in is not, it's neutral to price because you're shorting one instrument and going long another. But for the most part, no matter how you slice it, this is going to be impactful. And we're just at the early stages of adoptions in client portfolios as far as we're concerned. So it's going to be impactful. The one thing I would caveat is a lot of people are like, how is the price going down with money coming in? And it's like these ETFs, again, they're a big part of the market now, but they are just one piece of the pie, just like any other market. Yeah, we can see it. It's blatantly obvious that money's coming in. It's one of the benefits of this. It's just that it's not going to be, everything.
Right. Now we're talking about the impact the ETFs have had, but I'm curious what the impact you think MicroStrategy has had and those offshoot ETFs. I know you've been doing some work on that lately. Could you just take us through your thoughts on what's going on there?
Yeah, I mean, so it's actually rather unique, right? So you can't argue that Saylor buying billions and billions of dollars of Bitcoin wasn't impactful. In the same way, you can't argue that billions pouring into the ETFs is not impactful to the underlying price. But the ETFs you're talking about is actually rather interesting. So one of the hottest trends this year is single stock ETFs, and basically it's literally just 2x MicroStrategy, and that's all these ETFs are offering. And They're rather new in the last couple of years, and they are extremely hot. I mean, if you look at just these ETFs, there are some inverse ETFs. There's an ETF that is just selling basically at the money calls at MicroStrategy, or like just above, like almost pseudo covered call, and they generate massive yields, like 70% a year. You're giving up like almost all of your upside at MicroStrategy. But there's a lot of these stocks, these ETFs, that are just buying up MicroStrategy stock. Honestly, it's probably helping promote that premium that we see in the price versus the underlying value of the Bitcoin that it holds. But the one interesting thing over the last few weeks is basically the way that these 2x type products get their exposure is through dealers or banks, and they offer swaps on like the underlying asset. And they've basically said there's too much here. So they are not like offering, their full exposure isn't coming from these dealer bank swaps anymore. So what they're doing to get the exposure is they're going out and doing super out of the money calls to try and get different types of exposure through options, which ironically enough, yes, it's giving them levered exposure on MicroStrategy itself on a daily basis, but it's kind of breaking down. It's not giving that 2x on a daily basis like it's used to, basically because they can't get, the dealers and the banks won't, take the other side of that risk anymore.
Wow.
It just seems like it. Could you maybe outline it? I'd love to get your view, James. Like, is there a breakdown that happens? And have we seen anything like this before? Probably not. And what would be like a worst case scenario in this example you're outlining?
For the ETFs or for MicroStrategy?
Well, no, for the ETFs and and it's like, do we see an unwind? Like just trying to think it through, because you've got all these kind of levered products on top of this one stock, and I just just trying to understand the pathways of how that plays out.
Honestly, it's somewhat complicated, and I have a lot of thoughts, and we could talk about this for the entire hit, right? I could just talk about what's going on with MicroStrategy and these ETFs, and it's just absolutely fascinating. But I guess what I would say is, flows pouring out would be basically like outflows for people selling MicroStrategy, right? That's what the net outcome is when people are getting out of these things, or when they're pouring into the 2x inverse products, which some money's coming in, but there's not a lot of interest there at this point, and I don't blame them. This is not something. I mean, with the way this stock has gone, you're playing with fire no matter how you deal with it, right? So, I mean, that's really the only outcome. The one downside is, if you're holding these things, just know that you're not pretty much at this point guaranteed to get the 2x. Those issuers are doing the best they can, and in many cases they are getting that 2x exposure on a daily basis. But there have been days in the last few weeks where they aren't actually getting there. And so MSTU versus MSTX are the two products from two different issuers, and they're trying to go about it different ways. And sometimes one of them is better at hitting that 2x bogey than the other one. And a lot of that has to do with the fact that they just don't have those swaps. So typical, like I said, ETFs, they have swaps, and they go into banks, and the banks guarantee they'll give you 2x on a daily basis over whatever this does, or 2x inverse, and then they hedge that position. And basically, they've gotten to the point where they don't feel comfortable whether the costs are too high. I don't fully understand, but it's up to the bank's discretion, and they're saying we're not taking on any more risk on this single name.
Got it. So with respect to obviously Trump, the election victory was a clear catalyst. Maybe your thoughts on how should investors think about how this how a Trump presidency is more pro, or how much more pro is it? Does it really open up the regulatory opportunity?
I mean, the answer, one word answer, is yes, as far as I'm concerned, right? I mean, even if he has a lot of these pro-crypto, pro-Bitcoin people around him now in his cabinet, and around him just in general in the White House now, or he will when he's in the White House. So undoubtedly, one, that's a huge step up from where things were under Biden, when Elizabeth Warren was driving what was going on, right? So even if he comes in and does nothing that he's promised to do for the crypto space, for Bitcoin, you name it, I think the strategic reserve is still a rather big long shot, in my opinion, but I mean, never say never, I guess. But for the most part, even if he does nothing, it's still a huge step above from what the industry was dealing with from somebody that was antagonistic and sending out Wells notices like they're candy to everybody operating in the industry.
The Halloween of Wells notices.
Yeah, exactly. And literally suing everyone under the sun. And they let a lot of these bad actors and scammers out there that are doing stuff that's super sketchy, and then they're spending their time because it's much cooler to go after a big name like Coinbase or Kraken or Binance. well, there are some issues with some of the things that some of them did, but like the securities offering stuff, there's been no attempt at creating rules. They're just basically saying the rules here are fine and we don't need to change anything, and you guys are not in compliance. And then when they say, well, how do we get in compliance? And like there is no path, and then they just send Wells notices and sue people when they're debanking people. I mean, all of that is like, as long as that just stops, right, or slows down, or they go after the people that are actually doing bad actions rather than attacking companies trying to like be regulated, that is going to be positive for space, let alone if we actually do get some sort of like clear rulemaking and discussions between the SEC, CFTC, and the industry and Congress about like what's going to happen. So you also, you got to realize it's not just Trump. We also have, one, even before this election, we had a lot of Democrats in the U.S. that had sided with SAB 121 overturning. There's a lot of people that voted with the crypto market structure bill, FIT 21. Granted, it never got through, but there was a lot of Dems that joined the Republicans in trying to create, laws and frameworks for how to handle these things. And then after the elections, even the House and the Senate, not only did we have Republicans take both houses, but we also had a bunch of Democrats. A lot of the new Democrats that came in are actually also pro-crypto or want to create some sort of regulations here. So it's only a matter of time before we see something. How quickly does that happen? I don't know. But like all of those things, it's like pointing in one direction. And it's undoubtedly going to be positive. So one of the things that I'm looking at is in my space is we're looking at all these other ETFs that are going to come to market over the coming years under this new, at least not necessarily crypto friendly, but at least somewhat more accommodative or less restrictive and less antagonistic than what we've seen over the prior 4 years.
James, perfect segue to the final question. We got some XRP warriors in the chat. So, just with respect to future XRP, other altcoin ETFs, maybe you could talk about the landscape heading into 2025 and the same kind of kerosene that the Bitcoin ETF did for Bitcoin. Should we expect that for the altcoins?
Yeah, I mean, so there's two things. First, I have another chart that's a cumulative chart for Ethereum ETF flows. It's like red and green, and it shows like what's going on and what has gone with the Ethereum. So I know that's not specifically what you're looking at, but like this kind of goes to like another theme that I've been talking about when we do our podcasts. Actually, that number is 571. We actually had another massive day, so the number has actually gone up a decent bit. We're at like 727 since these things launched. So as you see, this is net outflows for the Ethereum ETFs, which we got in July of this year, and money just poured out, which basically came out of the Grayscale product, right? People had no interest in it. And then you see all of a sudden it goes from 554 million in outflows in the early November. And then the day after the election, all of a sudden money starts pouring in. And now we've seen basically over like 1.25 billion pour in since the election. So this goes to my theme of, I think like these other coins are likely to benefit more from what we just talked about than necessarily Bitcoin itself, because it's going to open the doors for more regulatory framework around like decentralized finance, what's allowed, tokenization, these types of things. They might not be like completely accommodated for it, but they're likely to be at least more open to it. So it makes sense. So we've already seen this happening. There's been more money coming to these things that are other than Bitcoin, which was the one thing that had a lot of clarity in the regulatory space. ETH got decent clarity with the Ethereum, with the ETF approval, but there's still a lot of things up in the air around what's actually going to be allowed on those platforms, right? So then we get to this table of what all these other people have filed. So I have a table listing out everything that's been filed, and you can see right now the things that are really coming up are there's going to be ETFs that hold Bitcoin and Ethereum. And then there's also going to be ETFs that there's a bunch of applications to convert Bitwise's BitW, which is like a crypto large cap index, and Grayscale's GDLC, again, a large cap index of cryptos. Those are the trusts. They operate with premiums. They're trading at discounts, like similar to what we dealt with with these other Grayscale products. And they want to be able to convert those. I don't know if those will get through. They might. Those index ones, because, Bitcoin and Ethereum, I think they're a shoo-in. They're going to get approved. I don't know exactly when, but it's going to happen. These products that go into other things like holding Ripple and Solana and Aave and these other coins, it is a much smaller part of the portfolio. So it might sneak in just because it's a small part of the portfolio before the new SEC comes in. But what we've had recently is we've had filings for XRP ETFs, HBAR, Litecoin, but the main one right now is Solana. So Solana, there's a process to get ETFs, right? You have to go through two divisions at the SEC. One division is Division of Corporate Finance. That's like your typical S1, your prospectus filings, just your paperwork saying exactly what this fund is going to do, what's going to hold, how it's going to operate. That's like pretty standard procedure. All companies have to go through that in the U.S. for the most part, that division. Then there's a Division of Trading Markets. You have to file a 19B4, which is essentially a rule change. So the exchange basically says, I want to be able to do this. And they had to do this for Bitcoin and Ethereum. Right now is the only other one they've done it for besides Bitcoin and Ethereum and the basket ETFs is Solana. So they're specifically saying we want to change the rules to be able to list the Solana ETF. Now, they just filed that a couple of weeks ago. What's important is technically they filed this back in September. So Van Eck and 21 Shares filed for this back in September, and the SEC basically refused to acknowledge it, which is an outright denial, essentially is what it comes down to. I think that's what's going to happen with these filings for Solana personally, again, because if you look at those lawsuits I talked about against Kraken, against Coinbase, against Binance, and many other places, they are the SEC's another division, the Division of Enforcement, the one that everyone's upset with right now in the crypto space, is basically saying Solana is security. They also say XRP is a security. Now, I think ultimately that won't be the case, but there needs to be time, right? Gensler's still at the SEC. We still have the Dems are running things at the SEC. We'll get a new SEC administrator at 6.67 months from now, potentially. But Gensler and another Democratic commissioner are leaving in January of this year. But that doesn't mean things are going to happen quickly. And I think you need to clear up a lot of those other things, those lawsuits. Like you can't just have one division approving Solana to get it launched in an ETF as a commodities ETF while you have another division, the Division of Enforcement, saying this is security, right? So there's a lot of like issues here. CBOE and these issuers are pushing the envelope at the SEC. My expectation, so if they don't acknowledge this within the next by Thursday or Friday, that means the clock isn't going to start. That just means these guys are going to file again probably in January or February when there's another SEC admin, and then they'll start looking at it. But there's a lot of other things, moving parts that need to happen here. So this is a really long-winded answer, but essentially the way that every Bitcoin and Ethereum got through was you need a regulated market of significant size that they can monitor for manipulation. That's what they were worried about. The way we got through that with Bitcoin and Ethereum was the CME futures market. They said that was big enough. The problem is we don't have a CME futures market for anything else, not yet. And even if we do, it would take months, if not years, before it builds up to the liquidity and trading volume and open interest where it would be big enough the SEC would accept it. The problem is, like, that's just precedent. There's no rule that says, like, that's how this needs to be done. And so particularly if we get a new person running the SEC, I think just setting up surveillance sharing agreements with those exchanges I just talked about, Coinbase, Kraken, Binance, you name it, whatever they are, Gemini, all of a sudden, I think that should satisfy the concerns. It's just that Gensler's SEC did not want to give any, they didn't want to say everything was on the up and up here. We're going to assign a surveillance sharing agreement. It'll be good enough for us to surveil, because they're also saying at the same time that you're like illegal and everything you're doing is wrong. So I think ultimately that'll be how these things get launched in the coming years. But we'll know literally in the next 2 to 3 days whether or not we're going to see these. And then if they do acknowledge them, if I'm wrong, and I think the odds of them acknowledging this are probably around, I'm like near 50-50, but I'll go 40%, which I know is kind of a cop-out, but I think it's less than 50 that they acknowledge them. Then the ultimate deadline would be August 8th. So we could see these things launched in August, but I think that's probably a little too optimistic would be my base case.
Wow.
Oh, man. James,
that was great. That was some knowledge there.
Fantastic. James, always a pleasure, man. You bring a lot of insight to the stream. And the Commodity 101. Like, James, if you guys don't know where to find James, always bangers on X. James, thank you so much. That's James Seyffart from Bloomberg.
Thanks, James.
Thank you.
Thanks for having me, guys.
All right. Thank you. Up next, let's go to it. Terry Lynch, let's do the intro.
We're going to go right in.
Power nickel.
You're going to start hearing from the CEOs now.
Terry,
hey! All right. We're bringing Terry Lynch on. Here he is. Power Nickel. How are you, sir?
Yeah, it's great, guys. Good to be here. I was just entertained listening to the last episode. It's pretty interesting stuff. Lots of insights there for sure.
Yeah, for sure. Yeah, well, it's the commodity market is expanding, and so obviously Bitcoin roll, and we had Warren with a lot of good insights on the oil and gold. Terry, always a pleasure to chat. You bring such a great wealth of knowledge through many commodity cycles. How would you characterize the current backdrop for base metals, the supply and the demand? And is the industry investing enough to meet future demand?
Yeah, I think obviously we're in a bit of a choppy market right now. Probably economic concerns sort of weighing on the base metals, in the short term, this year and maybe a bit next, and you can see that in the commodity pricing. In the long term, i.e., sort of outside of 26, as you move towards the end of the decade, you're going to, we're all going to sort of suffer the lack of investment that's happened over the previous decade, because it's not easy to turn these things into mines, as you know. So we'll see a major supply disruption in copper for sure, probably nickel, probably several other commodities, and so that'll lead to a much different price index for those commodities. And for explorers like ourselves who are not going to be producing tomorrow, you'd have to think that the price index going forward is going to be a lot more rosy than it is today. But that's sort of how we see it.
Fantastic. A great overview right there. Now, so big picture, we've talked about this in the past. There's been a disconnect between this strong demand for critical metals. Clearly, that's where the future is evolving, and the valuations of the underlying companies that are producing them and exploring for them. This disconnect is the most acute in the small and mid cap universe. What catalysts, really change that dynamic? Because, I think we all see the value. Just, Terry, maybe you can help us, through your history of the cycles. Like, is it M&A? What are the levers that start to come in, and are we starting to see green shoots of those levers happening?
Well, traditionally, it has been the M&A that's sort of kickstarted these things, and as the majors and the intermediates realize that their pipelines are barren and they need to sort of sweep in first. So you're starting to see that already now, a lot more M&A activities happening, and that's good. I think, if we're honest about the elephant in the room, there is a structural problem in the Canadian and the American markets in the small cap universe as it relates to the manipulation that happens in the markets. So nobody likes to really be upfront about this, but there is clear market manipulation and the spoofing and the naked short selling. It's pretty well documented now. There's a lot of evidence out there. This is no longer conspiracy theory stuff. And until the regulators and the politicians address this in a serious way, this bounce back will not be as quick as we'd like it to be. That being said, I think from an investor perspective, it's an unbelievable time to be an investor, to have capital, because you're buying some tremendous names that are trading at 10, 20, 30 cents on the dollar, and they could go into multiple dollars. So you're looking at 10, 20, 30, 50, 100 baggers that will happen here. And if you have to wait 6 to 12 months for that, is that a bad thing? I don't think so. So I think, the best move in any investment cycle is going from bad to less bad. And we're about to do that in the commodities. So I think if people are sharp and with it, they're going to be saying, hey, I'm a value player, because those are the guys that make the really big money, and they go and they look for the value deals that have cash on hand, have got catalysts coming, and then be patient. It could happen tomorrow, but in all likelihood, it's going to happen over a period of months. As they, I think the Trump administration is going to get hard on the naked shorters. That'll force the Canadians and others to follow suit, and I see a major change in that. The malfeasance that's happened, and that will be the catalyst the market needs.
Yeah, and the other part too, you touched on Trump, and just we just saw recently China's salvo on critical metals, but clearly the domestic production of critical metals has to be important, right? Like from a North American geo perspective, right?
Yeah, a lot of people think that with the Trump thing, the IRA is probably gone, and I expect the branding is going to go. The Inflation Reduction Act will probably die, but it'll be recalled the Defense Supply Chain Act or something like this. And the U.S. defense has woken up to how horrible they are in the supply chain, and they're moving rapidly. When the Americans wake up to something, they can move heaven and earth, and they will. And so the supply chain stuff will be dealt with. And we've made it clear when in talking to senior defense officials in the U.S. that it's not that the governments haven't done enough. The governments, both in the U.S. and Canada, remarkably have done some pretty good programs to, advance critical minerals. What's lagging is the market response. As you said, you talked about the various pricing discrepancies, particularly in the small and mid-size explorers, who are the guys that make the exploration discoveries that ultimately the majors pick up and ultimately bring into mine. So that sector is broken because of the malfeasance that allowed to happen, and the defense guys are now clued into this. So I expect the DOJ to start to make some moves on that rate in that respect. Our advice when we talked to the Ford government here, we said, you need to talk to the banks and wake them up, because it won't be Power Nickel they'll be worried about, it'll be the DOJ. And you're already seeing that with TD and CIBC. So it's time for the Canadians to wake up.
Fantastic. Now, Power Nickel, power polymetallics, as I like to think of it. It's your NISC discovery in Quebec is positioned to be the next great polymetallic super discovery. And when I talk about polymetallics and copper, polymetallics is probably the one where investors don't understand fully as well as traditional. Right now, could you share with us why polymetallic resources are so valuable?
Yeah, I mean, basically, let's define what polymetallic means. It just means that there's no single dominant commodity in your output. So in our case, we'd expect to have probably 33% nickel, 33% copper, and 33% noble metals. So PGEs plus gold and silver. So we might have Norilsk, which is the world's greatest mine in the history of the world, $1.4 trillion minerals in the ground, you go across the spectrum. The greatest mines to have in any economic cycle are polymetallic, and the reason why is they're natural hedges, right? So you never have any one commodity is dominant, so you're getting scuttled, and in fact something else is up and something else is down, and so your outputs are fairly consistent. So that's why they're so enticing. It's just super rare and super hard to find, but thankfully at Power Nickel, soon to be Power Metallic, we've found a major discovery, and we're having some very exciting results, and we're spending a bunch of time now communicating to the institutional investors around the world on just how big this is going to be. So that's the big, we've had a great year, went from, basically quadruple the stock this year. And I say to people, the best is yet to come. Like, I think we'll do much better next year than we did this year, which has been a great year.
Yeah, and maybe just on that, it's obviously it's been a fantastic year for Power Nickel. Maybe you could take us through just the evolution of how you guys got here, because for those who don't know the story, it's been a very exciting story, and it's the discovery is very interesting. Like, there's a story here on how polymetallics really come to fold. And I'll pop up the chart there, just shows the overall NISC high grade polymetallic area.
Sure. Yeah. So obviously on the bottom left-hand corner of that chart, that's how we started. We had a nickel sulfide discovery, nice one, 3.1 million tons of 1.5% nickel. We've grown that to a little over 8. In searching for more nickel sulfide, we've gone out to the northeast quadrant at a very similar sort of ultramafic at surface, drilled it, and we had the discovery hole, which was almost 8 meters of 1 ounce PGMs, 1.5% copper. And then, wow, that was a great hit. And then we followed it up with, 15 of 16 holes, from January to April. Probably 8 of them were averaging 10 meters of 10% copper equivalent. These are like never been seen before numbers anywhere. Certainly the greatest sort of discovery in the last 30 years, we think. And, that brought in obviously the Friedlands and the McEwens of the world and did us, raised us $20 million. So now we're fully funded. And then it also brought in some thought leadership. So Steve Beresford, who was the chief geo at First Quantum, MMG, and then IGO, 3 back-to-back hits in the polymetallic world. He joined first as an advisor and then eventually as a board member, because he realized the potential size and scope of this project. And that's what his whole passion is, to find these giant orthomagnetic copper, nickel, PGE deposits like Norilsk, like Sakatti, like Platte Reef, like Voisey's Bay, and this is going to be another one of those. And it's it's what's interesting about our process is that obviously we had the nickel initially on the left side, the nickel Nisk main, and then we stepped out and to the northeast and found the line zone, and we've obviously, analysts say we have 5 million tons of 6-7% copper equivalent. We're comfortable with that. We think it's probably more, but whatever. And then we've been stepping it out again. Like we just banged out another 150 meters, hit it again. So this thing it's going to be big. So we're tracking a 1.9 kilometer on surface ultramafic exposure, sort of 1 for 1. We're now at 700 meters. Will we get to the full 1.9? We think so. Can it be bigger? Yeah, it can. And for every ton of copper sulfide that you find, and these historically worldwide, you find between 2 to 7 tons of nickel sulfide underneath. So again, could it happen that we have no nickel sulfide underneath? Yeah, I mean, we obviously got the 8 million plus tons already on the left, so that we know that's not happening. But it just shows you this thing's going to be big. And it's like we've done all this at 10,000 meters of drilling, we've proved up at least 550 meters. Now we stepped out another 150. That's the start of the 30,000 meter drill program we're doing now. So would it be a stretch to see us triple that by the end of April? It wouldn't be a stretch. And then how big can this thing be? So, people have been asleep on Power Nickel, even though stock has quadrupled. They don't really realize how big a tiger we've caught by the tail here.
So you sent us a great chart, and just maybe we could talk about the line zone in specifically. Like that really is just, Terry, you want to take us through, what's happening with respect to delineating the line zone, the opportunity there?
Sure. So, I don't know if you're posting that chart, but
we're going to get it up now.
Basically, one of the things when we put out that release this week, we had 2 objectives. First was to showcase people just how big we already have. We've got 550 meters of strike length right now, and this is remarkably consistent and rich, right? So we're probably averaging, 15 meters of 6-7% copper equivalent across that stretch. I mean, that's insane, but clearly it's not like a one-hit wonder. This is, we showed 5 holes. We probably have 15, in that range of material. So it's very, very responsive. And so that's the first point we want to make people, is that this is already a big discovery right now. This is going to become, in our mind, a mine. There's no question about it. And now we just need to know how big it's going to be. And as you can see in the backdrop there, it's set out against like a 1.9 kilometer, 1.85, visible ultramafic. We think it's actually going to stretch all the way down to Nisk Main, which is 5.5 kilometers away. So imagine this is 550 meters right now. Imagine if it goes 5.5 kilometers. It's mind-blowing, and then underneath this, most likely is the giant nickel sulfide that made this happen. That's how these things, this is a nickel deposit. This is a form of a nickel deposit, the orthomagnetic. So the top parts of it are the copper sulfides, and they have the high-grade PGEs and golds and silvers. So that's the sort of the money part of it that gets us the money to drill down to what is probably deeper at 500 meters or a kilometer down there, is the beast of the nickel sulfide. So that's to be found. But here we are, banging these holes out. So it's certainly exciting times to be releasing assays at Power Nickel. I can't hear you, Tom.
Sorry
about that, guys.
Oh my God!
I won't get in the way. Sorry. Let me read again. Those who can read my lips. So I'm sorry. So Terry, you touched on it earlier, but I think we need to really highlight it. You've attracted a big roster here, from star mining investors like Robert Friedland, Rob McEwen, to the foremost expert in polymetallic mining and Steve Beresford. Could you talk to the importance of that bench strength, having strong backers in both the mining side and the capital side, and why that's so critical? Like those are kind of things you need right now to make anything work in what could be viewed as a tougher environment for those that actually have those two, that you almost have kind of a green light, right?
Yeah, I mean, obviously, it's been a tough market for. There's a lot of great stories out there, a lot of great discovery stories, and many of them have been completely disrespected. I mean, and we feel hard done by too, but at least we've done, okay. We've moved, we've quadrupled or so, and so that's good. We fought very hard to get in to meet these, influential investors like Robert Friedland, Rob McEwen, Gina Reinhardt, others, and obviously these guys are very sophisticated. They have the best talent to give them advice, and so when they step up, they do so as a knowledge investor, and so that really gives, or should give, the broader community comfort to know that, hey, smart money thinks this is pretty damn good. Now, it doesn't guarantee anything. Nothing. There's no guarantees in this life, but obviously they've done very well with their investment over the years. These guys, and so that's impressive. And then obviously getting Steve Beresford. I don't know if you know the story behind how we got him. My son had actually seen a video of his on his hunt for the next Norilsk. And he said, Dad, this guy's talking about NISC, but obviously he doesn't even know us. Reach out to him, see if you can't get him. And I'm like, yeah, as if that's going to be easy. Don't know the guy from Adam. So I reached out through LinkedIn, sent him the assays, and he got back. That led us to where we're at today. So he's there strictly on the merits of the property. I didn't know Steve. Now, of course, we're friends. He's a great guy, and it's a wonderful guy to do business with. But he came because of the strengths of the property. And investors, that's what they should be looking at. It's at the end of the day in mining, it's all about the drill bit. Management needs to put the money in the ground and execute and make sure they finance properly and do those things. But nothing can make it up. You either have a 1 or a 0 when you're drilling. We got a 1. So that's the thing to pay attention to.
That's a stamp of approval. You reach out of the blue, send your assays, and one of the foremost experts in your type of deposit replies and joins you.
Yeah, I mean, we've been blessed. We've had some great guys, and we just got JC Evanson on side, and JC's a really very respected mining advisor institutionally. And he brings us, it's always, I would say that would be where we've been a bit weak. We haven't had a lot of institutional interest because we financed it ourselves generally, just because brokers have done it's been a struggle for them in this market. So we've had to sort of put our own capital in and seek these high net worth people like Rob McEwen, who's been there twice for us, and Robert Friedland and others, and we've been blessed, been able to get before them and get them to write checks. The next stage for us, obviously, is to push into the institutional realm, to get the big commodity funds in, and they're already hovering around. And then we're getting obviously industry is quite interested as well. But we've said, hey, look, at some point, we're interested to talk to you guys, but we're in the discovery process here. There's a lot of meat on this bone, and we can discover it as effectively as anybody in the world can. We know the deposit better than anybody, and we've got a world-class team executing on all cylinders. We're fully funded. It's time to sort of ramp this baby up.
Wonderful. Terry, exciting 2025 ahead. Thank you so much. We're obviously following the story closely. We're going to have you over at Grizzle HQ for PDAC. And by the fire, we'll have a proper
the legendary fire pit with the drones and everything.
Exactly. Terry, thank you so much.
Looking forward to
it. See you in a few months, and Merry Christmas, Happy New Year, Big 2025, PNPN.
Awesome, guys. Cheers now. All right.
Thank you, Terry.
Terry. All right, everyone. We hope you've been enjoying. We're just getting started. As hard as it is to believe, these insights have been incredible. This is why we put this group together, right? It's a very, very group of smart people. Hope you've been learning a lot. We have. We're going to come right back with West Red Lake Gold Mines. Don't go anywhere. All right, everyone, welcome back. Remember, this is a live show. If you have any questions, you're curious about something, put it in the chat, comment. Your question might get asked. You've seen we've been asking live questions.
Yeah.
So let's get right into our next guest. We're happy to be joined by Gwen Preston. She's VP of Communications at West Red Lake Gold Mines. Gwen, let's get her up here.
Hello.
Gwen, welcome to Body 101.
Hey, Gwen, how's it going?
Good. How are you guys doing? I mean, you've got lots of energy. I'm waking up on the West Coast just listening to this.
Oh my gosh.
We're your coffee. You don't need any of that.
Right,
it's absolutely true. I did not get a coffee. I was like, I'm just going to listen to this.
All right. We got you. Gwen, thank you so much for joining West Red Lake Gold. Gwen, for those not familiar with the story, it'd be great to kick off with a brief overview and history of West Red Lake Gold. It's a unique combination of a company with pre-production, yet very much exploration focus. Give us the overview.
Yeah, absolutely. It is a complicated story, but it's a really exciting story, I think, especially in 2025. So West Red Lake Gold is a story that started 18 months ago. Well, really, it started sort of 2.5 years ago when Frank Justra, who's a really successful mining financier, investor, one of the best out there, got to know Shane Williams, who's a very, very experienced mine builder. And the two of them connected on the idea that we were going into a gold bull market, and they wanted to create a new vehicle for investors to benefit in that market. And they both shared the thesis that the best way for investors to get leverage to gold in a rising market is through companies that are delivering significant production growth. So rising production, you get, the increase in your NAV on top of a rising market. And that is what really gives investors leverage to gold. So to do that, basically, they needed to create a new gold mining company. And so West Red Lake Gold is the company that they created. The foundational asset that they acquired for that company is the Madsen mine, which is basically smack in the middle of Canada, western edge of Ontario in Red Lake, super famous high-grade gold district. I mean, globally, it's a district that's, churned out 30 million ounces of gold from high-grade material. And the Madsen mine, which is in the lower red land package in that image right there, has a history. This is a mine that operated from the late 30s to the early 70s. They pulled 2 million ounces of gold out of the ground from rock that was like 9 grams per ton, which is a very nice grade. Classic Red Lake mineralization. They did some great exploration. They found the 8 zone, which is underneath the rest of the deposit, but like 3 times the grade. So tantalizing that they drove a shaft all the way down to that 8 zone, which is at almost 1,300 meters depth. So they did great work in that historic version of the operation. Then in the 70s, the gold price wasn't worth enough and it cost too much to keep the mine dewatered at that time. And so it shut down. Fast forward past a few little restart attempts to 2015, and a company called Pure Gold bought the asset. Now they did some really, really good work, 180,000 meters of drilling that defined the resource that we're still working with, which is 1.7 million ounces of indicated gold, grading 7.4 grams per ton. That's still, the underlying resource at our asset. So they did a bunch of really good work. And then they made a few missteps as they put the mine into production that unfortunately were very costly for them. So the missteps meant that the mine went bankrupt after only 14 months of commercial operations. That created an opportunity for Frank and Shane when they went and analyzed those missteps and realized that they were all fixable things. They were all things that could be remedied if you had enough mining expertise, which is what Shane Williams brings in spades, and then access to capital, which Frank certainly brings, especially, and then, with Shane's connections as well, and just approach, right-sizing it, patience, know what you need to do. So they went in and they bought this asset, and that deal closed about 1.5 years ago. And since then, since mid 2023, West Red Lake has just been pushing as hard as we can to get this mine restarted. Now, we're not going to restart it until we know that we can restart it successfully, but we're right on the cusp of that. 2024 was about doing a bunch of the work that just needed to be done to get us there. And now 2025 is going to be about turning this mine on. So we are, after, it's fast but slow. It's felt slow in some ways, but it's also, we've done a lot in a short time. Now we're ready to be the emerging gold producer in this gold market in 2025 when there's hardly any new gold mines out there. So that's the backstory. There's exploration on top of that, but let's just leave it at the meat and potatoes of new gold mine for now.
No, it's a great overview of the opportunity ahead, and so this you got this old operator, they had some missteps. You guys picked it up for a great value, figure it out. Now, definition drilling obviously is critical, right? Like this is like maybe you could talk to us and investors about how definition drilling is like really, what makes you guys very comfortable that 2025 is the year.
Yeah. So, I mean, the question of what went wrong and what are we doing differently is very common. And it's certainly it's the foundation of everything that we are doing at the Madsen mine. So really, the previous company stumbled because the material that they delivered to the mill was less than half the gold grade that they expected, and their costs were quite a bit higher than they expected. So both things that don't work out well. Now, on the first side of that, the material not grading what they expected, they delivered 3.5 gram material when they expected to deliver 8.5 gram material. So you don't need to be a mining engineer or CFA to figure out that that's not going to work out very well. And the real problem behind that was they did that huge amount of really good drilling up to the point when they started engineering the mine. And then once they got into sort of mine engineering, they stopped drilling. And that's not something that you can do, especially in this kind of gold system where you're talking about fairly narrow veins and the gold isn't consistently spread like butter along those veins. It's lumpy. There's a chunk here and then there's nothing. And then there's a lens here and then there's nothing. And then there's a big pocket there. If you want to mine effectively in that kind of system, you have to hammer that resource with drill holes so that you really accurately know where the gold is, and you only mine those areas, and then you don't end up mining the mostly barren material that's in between. So they didn't do all of the defining those lenses, the definition drilling to do that. Their drill holes were 20 meters average spacing. We're pulling it down to 6 meter average spacing. So if you think about that in like 3 dimensions, think about how much data we are adding to the resource model. And then of course, we're layering in a bunch of other data about what we're seeing underground as we develop chip samples, all of that, a slightly updated model. And we believe that we have very good understanding, an accurate model for where the gold is. Then you have to mine it appropriately as well. There were some approaches to their mining that were insufficiently selective. So even though I don't think they were really selective enough in where they wanted to mine, they also didn't only mine that. They overbroke, they took material from around the zones that they were trying to mine. They were not sufficiently selective in their mining method. So we're mining experts. We're going in with the appropriately selective mining method, and we're attacking the areas where we accurately know the gold really sits. So that's how we plan on delivering material to the mill that is the grade that we expect. We're going to deliver material between 7 and 8 grams. We'll find out the actual number on that. We're about to put out the official mine plan, so that'll lay out those numbers with clarity. But that's the premise, the mining premise. Then there's the cost side of things where they made some decisions that pushed costs from construction into operating, leased a lot of stuff. So that really increased their operating costs. We've been doing those capital projects now, so we're not pushing that into operating costs. And then other capital projects that are really just about efficiency that they didn't do, that hindered their ability and moving material efficiently. That's the other. You got to know where the gold is and you got to move the rock efficiently. Those are the real tenets of a successful mine. And so we're doing several capital projects that are also just about setting up an efficient mine. So that's really the what went wrong and why we're going to be able to make it work story.
Yeah, great overview, like excellent. How the fix works and how you guys are tackling it. Now, we've talked actually extensively about it. And you've talked about it. It's this golden runway concept. And for those who aren't familiar, the Lassonde curve is actually a very critical component of how investors should think about investing in mining. And the golden runway, you Gwen, through your career researching gold exploration companies, could you talk to us about the importance of timing in the industry from an investment perspective and what that value of that golden runway is. Maybe define the golden runway, but it's that kind of like just before production, you get first pour. But yeah, talk to us about, what you've seen historically and why this is such a sweet spot.
Yeah, I mean, the golden runway, the Lassonde curve, for anybody who's seen it before, really captures the two phases of a project's life when investors can make good money. And one of them is when the project is being discovered. Discovery excitement is like, woo, there's no realities on the table. What could this thing become? This is like turning moose pasture into gold. So sure, the discovery side of things, dramatic.
And most people would consider the discovery side when they think about mining and mining investing. It's all they only think about the discovery side, right? Like that's no one really thinks about the second ascent. And I just, but for our viewers, like that's where everyone's like, oh, I just discovered this, and that's where things happen. But it's this other part of the Lassonde curve that happens, and no one really kind of, there's not a lot of work done on that side.
And what's interesting is a lot of the more long-term or, the bigger money that comes into mining doesn't play the discovery side of things because they know how risky that side of things is. It's great when it works. Oh my gosh. But how often does it not work, right? And that's not, I'm not trying to speak badly about explorations. We need them. We need them to get out there and fail a bunch of times because 1 out of every 50 times they'll make a success. And that's how we find the materials that we need to make our monetary and, physical world work. But it's super risky. So a lot of the bigger money, the lower risk money, the more mining aware money that comes into the space actually plays that next part of the curve, which is the discovery happens. Then you go through this long grind of figuring out what it is, engineering it, permitting it, financing it, doing all the studies. The value of the project declines significantly during that time, even though, of course, it's essential work. Then you get to actually building a mine. And when you're building a mine, you're going from, you get to the point where you're like, okay, we're going to turn this thing into something that churns out money. And then there should be a re-rate from a stock should rise in value when it goes from only spending money, which is what it's done through this whole boring period, right? It spent a lot of money. That's what's needed. And including building the mine spends a lot of money. Then it should go to making money. Of course, assuming that the mine works, it should go to making money. And that is a very tangible, real thing. And that's the foundation of the golden runway, that you go from spending money and slogging through the hard part of the Lassonde curve through to producing gold. And that's where we are right now. And I think West Red Lake is a particularly interesting golden runway case because we're not going from construction decision. We're like turning this mill on very soon. Like everything's already built. We're going to go into production with almost no debt because this asset was built only a few years ago. We've gone in, we've raised the money to fix the things that needed to be fixed. And now we're about to turn the mine on. So it's an accelerated golden runway that I think the market isn't totally aware of yet because we've been doing so much all at the same time. And so, our three goals for 2025 are to get the mine up and running, to make sure very soon that the market understands that is imminent and what it's going to look like and what the value of that should be, because we're about to be able to make all of those things clear. And then to immediately start layering on top of that first mine that we're starting up, what this mine could become in the reasonably near term, because there's lots of additional zones, higher grade pods of mineralization that we want to pull into the mine plan. And we want to start layering on that next case scenario in the near term as well. So that's the goal. We did the grind in 2024. Now we want to start, delivering on all of that work in 2025.
Well, it's super exciting because, you guys are putting it out there and you're saying, this is what we're going to do. And you're laying it out. You got the framework and it's go time. Now, one thing I really wanted to highlight is, and you guys have a good slide in your deck, but just one area. So there's the Lassonde curve and you've got the second ascent of the Lassonde curve. You're in the sweet spot there. Now, there's also the valuation bump you get from going from a developer. So, and the way to think about it is price to net asset value, right? So net asset value is the stuff in the ground. And as a developer, it's still not producing. So you're going to be valued low relative to all your stuff in the ground. But then as you kind of mature, your valuation on price and NAV increases. maybe you could talk just about, the value of just moving up that chain, because that's a clear tailwind as well, right?
And this is an opportunity to investors and the company as well.
Yeah. But it's like it's just such a high correlation when we'll have that chart up in a bit, but I'd love for you to talk through why that happens really, and how you guys are situated.
Yeah, for sure. And I mean, there's a lot of rationale in this, right? So this is showing the average price to net asset value ratio for gold stocks. And you can see that when you're still in the grind, you maybe don't have a permit yet. You certainly don't have the money lined up to build your mine. You're still really in that like trough of the Lassonde curve. You probably get a point, not even quite 0.3 to your NAV as your market valuation as a stock. And then as you show that you can access the capital to put the mine into production, you get finance, then you move up to almost 0.6. Once you get into production, you probably move up starting to get closer to 0.7. And these are averages too. I would argue that particular jurisdictions, including Red Lake, get a premium on these average ratios. That's one of the reasons that we really liked the idea of a foundational asset being in a prime mining jurisdiction like Red Lake, like Canada. So I think that the 0.6 there, the 0.64 there could likely even be higher. I think high grade also tends towards a higher price to net asset value for new gold stocks. So anyways, you're going from where we're at now in the 0.2 to 0.3 range on NAV up to a 0.6 to 0.7 on NAV. Not to mention that we haven't specifically defined our NAV yet. And so because we haven't put out the official mine plan, which is coming out just at the beginning of January. So that number is going to get crystallized. So I think the clear argument for a re-rate, like the numbers backed argument for a re-rate, is very real. Now, I will also say, usually that re-rate, builds itself in while the company is building the mine, because the market's forward looking, always is, right? But because we bought a mine that's built and permitted but needed fixes, like we're not doing it in the normal sequential order. We're doing everything all at the same time. And so now we're on the cusp of turning this thing on, and we haven't started the re-rate yet. So I think that the crystallization of what the NAV is, and then the realization that NAV is around the corner, I think has some pretty strong potential for what might happen, how investors might get interested in West Red Lake in 2025.
That was a great chart.
Yeah, Gwen, that's fantastic. Thank you so much. A great overview, and just that in mining in general, right? So much of our time you follow the bright shiny object in discoveries, but this is a really great exercise for investors to say, you have a real tangible asset that's coming into production. You can really play with that NAV. Like this is it's an exciting exercise and opportunity for investors, right? And Gwen, feel free, please.
And I mean, I think I said that the third thing that we want to do in 2025 is show what more Madsen can be. This first mine plan, this PFS, pre-feasibility study that we're going to put out in January, is a fairly conservative first mining opportunity at the Madsen mine. This thing failed only just over 2 years ago. So we're putting together a mine plan that we're very confident that we can deliver on, because that's what we need to do. We would need to do that in any situation, and it's probably redoubled because of, there's questions about the asset from its history. But that doesn't mean that this mine plan that we put out is all that we think Madsen can become. We really do see opportunity for Madsen to grow from, the ounces per year that it's going to produce in this initial mine plan, probably in the 60,000 ounce per year range, as you can see from, analyst reports and what the mine did previously. We see potential for it to be quite a bit more than that, and we want to layer on. We want to make clear that potential with, in 2025. And then the other side of that. So we want to see if we can continue to deliver more production growth from Madsen. So keep increasing that NAV at Madsen through 2025 with the market looking ahead to this asset becoming bigger. And, Shane and Frank didn't partner up to build a single asset mining company. The bigger vision here is to then go out and find another asset so we can deliver that production growth re-rate to our investors again down the road. That is, of course, a vision statement at this point. We haven't found that asset. We certainly haven't transacted on one, but that's the goal. We don't want to be a single asset producer. We want Madsen to be our first asset, get us into cash flow, demonstrate our capability, and then we want to go out there and get another asset and do it again. So we're aggressive growth in a rising market. That was the premise of the company, and it will remain the premise of the company going forward.
Fantastic.
Excellent.
So the commodity call was nailed. Frank nailed that with respect to picking off the asset at a cheap price, and sure enough, gold clicks, and now you guys are heading into production. Gwen, very exciting 2025 ahead. We're rooting for the West Red Lake Gold team, and the valuation is definitely attractive. And thank you so much for the insights. And we'll see you at PDAC at the Grizzle HQ. Yeah, the proper fireside. Gwen, thank you so much.
Happy holidays.
Happy holidays to you as well. Thanks, everyone, for your attention. Have a good day.
Thank you.
All right, everyone. Train keeps rolling. We're bouncing around all these different commodities to try to give you a balanced view on what's going on in all the different metals that matter. So we're going to go back to the world of copper. Next up, we have Aurora Davidson. She's CEO and director of Amerigo Resources, another very unique player in the copper space. So we're going to bring her up. Great. All right, everyone, welcome back to Commodity One-on-One. We're going to get right into it with our next guest. It's Aurora Davidson, CEO of Amerigo Resources. Let's bring her up. Aurora, welcome back to the conference. Great to see you.
Nice to see you guys.
So, Aurora, you know the Chilean copper market better than most. Can you talk to us about the supply problems state producer Codelco and others have been dealing with, and if there's anything that can be done for Chile to return to copper, to a copper dominance? And now I know we just got a report that they did see a pickup in Chilean output. So I'm wondering, does that mean the problems are behind the country, or what do you think? What's the situation look like from a supplies perspective?
Look, I think we have a structural situation, but just to be clear, Chile is the world's biggest copper producer, and they will continue being the world's biggest copper producer for a decade or more. There is no structural change that will lead to a different key player. Chile produces 27% of mined copper, and who are the second and third players? DRC and Peru. Peru and DRC, they're always, DRC just surpassed Peru as number two. So for any of the other players to lead over Chile, it's not going to happen probably in our lifetime. So let's be clear about that. Now, what has Chile been facing? It has been facing the same challenges that a lot of the other copper producers dealing with the world's biggest mines, copper mines, are having. They're facing older mines. Older mines mean deeper mines, mean mines with lower grades. And if you have lower grade, that means you have lower copper in your rock, and you have to do much more work to get the same amount of copper. But Chile is the leader and will continue being the leader. The record production, 2018, it was the year when they produced the most, and there has been a tendency up until this year of declining production. Last year they produced 10% less than their record, but they're still leading the world, and they will continue doing so. What needs to happen? There has to be more investment put into the industry. We have to be looking for more resources, but there also has to be a structural change in permitting and in regulatory in the regulatory environment that allows for expansions and for new projects to come online. We have a lot of bureaucracy. We have a lot of red tape that is not necessarily leading to shorter times of having your resource ready into production. So we have to change that.
Great. That was useful.
So you've got this interesting dynamic where you really, you have this strong demand, critical metal demand, but it's just supply is challenged. And now pivoting to China, and growth in China has been critical for copper in the past. But in our last conversation, you gave excellent overview on why countries like India may matter more going forward. Could you expand on that? Because I thought that was a really, that was really insightful, because there's hyper focus on China, but India is really setting up as well.
Yeah, we tend to base our analysis on short-term factors and forget about a more global view of what may be going on. And in this case, the metric we discussed on a prior conversation was the concept of installed copper per person, which basically means it's correlated to GDP. It means how much copper exists within a given economy, Canada, China, India, to support the modern life that we all lead. So the more advanced the country, the more installed copper they have per capita. And in that sense, let's just look at the numbers, because numbers are always telling you the story as it is. So China right now, China moved from an installed copper capacity per person of about 45 pounds per person 20 years ago to 260 now. And they're still growing. They're still in that growth-driven spur where they need to get to around 360 pounds per person. In the Western world, we have more than 500 pounds per person. But India is sitting now with about 15 pounds per person. So it's a significant gap from where they are now to where China is now. And they have the same population, 1.4 billion people. So at some point in time, they're starting to grow up that copper installed capacity per person. The last 2 years, they doubled their copper consumption. So when you talk about a doubling of copper consumption in a population with 1.4 billion people, it's not insignificant. So we have to expand our view of the world in terms of where is the demand going to be coming from.
That's amazing. Yeah, definitely. India has to be on everyone's radar if they're a copper investor and a commodity investor.
Yeah, it's something I just even thought about. It's just that intensity. It almost like whatever historical examples we have for copper intensity as countries grow, you almost know that that's going to grow and increase. But for oil, like that may not be as strong, right? Like copper is like that difference, right? It's, copper is going to increase in per capita intensity versus oil will decrease.
Absolutely. And when you're talking about the copper installed per capita metric, that does not include energy transition demand. That does not include digital demand. This is basically traditional copper demand, the old Dr. Copper demand, construction, basic electrification, infrastructure, etc.
Perfect. Now, Aurora, I wanted to move on and talk about Amerigo a little bit, because you have a unique asset. There really isn't another one like it. So I want to make sure people understand what you're doing there. So Amerigo produces copper without a copper mine, making your business model unique in the industry. Could you provide an overview of how you do it? And we'll throw up a chart.
Yep, it's a very simple business model, which is one of our biggest attributes. We essentially produce copper out of the waste material of the world's largest underground copper mine, the El Teniente mine, which is owned by Codelco. The amount of copper that we produce is not insignificant. We're producing around the same amount of copper a mid-sized copper mine would produce, 60 to 65 million pounds per year. And we sell that copper in the form of a copper concentrate to the market. So essentially we are producing, selling to the market. We don't have a lot of the mining risk. We also have a unique ability of returning capital to shareholders, because we have already attained our production goals. We don't need to grow any further. So the amount of operating cash flow that we generate from our business is being returned to shareholders. So it's a win-win situation. We're producing more copper for Chile. We're paying a royalty for that copper to the owner of the tailings, to Codelco. and we get a copper concentrate that is fully comparable to any copper concentrate produced by a primary producer. We sell it to the market. That's the business model in 3 seconds.
It's fantastic. So one thing it's with respect to green and this is a very environmentally friendly way to produce copper. No doubt, like this is a waste product, right?
Yeah, one of our taglines is the copper factory. The other tagline is the world's greenest copper. We're producing from a green producer. Codelco's El Teniente mine is Copper Mark certified, so they are the best of the best. And we're producing copper from a waste material. We're only using renewable energy to do so. We have low water intensity. Whatever metrics, just look at our website, our ESG scorecard. It almost looks made up because the metrics are just down the chart in terms of what we need to produce this copper.
I didn't know you guys. So your power is coming from renewables as well. This is the full. You guys are doing the full. It's the full
ESG
green
dream here.
Yeah.
Yeah, and it's a business decision, right, to do so. We have been powered by renewable energy since 2021.
Okay, excellent. Yeah, I mean, we followed you guys for a while, and we've been impressed how you've managed costs so well that Amerigo is a very close cash flow proxy for the copper mining business, essentially. So it's impressive because there's not a lot of vehicles like that out there for investors. So hats off to you guys.
Yeah, and so it wouldn't be a discussion about Amerigo if we're in a yield hungry environment, right? Like when we look at the landscape, we're like everyone wants dividend yield. So you have all these characteristics of a metal. In copper that, very a great structural backdrop looking into the future, but Amerigo couples that with a very exciting total capital return formula. Now, you have a dividend yield in copper that's currently over 9%. Talk us through how you decide what's a sustainable dividend payout level and how you decide when it makes sense to pay out specials and buybacks. Talk to us about how investors can think about excess cash flow and you distributing that back to shareholders.
Sure. It's a very simple proposition, really. We also try to simplify it as much as we can and take a lot of decision making out of the equation. So the basic premise, as I mentioned before, is that we do not need capital to grow the business. So any surplus cash can be and is being returned to the shareholders. And that has been the case for the last 3 years. So how did we do that? We basically said we need various tools. The copper market has cyclicality within it caused by variations in copper price. So we need to have a strategy that is flexible enough to allow us to navigate through that short-term cyclicality without creating any problem for our shareholders. So we decided to use 3 tools. We have a basic quarterly dividend. That's the base. That's the base that you can count on every quarter. We now have 15 consecutive quarterly dividends on record, and what we're paying is 3 cents Canadian per share per quarter. That shouldn't change. You should count on that money as part of your regular stream of funds. And then what happens when there's additional cash on the tilly? We have a figure. What is additional cash for us? Anything over 25 million US, we get into what we call additional distributions territory. What are additional distributions? It can be either performance dividends or share buybacks. And we've done both, and we've been active on both. In the last 3 years, we have returned 75 million US to shareholders through these 3 mechanisms.
Excellent. Now, Aurora, before we end things off, I just wanted to ask about debt, because I know that you have free cash flow and you've been paying down your debt with a piece, and then whatever's left over, it goes to special dividends, it goes to the dividend. So your debt is as low as it's been in multiple years. What's kind of the level? Where's the level you'd like it to be versus where it is today?
Yeah, our highest debt level was 100 million US. It basically, we took in that debt to grow our business. We didn't want to dilute shareholders in the process, and we knew we could repay it back. So we're almost there. At the end of this year, we're going to have $11.5 million in debt. And at the end of 2025, we're going to be debt free. So the optimum a debt number for a company like us is zero. We don't need the cash for capital allocation, and we're not going to be borrowing money and paying interest to return a dividend to shareholders or to buy back shares. So as long as you have a solid relations in Chile with your bankers, you have a solid line of credit. Call me a contrarian, but the optimum level for a company in this mature stage is zero debt.
Right.
Excellent.
Thank you, Aurora. And so, maybe just one final question. Given your high dividend yield, I just wanted to think about the mining market as a whole. Is that just something? When you think about the industry as a whole, is that clearly, shouldn't we get to a higher kind of paying out cash flow level? This is something that could bring back the industry, right? Just if there's free cash flow, really give that back. Maybe your thoughts on your conversations with investors and the attractive formula that Amerigo has come out with. But yeah, just maybe, at a broader industry level, surely that's valuable.
Absolutely. But what's happening in industry is that there's always that growth stigma, right? If you're not growing in terms of production growth, you're staying behind. And I challenge that, and I've put up a number of videos on our website to speak about that topic. Does production growth really translate into return on investment growth for shareholders? Not necessarily. There's a lot of risk involved. You're talking to a lot of explorers here in this conference. So the path is not always that clear a path. So if you sort of take a step back and say, you are a business that's generating cash flow. Do you need to grow? Yeah, well, look at your growth opportunities, but don't necessarily be focused exclusively on those, because within a business, there's always going to be that ability to make your shareholders whole through the traditional, the old school dividend path. And a lot of people dismiss that. But maybe it shouldn't be dismissed.
So, a great point, Aurora. And that really is that what you're talking about here is when I get a company with a dividend, I'm getting an element of capital discipline, right? That an exploration company just doesn't have those kind of guardrails. Is that fair to say?
When you're getting a dividend, from an organization that has a mature stage, that has to risk itself operationally and financially, and that's running like a Swiss clock. So if you believe in the integrity and the value of having a nice Swiss clock, that's what a dividend investment is all about.
Excellent.
Aurora, thank you so much. That's Amerigo, a dividend, the power of a great capital discipline and returning that capital to shareholders. Aurora, thank you so much for joining us.
Thank you so much, and happy holidays.
Thank you. Happy holidays.
Bye.
All right, everybody, Commodity One-on-One. Let's keep the party rolling. We're going to take a quick break, and we'll be right back with our next guest. Oh, Commodity One-on-One. Let's go. Hope everyone's been enjoying. Thank you guys for tuning in. Remember, if you have questions, this is live. Put them in the chat. Now we're going to bring up our next guest. He's portfolio manager, founder of the Blokland Smart Multi-Asset Fund. It's Jeroen Blokland. Let's bring him up. We're feeling that music. All right.
Jeroen, how are you?
Welcome back to Commodity One-on-One. How are you?
I'm fine. You guys? How are you guys?
We're doing great, as you can see. We're having a little too much fun, I think.
As always.
I got it. We've talked. You've really defined, since we first interviewed you, the world of scarce assets and what that means. And it's been a heck of a year with respect to your strategy and how those pieces have performed. It almost like, it really is almost like the thesis for why the Blokland Smart Multi-Asset Fund was created, right? For a year like 2024. Maybe I got to give you kind of the floor to give us a recap on just talk about the strategy, but bigger, just, how this year's transpired. It's been a great one. And congrats.
Yeah. Okay. Well, thank you very much. I'm also very happy. You have to be a little bit lucky, even though I can also say it was a perfect philosophy and timing of launching the fund, of course. No. The whole idea of the fund is to invest in scarce assets, and the philosophy is very simple. In a world full of debt, which happens to be the second biggest asset class on the planet, bonds, invest in the exact opposite, which is a scarcity, in this case, scarce assets. So in my case, that is quality stocks, because these are special, physical gold and Bitcoin. And of course, we have had a tremendous year so far, return-wise, but also volatility-wise. So I'm very much in favor of looking at volatility, because that I can manage, and returns, I don't have a crystal ball. But going deeper into your question, what we have seen. So just a couple of examples. Central banks continuously buying gold to add to their reserves. China, for example, Poland. We have seen, of course, this is now already old news, but these spot Bitcoin ETFs breaking all of the records. We know the Bloomberg guys that give you all the data every day. We have the biggest economy and the new president of the biggest economy in the world talking about a strategic Bitcoin reserve. We now have state pension funds investing. We have, of course, Michael Saylor basically selling what he will call bad capital to increase good capital, or one that can weather time. So yeah, you see, I use the phrase the great rebalancing every now and then. That people start to rethink their strategic asset allocation and what is true diversification, and then add some what is fundamentally happening in the world. Now we are seeing France again. The government will be out, I think, could be soon as today. So a lot of the boxes of the philosophy were ticked this year, and of course some of these things actually went much faster than I would have anticipated. So that is a bonus. But if your a question would be, do you feel comfortable with your philosophy? Totally. So that is that feels very nice, and also for my clients, of course. So yeah, very happy standing here, and great first year.
Fantastic.
Yeah, congrats,
Jeroen. Scott, go ahead.
Maybe I'll kick in. There was a chart you posted recently on Twitter, and I wanted to dig into it a little bit. You said the U.S. is the first aging nation that at least tries to slow the unprecedented pace of debt accumulation to create artificial GDP growth. This will be the key experiment for the coming 4 years. What do you mean by this? Can you take us through your thought process?
Yeah, sure. So all major economies suffer from the same problem. I think the only exception among these major economies is India, but we have a lack of growth or GDP growth. So all of these major economies are aging. The labor force growth is either slowing or turning negative. So, for example, in China, the labor force is actually declining already. And that means that we add more and more debt to keep growing. And most of that debt is now added through the governments who have grown very large. And you also see that they have all kinds of spending issues, and the balance between income and outlays is totally away, so given all the budget deficits. And what you see now, so Trump has won the presidency, but also the House and the Senate. So for 2 years at least, he has a very big mandate to implement the policies he wants to. He also created this Department of Government Efficiency run by Elon Musk. So you should assume that at least he has some power to try to get that budget deficit down. At the same time, and that is also what the charts showed, the mandatory costs outlays, and these are not called mandatory for a reason, of course, are going sky high. And you talk about Social Security, Medicare, Medicaid, insurance, everything. So in an aging society, in an aging economy, these, if you have a welfare state, these costs will continue to rise. So even if Elon Musk and Trump get rid of what they will call all these wokeism related things, they will put it on that because that's policy. I think it will be very, very hard to get that budget deficit structurally below the 3% of GDP threshold, which is seen as a magical barrier. And from that example, so first, there's a clear, take for example France, it's totally opposite, but in the United States, there's a clear mandate for the in this case, the man who is in power. And also, they are trying to do something about that with thinking a little bit outside the box. And this is why I call it an experiment. But I do think that it will be very hard to make the experiment succeed.
Interesting. That was a great review of that. Now, I wanted to expand on the Trump presidency. How do you believe a Trump presidency will most benefit the crypto industry? Is it simply expanding access to different coins with ETFs, or could it be more than that, where we actually get use cases for Bitcoin or something like that?
I find it an interesting question, but also a difficult one, because I'm not an expert in what is called the crypto industry. I know a little bit about Bitcoin. There are a couple of things that is interesting to see and is likely to be a positive for the sector in general, that there has been a tendency, again, in all these major economies to make the life of crypto as miserable as possible, because it's very hard to control, and politicians love control. So you see now that Gary's already gone, he already resigned. Pennsylvania has sued the SEC for all the crypto rules. These are going to be abolished, is my guess. Talking about a level playing field, this feels more fair. That's one thing. The one thing I would add from a macro perspective is we should not forget that Trump is about America, is about the US dollar, and is about Trump. So once it becomes clear that Bitcoin, for example, is not helping his goals, and that could be, it's very easy to make such a case because it's decentralized by definition, then I'm interested to see what will happen then. And also, if you then consider, let's say, if this is in the last 2 years or last year of his presidency, I don't know what will happen. So I think for now it's a positive. I see it as a positive. The market sees it as a positive. But in the end, don't forget for what Trump stands for. And I don't know if that is intrinsically crypto or Bitcoin. I think that is more America. And if Bitcoin can help make America that Bitcoin superpower, great. But what if that is not the case?
Excellent. Now, there was something else you talked about that was interesting. I haven't really heard this mentioned too much, but you posted a chart showing that U.S. investors have 35% of their portfolios allocated to private equity. You don't seem to like private equity very much, or at least you think that's way too high. So what are the underpriced risks of that asset class? And I'm curious if you think private equity and private debt could be sowing the seeds of the next financial crisis, because that's something that's like a pet project for me. So I try to watch that closely as well.
Yeah. Okay, please do that. I find it astonishing that so-called smart or professional investors bought this whole marketing scheme. It's a marketing. It's very clear that when you de-smooth the returns of private equities, because the volatility is artificially low because of pricing schemes. And even in a simple Excel, you can de-smooth equities, private equity returns. I can do it, everybody can do it. And then you will see that the realized volatility is actually higher. So they all bought this on this, whoa, this has superior risk return characteristics. Let's put it into our asset mix. And then they lifted it until 35%, which is actually 7 percentage points higher than traditional equities. Okay, so you have this very easy to debunk risk return characteristic. And now an even more simple idea. You don't have to know anything about private equity. I'm not an expert as well, but now suppose you have 100 billion chasing private equity projects, right? They have to find the biggest, highest return on investment projects or companies or whatever. Suppose that a couple of companies are doing that, but now the total amount standing at the sidelines grows from 100 billion to 1 trillion, so 1,000 billion. And all of these private equity funds have to find all of these greatest projects. But the number of great projects is by definition scarce. So to put all that money at work, they have to buy second tier, lower quality projects or companies or whatever, by definition, because the bigger it gets, the more you go down in quality. So private equity house number 755 will buy shitty, less qualitative private equity. It's by definition. You don't have to know anything, understand everything. So my guess is they will either, all of these private family offices will be disappointed by the amount of diversification in their portfolio, and also by the quality, hence returns on those investments. Now, on your second question, could that be the origin of a next financial crisis? Well, I don't. It could well take a lot of things down, because 35% of your asset allocation into private equity is huge, way too large. But my thinking is more like every time they get their capital back, so a deal is done with bad returns, then the bosses of those family offices will say, but didn't we buy this because of the superior diversification benefits of this asset class? Now go back out there and find me some asset classes that offer true diversification. And you know where I am going then, gold, Bitcoin, other scarce asset classes. My guess is they will not put that private equity allocation of 35% back to equities, but they will try to find something else. Now, the weight of art is 1%, infrastructure is 1%, commodities 1%, gold is 0.4%, and Bitcoin, of course, is 0%. So I'm happy to see that even half of that number goes into these asset classes, and actually they will find true diversification. Because there is no smoothed returns there. And from Bitcoin price, looking at Bitcoin price, and everybody knows there's no smoothing at all.
That was great explanation there. Yeah, definitely something to watch with that and private debt as well. Now, I wanted to ask you one more. You've posted this chart before on inflation, looking at the 670s and 80s versus today, and there's looks like some corollaries. Now, do you still think investors should be prepared for another bout of inflation?
Yeah, so that is the chart that everybody uses. So yeah, there it is. Do we get another big spike in inflation? Now, to be honest, I don't think it will be as bad as what is shown here. And I don't think that we will go to the levels we have seen in 2022. For example, in my country, the Netherlands, the inflation peaked at 17.1%, so that's enormous. But the whole debt-driven system in which governments have to issue more and more debt to keep growing, that has to be monetized by central banks, and that means that the risks of inflation peaks get higher. And what I believe is that these peaks will become more common, maybe not 10%, but 5% or 6%, because and that is already very different from between the great financial crisis and 2020. There were 10 years of below subpar inflation levels. Now, I think we will see these peaks every now and then when we get a crisis, when debt monetization goes in warp speed, things like that. And that means that on average, inflation will be above 2% and maybe 3%, I don't know, But that's so I don't know if we are going to 14% like the chart shows, but I'm very aware that the whole system of this monetization of debt with endless spending of governments to keep growing and to get out of crisis will cause more inflation, volatility, and spikes.
It's a great framework.
You know, Jeroen, I always want to ask you this question about when you think about quality stocks. And, you know, we talked last about Europe and what's happening there, but maybe, you know, in a structural decline, right? Like in terms of competitiveness and the rest. Your quality stock basis, how do you look at the various regions? And I'd love for you to kind of emphasize, your thoughts on how Europe fits into that puzzle.
Yeah, so the thing that you described is exactly happening in quality stocks. So quality stocks is a way to create a subset of the MSCI World Index. I do believe that investing globally is still wise because it also gives you diversification benefits. Don't forget that's the volatility part of things. But you can see that everywhere. So you have this ranking on 3 major buckets. So first, do they have structural competitive advantages? Second is low debt, of course, and do you have stable earnings, because dividend income is one of the key income parts of investing in stocks, right? So then there's this ranking, and you see by definition, because Europe is sinking like hell, that the weight of European stocks in the quality basket is also declining. And so I don't have to say anything about it, but it's happening themselves. The thing is, of course, that I don't know why Europe is doing this to itself. And I have discussions with my wife, with friends, with economists. I struggle. So first I thought it was stupidity. Now I sometimes think it's almost on purpose. I don't know why are we doing this. So you see everybody around. The United States has a much more growth-orientated model, but so has China, so has India. At some point, you have to say what is important for the society as a whole. And I do think that economic prosperity has a position, has a place in such a society. So maybe it's not the one thing that we should all strive, but it looks like in Europe that whole concept is wasted, is not relevant anymore. So we have, I think, 2 companies in the top 20 of biggest companies in the world. And this is a big frustration because I'm literally in it. I'm in the Netherlands and I don't understand it. So this is also more like a personal question. I don't understand it, but through the lack of performance of Europe as a whole, that quality bucket is also changing over time. So nothing I can do about it, unfortunately.
We were talking about this yesterday, a deep discussion on it, and there's no easy answers for sure.
No, it's Jeroen, always a pleasure. Thank you so much, and congratulations. We're a few weeks away from closing out the year, but a heck of a 2024, and wishing you the best and the fun into 2025, and look forward to staying in touch and through the new year.
Sure. Yeah, a couple of weeks. So we don't celebrate until it's the first of the next year.
Don't jinx it. We got some wood here. I'm knocking on some wood.
Yeah. But I'll take it. Yeah.
We'll just say happy holidays and leave it at that.
Yeah. Happy holidays. Thanks, guys.
All right. Talk soon. Take care.
Yeah. Bye.
All right, Commodity One-on-One. That was another great conversation with another luminary in the industry. I love speaking with these guys who are looking at different things than we are, so they bring different perspectives. We're going to take a quick break, and then we're coming back with Commodity OG, Leigh Goehring of Goehring and Rozencwajg. Don't go anywhere. This is a big one.
All right, so our main lunchtime keynote, Leigh Goehring from Goehring and Rozencwajg. Always a pleasure. Let's get Leigh up here. Hey, Leigh.
Leigh, welcome to Commodity 101.
Oh man, the hat. You always come with the right. That's a classic one, right? I like it. That's a great one.
I tell people that this is the Goehring and Rozencwajg official cap, and I wear it to bed at night, much to my wife's consternation. So,
Amazing.
Leigh, thank you so much. Always a pleasure. You've been a foundational member of the Grizzle Commodity live series, and some of our conversations. I still chuckle. We've had such great conversations and such great commodity insights, and so a big thank you.
okay, well, great. Thanks for having me back. I love being with you guys, and to me, doing this is a lot of fun. So,
good. That's our goal there.
Totally appreciate it. Leigh, so you have a unique vantage, and you've seen so many commodity cycles. Could you provide for us your broad investment framework for deploying capital in a notoriously challenging industry?
yeah, from a big macro viewpoint, if you're interested in investing in the global natural resource commodity sectors of the market, you are being given a once in a lifetime opportunity to do so today. We study market cycles going back well over pretty much into the very end of the 19th century. And based upon our research, we believe that commodities today have never ever been priced more cheaply relative to financial assets. And every time that they've been this cheap, and like I said, they're the cheapest now that they've ever been. But every time they've been this cheap, it is paid to put not a section of your portfolio into the commodity market, to put it all into the commodity market. Now, I don't recommend investors do that, but the thing is that there's enough opportunity to really seriously think about increasing your weighting here, of which, of course, in today's world, which is dominated by AI crazes and multi-trillion-dollar market cap stocks, no one has any interest in doing.
No, it's a very all in. But that's a very strong statement in terms of never been cheaper, and it's you guys, like, it's a very interesting dynamic. Now, in terms of previous, you'd get price signals and you'd get explorers redeploying capital. Are we seeing that right now? It just feels like it's it seems like we're setting up for more of a tightening that will send the commodities higher, right? Because you're not getting capital put back in the ground.
Yeah, definitely. And I think if you want to look for a market period that is very, very similar to the market period that we're going through today, I recommend everyone to open their textbooks and study what happened in the late 1960s and the early 1970s. Very, very similar to what happened today. In fact, what's interesting is that you look at the AI / Magnificent Seven FANG crazes that we're going through today. It's very, very similar to what began in the late 1960s, which was the beginning of the Nifty 50 craze, which was a craze where everyone had to be invested in what were called one decision stocks. You buy them, hold them, and that's it. And basically the Nifty 50 referred to approximately 50 stocks that all traded at PEs of 50 or greater. And they were all very profitable, well-established companies, of which most of them are around to today. Stocks like Johnson & Johnson and Merck and IBM and Schlumberger and Exxon and these I don't think Exxon was in there, but that they were real companies, except they were radically overpriced. And that's what's going on today. And at the same time that the Nifty 50 peaked in the fourth quarter of 1972, again, commodities were just about as cheap as they are today relative to financial assets. And we're getting closer and closer to some event that's going to change the entire psychology between the hard asset class and the financial asset class. Back in 1970, One, it really started when Nixon took the U.S. off the Bretton Woods gold exchange standard, and gold rallied from basically $35 to $40 an ounce, all the way up to literally within in several months to over $100 an ounce, and then peaked in 1973 at about 160. And that big move in gold told you that something big was coming. And what was the big that it was referring to was the Arab oil embargo and oil price shock of the summer of 1973, September 1973. And that was what set off the inflationary spiral. That's what set off the massive shift of money away from financial assets into hard assets. And the commodity markets from 1972-73 never looked back. And gold finished the decade out at $850 an ounce, one of the, if not arguably the most widely held and popular asset class that was existence at the time.
Wow. So you feel like we got that teed up right now, like where gold's giving you that signal, and the rest of the commodity complex follows.
Yeah, I think that gold is telling you that something is happening, and the thing is, it's interesting that very few people are paying attention to what is happening in the gold market. And investors certainly not paying attention either. Obviously the gold broke out back in March and April of this year when it punched through the high 2000s 2100, and since then we've only seen a little return from Western investors buying physical gold through the physical gold ETFs. There has been an upturn, but it's nothing really substantial. It looks like it might have rolled over. And what's most fascinating to me is that the money that's flowing into gold-related equities still remains negative, even though the gold price is up almost 30 to 35% for this year. The open interest of the GDX gold ETF is down almost 20%, and it's still going down. So investors just the average investor, certainly the institutional investor, he wakes up every day, looks himself in the mirror, and says, "Oh, should I buy a little more Nvidia today? Should I buy a little Microsoft? Meta's pulled back a little bit here. Maybe I should be buying that." And with it, and they say, "Oh my God, I still have a little bit of those oil stocks left. I have still a little bit of those gold stocks left. Some idiot, I inherited them. I have to get rid of them," and they sell them. and that's what's going on to this day. Now that psychology is about to flip. Now, when it happens, I don't know. My gut feel it's going to be a black swan event that we can't even think about, just like the Arab oil embargo in September of 73 came out of nowhere. And oil, you woke up on I got the days wrong, but you went to bed on a Friday and oil was $3.75, and then 1 week later is $15. And can you imagine a shock happening like that to the system today? I mean, but that did happen. That did happen.
So, on that gold point, Leigh, and you guys wrote very eloquently on it. I feel like you were like, you were going through your historical notes when you were talking about the value of these miners, right? Like what's in the ground, and you guys have an interesting framework lens that you're thinking about gold equities as like a series of options. Maybe you could help flesh that out. I thought that was a really good analog for how an investor can think about a gold equity.
Yeah, it's interesting. There are a couple ways you can try to value gold stocks. I mean, obviously, the total market cap of ounces in the ground, approved reserves, things like that. Or the other way to do it is just say, what is a gold share, a share in a gold company? It's a call option on the gold price, and obviously is the gold price goes up, earnings will go up, and it's an option on that and you have a fixed strike price, which is the cost of your gold production, things like that. So you can actually, using Black-Scholes, you can actually try to put together a model that tries to say, okay, how are these options on the gold price through these gold equities being priced? And it turns out if you do that, they are being priced today as cheaply as they were back in the summer of 1999. Now, I'm sure that not many investors remember the summer of 1999 in the gold market, but it was the depths. Everyone was bearish. everyone was bearish, and the reason was because the European central banks were on this rampage to sell gold. And the thing is that there was absolutely no bulls out there whatsoever. And what's interesting, I'll tell you, I'll try to find you. Yeah, but there was one bull out there, and I think I've joked with you to this on this show
Who's that?
that
Who's
that
that?
yeah, this is important because this article, this is in Forbes
Wow,
magazine.
That's amazing.
That's fantastic. Golden 2,500 with Leigh right there.
Yeah, and this article came out in May of 2000 with gold at $275 an ounce. And the reporters were we talked about commodities in general in this Forbes profile. But the funny thing is that they said, well, like, what's your favorite commodity? I said, the most radically undervalued commodity out there today is gold because of all the European banks selling. It is going to be the best performing asset class the coming decade, I think. And they said, well, why would you be willing to put a price target on it? And I said, yeah, okay. I said, you guys, you're going to think this is absolutely crazy, but I think that gold, the price target this bull market will be 2,500, and they actually, that's what they actually printed in the
They
article.
went with the heading.
Yep,
There it goes.
with gold at 275. Now, how good a call was that? Well, in 2011, gold hit 1,900. So it didn't quite get the $2,500 price target, but the funny thing is it got awfully close. Now that price target wasn't plucked out of thin air. We try to model gold. We try to come up with these very, very um, interesting models to just try to see whether gold is underpriced or overpriced, or is it radically overpriced or radically underpriced? And of course, you want to be buying it when it's radically underpriced. And today, it's not as cheap in some metrics as it was back in the summer of 1999, but in other metrics, it's just as cheap. And if you were to use that same framework that I came up with, that $2,500 price target back in May of 2000 with gold at 275, you could come up with a price target today that's somewhere between 15 and 25,000.
What?
And
yeah.
yeah.
Wow.
Now, but just think of
year.
it. How radical was that? 275, gold had to go up tenfold in price to get there. So gold at 2000 today, can it go up tenfold again? It did back then. So the thing is, can it go again? Yes. In some measures, it's as cheap as it could be, and gold stocks are as cheap as they could be on some metrics as well. Some of them are not as cheap as they were in 99, but on the valuation, that option valuation, they are. Now, get this: if you had bought gold, if you had bought the Huey, the old Amex Gold Bug Index, which that's always been my preferred way because that goes all the way. That's an extension of the old Dow Jones Gold Stock Index that we have data going back into the 1920s. That if you had bought that in the summer of 1999, by 2011, that had went up 36-fold.
Wow.
And get this, by 2011, gold stocks had reached 2% of the S&P.
Wow.
Now, the funny thing, oil stocks today, total, Exxon, Chevron, and everything else, Schlumberger, they're only 3.8% of the S&P today. So, I mean, it just goes to show you how radically undervalued everything is, and where it could potentially go. So
like one thing, Leigh, like one thing that's interesting, right? Like it just feels like the gold equities it's just been so tough, like and everyone's just investing in the GDX, right? Like this GDX, right? But the gold, like it feels like investors are just resolute. I'll just own the GLD. Like maybe talk about like how gold equities have just lost their role in asset allocation relative, the GLD is kind of taking up this fulsome, component.
Well, it's funny, Thomas, that the GDX and the GLD are, like I said, the GLD is finally getting some inflow. So it looks like it's rolled over the last week or so after the Trump election and the strong dollar. But like the GDX is still being liquidated. So yes, if people do invest in gold, they're going to buy the GLD and the GDX and not the individual names. But it's funny. I think that will change. It's the bottom. What happens is that when various commodity markets and related commodity natural resource stocks go through these huge bear markets, narratives emerge at the bottom. And the narrative is, oh, there's some structural change that's taken place that will prevent for a new bull market in this commodity or in these stocks from ever happening again. And you see it over and over and over again. And the narrative now is that, the gold stocks, because of passive investing, GLDs, GDXs, that money's being taken away by the crypto markets and financial assets, these stocks will never recover and things like that. That's the narrative, and that's the explanation why no one has to think about buying them. But that'll change. That'll change. And what happens is maybe it'll require a $4,000 gold price, because what's going to happen is that at some point the earnings will become so great that capital will be forced in to buy the stocks to take advantage of their cheapness. And maybe 2,500 or 2,800 or wherever it is today is not enough, but it's going to happen. And there's going to be a price point where the earnings become so strong and the cheapness becomes so great that investors will be forced to buy them because they'll be what's outperforming. And
Yeah.
we're not there yet, but and we're still gripped by the narrative, the bearish narrative, but that will change. It always does.
Leigh, thank you. That is fantastic 101 on how GNR thinks about gold, and clearly nailing the call, and what's ahead of us. 10x. I wrote that down. 10x. We got a 10x here. And which is super exciting for gold investors and gold equity investors. Now pivoting to oil, GNR's done some great work on potential production exhaustion in key U.S. shale basins. Could you explain to our viewers why you think these fields are close to production? And then, as an auxiliary, what's enabled this continued record U.S. production? Why aren't we necessarily seeing that economic discipline among U.S. E&Ps? But maybe just kind of a big picture on when do we see shale get exhausted, and, why hasn't it happened just as yet?
Yeah. Well, what I should point out that is somebody who's lived through these periods before. I've always big believer that we're going to repeat the same things, and a number of going all the way back to 2017, 2018. I had a hunch that ultimately the shales, which remember between today and going back to 2010, over the last 14 years, the U.S. shales have been responsible for 90% of non-OPEC oil supply growth. And remember, the rest of the world, just other than some Canadian oil sands and biofuels, the rest of the non-OPEC world, conventional oil, is actually declined by about 200,000 barrels a day. So everything is related to what happens in the U.S. shales. And I said to Adam, and Adam is unbelievably mathematically inclined. And he said, I said to Adam, we have to understand the shales better than anyone. And so what Adam did is he built this neural network, which we today would call it a broad-based artificial intelligence system, that we put in all the data, and we tell the neural network, here's all the data, learn from it, and you become an expert on shales. And once you become an expert on the shales, we can ask you questions on what's happening in the shales. And it has done that. Now, you have to be very, very careful with all the neural networks that it doesn't overfit, comes up with spurious correlations, all these type of things. But, Adam has worked on it and refined it. We have great confidence that what it tells us is really correct. And what it tells us is that basically in all the shale plays, and remember, this applies not only to the U.S. oil shales, but the U.S. gas shales as well, that you have reached a milestone in every one of the shales, including the last one that's growing at the Permian, that you're basically have replaced, you have produced almost 50% of your recoverable reserves. Now, what are recoverable reserves? It's an interesting question, and it's a very hard question to answer, and most people don't even try. But our neural network, because the drilling data that comes out of the shales is so robust, because every shale operator has to report to the state regulatory energy agencies all their well their drilling and producing data. So we have great records of what's going on there. That our neural network, by analyzing all the data, and we have other ways we can cross-reference it to try to to triangulate whether it's right or not. It tells us that all the shale plays have produced over half their recovered reserves. And the thing is that now you can say, okay, that's a great theoretical thing, but the shales are still growing, right? Aren't they? And I would say, they're not. Like, does
Okay.
anyone ever go to the Energy Information Agency websites? And they have this excellent both in the oil and natural gas sections. They break down all the oil and gas shales by tight plays, and they estimate what the production data from all the shales, both oil and gas, are. Now, what does that data tell us? That tells us that the shales in both those plays, they've rolled over negative in natural gas, and they're finally gone to zero in oil shales. Now, that's one part of the EIA data. The 914 data, which is actually measured data, it's not estimated data. It's what the EIA tries to actually measure. They released their 914 data updated it to September. And what does it say? It says that U.S. natural gas production is now down 2.3 BCF year over year. Now, if you go back, the natural gas production, dry natural gas production in the U.S. is at the same level it was in the first quarter of 2023. So now it's over a year and a half, and you have had no growth in the U.S. gas shales. Like, why does everyone say they're growing? What they're doing is the reason why they're saying they're growing is because we've had two almost record warm winters back to back, and inventories have grown abnormally. And for people have gotten out of the whole weather adjustment thing of inventories. And the funny thing is that we would say that all that inventory growth is weather related. And the thing is that it gives you the luxury to pretend that the shales are still growing, and they're not. Now, it's so interesting. In the 914 data in the oil section, which incorporates all the oil shales plus the conventional oil, that has also gone, the growth year over year has gone to zero. And we have now U.S. oil production. Now, I don't know why everyone keeps saying it's growing. U.S. oil production now peaked in the fourth quarter of 2023. So now we're almost a year of flat growth. So the thing is that our neural network, what it tells us, is now being corroborated by the actual EIA data, of which everyone has decided to ignore. And so everyone, I guess some guy wrote me today, said, "Oh my God, the weekly numbers show an all-time high in oil production," and that's not 914 data. That's estimated. That's based upon EI guess of what happened last week.
Yeah.
And so
Yeah, I know once they go and it becomes real data, there can be some big changes, right?
yeah.
From the estimate.
So don't underestimate how important this is. Now, I'm going to give you an analogy, and there's a lot of your listeners probably remember this. First is that you go back to 2002 to 2003. What was oil back then? It was in the high 20s. What was it 5 years later in 2008? It went to 145. It went up five-fold in price. Now, why did that happen? Well, it's important why understanding the reasons for that happening, because it's going to happen again. Back throughout the 1990s, all the way to the early 2000s, 65 to 70% of non-OPEC oil supply growth came from just two fields. The North Sea, which is not a field, it's a region, it's a hydrocarbon basin, from the North Sea and the Cantarell field in Mexico. And the funny thing is that in 2002, everyone was radically bearish on oil prices, just like they're bearish today. And the funny thing is that I was going to show you a picture. There's an Economist magazine cover from I think it was May of 2003 that covers the end of the age of oil. No joke.
Yeah, I remember that cover very well.
Yeah, end of the age of oil. And the funny thing is that same business cover could be written today as far as psychology. But what happened? One thing happened, actually two things happened that broke the bearish narrative that no one understood. And what was interesting about that narrative is that here, I'm going to show you, but I'm going to show you in a second. There was somebody who understood it. But the narrative is broken because those two fields, the North Sea and the Cantarell field, both those fields in 2003, 2004, were in the process of peaking and rolling over.
Oh
And
my.
the fact is that no one knew that. No one knew that was happening, except there was one person that knew that was happening. And again, that person was me. And there we go.
Let's
Oh
go,
no, oil.
yeah.
Okay,
Oh,
at
and
least it's not oil 100 or something
yeah,
like that. I couldn't take it.
that was wow,
Yeah,
well done.
there
Oh, yeah.
I'm pumped. I'm pumped. I'm in the profile at Barron's magazine, and it's January of 2004. Oil is $33 a barrel, and I've talked about how we're going to see this rapid slowing in non-OPEC oil supply growth. The article says a natural resource maven sees a long-term bull market for oil. That was a great call at a time when everyone's bearish, and the radical, both the North Sea and Cantarell rolled over non-OPEC oil supply. The EI, I'm sorry, the IEA this time, every year overestimated non-OPEC oil supply growth by almost 1 million barrels a day. And the funny thing is that the I'm going to try to show you these charts here. That
Yeah,
Yep.
we have people in the chat saying you should be Prime Minister of Canada.
Yeah. But the top bars are what the IEA predicted every year for non-OPEC oil supply growth, and the dark bars are what actually happened. And you can see that from 2002 to 2008, the overestimation by the IEA every year got worse and worse and worse. And what happened is that China was growing strongly, non-OPEC oil supply is disappointing. OPEC gets market share there. We calculate their market share from 2003 to 2007 went up 3 percentage points. And the funny thing is they used that market share to gain pricing power, and that's exactly what they did. And so the thing is that we're in the same position today. The U.S. oil shales have now supplied 80% of non-OPEC oil supply growth, just like Cantarell and North Sea did back in the 1990s. And that supply growth is now coming to an end based upon all the analysis we've done. No one wants to accept us. We can't get anyone to agree with us. That's not true, but there are very, very few people that do. And this is going to come out of nowhere, just like it came out of nowhere in 2003 with that very, very, oh, here it is right here. I'm going to show you right now. I don't know if you can see it. The end of the age of oil. Oil was $30, and that was the summer of 2003. How do you like that? And the funny thing is that was the worst call of all.
Now, Leigh, you know that natural gas is like a pet project of mine, and you guys have done some of the best work on it. Just wanted to get your take on, global gas. You have this out of consensus view that global gas prices will converge in the not too distant future. Could you just share the thesis quickly, and then any recent data? Are you still bullish on all the LNG that's coming on in the U.S. and what that could mean for gas prices?
Yes, and we're still as bullish. And the reason, and I know this, we're Adam and I are beginning to sound like worn down clocks or whatever. And the reason why we've been talking about this for 2 years. The reason why it hasn't happened is because we have had two very, very North American warm winters back to back, and so that it's pushed it out. But everything, one of the things we like to do when we do all our research, trying to pick a bear market bottom, is we basically put together a roadmap that we have to travel down. And of course, that's important to do, because if you're bullish at the bottom and everyone is bearish, you can't go to anyone and say, "Am I right?" And they're going to say, "Absolutely right. You're an idiot. You're wrong." And so you have to gain a lot of confidence in yourself. And what you do is you put together this roadmap, which includes mile markers and road signs that tell you you're going in the right direction. And what's interesting about natural gas is that for the last 2 years, it's telling us we're going in the right direction, to the point now where production in natural gas, we believe, has turned negative. And it's been, like I said, it's been plateauing for close to 1.5 years now. That plateau has been hidden by the fact that we've had these warm winters, which has given us the luxury not to worry about it. And we're tightening the market. And you mentioned, Scott, about the LNG. Yes, there's it's got pushed out, as it always does, because of construction delays. But it looks like we're going to add another 6 Bs a day of export capacity in the U.S. Plus, we're going to add the big LNG, the LNG Canada, which is going to add 2.5 Bs a day by the summer of 2025 as well. That the LNG export story is still intact. the international price is basically $14.50 today. Here we are with the rally, we're $3.30. The reason why you have this dual pricing structure is that the U.S. natural gas market for the last 15 years has been in structural surplus, and that structural surplus is now ending, and it's dragged on because of these warm winters where it's obviously severely impinged on natural gas heating related demand, but the underlying factors are still there. LNG exports, the mechanism by which that conversion can take place are getting stronger and stronger every day. New LNG export capacity and no supply growth.
Leigh, that
That's
fantastic,
great.
fantastic overview. Now, one thing you always story very eloquently about, as countries, emerging markets move up the wealth curve, they demand better fuels, right? And surely natural gas is the next big step. So maybe just a twofold question, as we wrap up, but just your thinking, if I were to transport you out 10 years, you spent a lot of time in India, you've and throughout Asia, around the world. What do you think the energy mix looks like in 10 years from now? Do we see less coal? Is natural gas much more significant? Does nuclear, gain momentum in the West? Would love to get your kind of, I don't want to say blue sky, but what's your view on how the energy mix looks in 10 years from now? And what are the components of that pie that change dramatically?
Yeah, one of the interesting things we've over the last decade, we've taken a very, very different viewpoint on global natural gas demand. This is outside of North America, and it goes against the consensus modeling, which is basically promoted by a big London-based LNG consulting firm that basically, as far as I can tell, models global or especially emerging market natural gas demand is just a function of GDP growth. And our modeling is not based upon that at all. It's a function of two things. One is GDP growth, but second is the idea that as a country goes from poor to middle income to rich, you change your fuel consumption preferences. When you're poor, you burn a lot of coal because it's cheap. When you become a middle income country, you become much more, as your per capita GDP goes up, it affords you the luxury to actually go outside and look up at the sky and said, I don't feel comfortable looking at a brown sky every day, which is basically describes what China's been through the last 25 years. And so what you want to do is you say, well, I would really like if we could to basically stop damaging our environment. I want to live in a better world, environmental world. And of course, the way you do that is you burn natural gas instead of coal. Now, the problem with natural gas, it's more expensive. Coal is so cheap because you dump it on the ground. You don't even store it. You dump it on the ground and just feed it into a huge furnace and boil water with it. With natural gas, it's a gas. It has to be, if you don't have any indigenous supply, it's got to be compressed, liquefied, and then regasified and then stored and transported through pipes. It's much more expensive. But as you get richer, you decide you want to do that. I don't want to live in a polluted world. Every emerging market goes through this process. India is a classic example. They're poor right now, but they're going to be middle class, and so they've already signaled that they want to switch over to natural gas. They actually have goals of what natural gas will be, basically up threefold in the next 7 or 8 years, their consumption versus what's today. China has been going through this process now for the last 20 years. Back in 2000, they were per capita $2,000 per capita GDP, and now they're basically $13,000 per capita GDP. They're solidly middle income now, and their natural gas consumption preference change has switched tremendously, and it's going to switch even greater going forward. And this is happening all over the world. The developed world is structurally short natural gas. And that's why you see every time you have these big expansions, whether the Qatar huge expansion in the early 2000s, Australia's big expansion, 7 or 8 years ago, that same firm in London was running around saying, "Oh my God, we're going to break the oil price link. We're going to have this huge spot market develop where it's going to be priceless. LNG is going to be priced at the marginal cost of production, which is basically $1." Never happened. all gas came on and was just bought immediately at a 6-to-1 price link. And so that's just proof that the world is structurally short gas. So the big expansion that's announced in Qatar, the big expansion that's going to happen here in the US next year, it's all going to be absorbed because the world is structurally short. The world wants gas. Now, ultimately, the world will want to go nuclear, but nuclear is very expensive. And that's your final outcome. And of course, China's getting to the point now where they can begin to afford it. And they're building 50 reactors. India is now in the process of going through a big building campaign. And before we have to talk about, there's a massive structural change happening in the global nuclear power industry, which is not being recognized, but it's right in front of us. It's being played out. In fact, a big, huge announcement today was announced. And so nuclear power is going to become a bigger and bigger source of power. It's going to be natural gas and nuclear, and coal will get phased out. And that will solve a huge amount of the CO2 problem.
Yeah. There you go. You got the Leigh Goehring playbook, GNR. Leigh, a thank you from the Grizzle family, Scott, myself, Chris Wood. Thank you so much for being with us from day one for Commodity One-on-One.
All your partnership.
It's always a pleasure to have you as our lunch hour keynote. It's something we really look forward to. And
okay, thank you, Scott, Tom. Yeah, thank you for having me. And one plug for Goehring and Rozencwajg. I know there's a huge amount of people that follow our research and our letters and things like that. Our quarterly letter, which has been delayed because of our Investor Day in October, and Adam just had his third child, so he's been very, very busy. It's delayed. It's coming out in the next couple of days. And if you want to, there's a very in-depth analysis in there on Hubbard's peak and how it relates to both the oil and gas shales in North America today, which I think a lot of people find very interesting. And there's a lot of talk about nuclear power, and we're on, like I said, we are on the birth of a renaissance in nuclear power driven by SMRs and so small modular based reactors, which are going to be basically molten salt based, we believe. But it's a huge technological advancement that is going to bring all the benefits of nuclear power to a huge amount of people, and not just data centers.
We're looking forward to that. We love your quarterly letters. Everyone check those out.
Okay, great. Thank you guys so much for having me on. I really, really enjoyed it.
Leigh, thank you very much.
Okay, bye-bye.
Thank you. Guys, that's Leigh Goehring, Goehring and Rozencwajg. And for that quarterly letter, if you're on YouTube, the link is in the notes. And if you're on YouTube, hit that like, smash
and
that
also,
like.
I know the link, so I can tell it to you.
Yeah.
GoRozen.com with a Z.
There we go. Yeah, well, the show keeps on going.
Oh, so I'm excited. Yeah, we're moving on to lithium. It's one of the most interesting commodities right now because it's had some big swings lately. And so the question everyone's asking, is the bottom in? We're going to talk to an industry leader in the lithium market right now. All right, everyone, welcome back to Commodity One-on-One. Train never stops rolling. So we have Rob Weir. He's VP of Corporate Development from Lithium Royalty Corp. We're going to bring him up. Rob, what's up, brother?
Rob, how's it going, man? What's the word?
Not as good as you guys, but hanging in there.
We're amping you up for lithium.
Oh,
okay,
man.
well, it's good.
I was going to bust out the Indian leprechaun for you.
Save that
Rob,
for happy hour.
the Indian was that a jig? And didn't I put the jig down on that?
You did at Kelly's Landing or something down after a Jays game. I did see that.
Yeah, after a Jays game. But oh man, Rob, a pleasure to have you on Lithium Royalty Corp. For those who don't know, the royalty model is the superior model, and has been shown so in in mining, and to just obviously, Rob, Scott, you want to kick it off?
Yeah. So, Rob, wanted to start with your current views on the lithium market. Is the supply-demand imbalance in the process of correcting, and do you have a view on what a sustainable price is for lithium?
We do. I think the best way to describe the lithium market is that it's healing. We've had a pretty difficult market for the past 24 months. I think a lot of that was just giving back some sort of outsized gains we had coming out of the pandemic. Those prices incentivized some marginal assets to come into the marketplace, and that's really conspired to take us down 85% from our high. So, we've been through this before. We see these sort of 2-year cycles, and we think we're very close to the end of this one. EV demand is continuing to grow globally, although it does move around. Battery storage is becoming a real factor, and we're seeing a lot of really intelligent M&A, sophisticated investors that are positioning themselves for the next 20 years. And I think a sustainable price is basically double where it is today. The hard rock price is sort of around $800, and we think the long-term price you need to build out these hundreds of mines we're going to need is closer to $1,400.
Mm-hmm. Okay, that's great. Great color there. Now, the prior chart highlighted some recent supply cuts by producers due to low prices. Are you seeing the cadence of supply cuts pick up, or has there kind of been like a steady plateau? What are you seeing in the market?
Yeah, you've seen a pretty steady drumbeat of assets going into care and maintenance. The economics just don't support continuing the sustaining CapEx and the other items you have to spend to keep these things up and running. So we think we've seen between 150 and 200,000 tons of assets either going into care and maintenance or earmarked for care and maintenance. And that's in the context of a 1.2, 1.3 million ton market. So Chinese lepidolite's probably down 45, 50% since June. You've seen the producers in Zimbabwe collectively ask for royalty relief and subsidized power. And as you guys well know, those are things you don't ask for when things are going well. So supply is absolutely being curtailed, and it's going to really pay dividends here in the next 6 to 18 months.
Yeah, so for anyone who is not a long-term commodity investor, you know that when capacity is being taken out of the market, it means that the market is righting the imbalance, and it generally means the worst is behind the market. And so that's what we're seeing in lithium. Now, Rob, let's move to the demand side. Now, everyone, last few years during COVID was electric vehicles, they're going to change everything. Is that still the long-term demand driver? Or are there other sources of demand you think could surprise? Yeah, great point.
Yeah, I think electric vehicles and battery storage. Battery storage is now 15% of the market. And that's something no one was talking about even 12 months ago. So BYD is a great example. It's becoming more mainstream in the developed world. They sold 500,000 NEVs in November, and the year ago number was closer to 300,000. So demand is continuing to grow. Rio Tinto thinks it grows at 10% a year through 2040. So as these mines come off and that demand keeps building, you start to get into deficits pretty quickly.
Rob, I don't know if you heard this, but BYD has like a Cybertruck knockoff. Apparently, it's being sold in Australia. It gets 1,000 miles in a charge, and it starts at $40,000 or something like that. That's wild.
Yeah.
All right. So let's talk about lithium royalty a little bit. So you guys have 35
and domestic OEMs in Canada's.
Sorry.
Fuck, you just lost me.
No. We got you, Rob. You're there.
You're still here. As long as you can hear us.
Sorry. My screen went dark. So.
Oh, that's we. You know what? Just look at the camera. We can still see you. It must be your camera, but we can still see you, and you're still live. Don't worry.
Rob, stay with us.
You got it. You got this.
Here, so if you can hear me, that's all you need, though. So yeah. I want to talk a little bit about your royalties. You guys are spread all over the world. Now, I'm curious, was there an overall strategy at the beginning, specific regions, types of mines, or do you simply go asset by asset? You're just basically picking the best ones you can find. How do you approach it?
Yeah, there was 100% a dedicated strategy. It was essentially to look for high grade hard rock assets in safe jurisdictions with low technical complexity, and we've largely done that. We bought 29 of them when we were private, and we've since grown it to 35 as a public entity. So we like to say the ABCs of hard rock: Australia, Brazil, and Canada. We've avoided what we think are higher risk areas: Mexico, Bolivia, Africa. Doesn't mean there's not good assets there. We just think we have better chances of succeeding in the developed markets we're operating in. The one area in South America I think we were really early and right on was Brazil, and it's really emerging as a low-cost geography. And we have one asset going through a fully funded phase 2 expansion, and there's another of other companies that are in the midst of permitting and building their assets. So yeah, that's our business plan, and we're going to stick to it.
Great. Now, let me see what I have here. So what's the team's investment criteria for signing a royalty? Like, what are the boxes that the asset needs to tick for you guys?
I think because we have a pretty deep technical team, we can project out what these projects are going to look like before all the information's sort of well understood. But I think high grade is number one. We have a number of assets in Quebec that were very modest in size that are at or above 100 million tons today. And in a bear market, those things don't get much attributable value, but when things turn, which they always do, there's a lot of embedded value there. So I think high grade, a place where you can get permitted, albeit checking all the boxes. So Brazil is a great example. Atlas and their Das Lithium project got permitted in 14 months. So grade, size, and ability to operate, I think, are very important.
Excellent. Now, I know in royalties, having proprietary deal flow and just a view on the commodities and the projects is important. So you highlight in your deck, you have proprietary deal flow and sector-leading IP. Can you expand on how you were able to build these competitive advantages?
Yeah, I think first and foremost, there's a very well understood institutional body of work around the royalty model. And Blair Levinsky and Ernie Ortiz, two of our founders, basically decided to take those best practices and apply it to the lithium world. In addition to that, we've populated our board and our technical team with people that have been in the industry for 3 decades at Albemarle, who are QPs under 43101. Some individuals that have built 5-6 spodumene mines. So I think looking at a company when it's $100 million market cap, it's pre-resource, is pretty daunting from a public markets perspective. But their ability to be geological engineers and have that process to understand what these things could be. So Sigma Lithium, which is pretty well known, it was a $105 million market cap. We bought a $7 million royalty in 2018. They're now on to phase 2, fully funded, and their market cap's about 2.2 billion. So we think we have a number of Sigmas in our portfolio, and that technical team is essential into accumulating those assets.
That's amazing. Now I wanted to move on to your shareholder base. You have 2 major shareholders with more than 80% of the outstanding stock. Can you just help us understand the history of your relationship and what you believe their objectives are for their ownership?
Yeah, that's a good question. Their objectives are to compound capital without question. Riverstone owns 27% of this. They invested into LRC as a private company. The balance of the Waratah capital position are LPs, family offices, high net worth, that bought the predecessor vehicle to LRC called Royalty Capital Partners. So there's 3.5 years left on that mandate. They're very patient. They see the demand compounding and growing each year. So they're, at the end of the day, we're going to want to have more shares in our float cap. But for the time being, they're extremely supportive and extremely patient as this industry builds itself out.
That's excellent. Now, maybe to end things off, could you just walk us through the most important catalysts for lithium royalty in the short or medium term?
Yeah, sure. That's a new slide we've had some good feedback on. There's 3 assets in South America. Mariana, operated by Ganfeng. It'll be producing this year. Tres Quebradas, which is operated by Zijin. We've got $41 million invested in that project, and Both those companies are through the majority of their capex and will be producing at some point this year. Atlas Lithium owns the Das Neves project. They've been equity financed by Mitsui and then a number of Chinese conversion companies. We put $20 million into that project last March. They're building their DMS plant in South Africa, and they're going to ship it into Brazil. They'll be producing this year. And then probably my favorite one on the sheet here is Adina. It's operated by Winsome Resources, and they've done something very innovative. And these bear markets create these opportunities, and they're going to buy the Renard mine and related infrastructure out of bankruptcy. Stornoway had unfortunately gone bankrupt twice, spent $900 million Canadian, and they have an option agreement to buy that for $50-odd million in cash or shares. They just put out their PEA and scoping study, and in those documents, you'll see that the cash flow is attributable to us over the 17-year mine life for $300 million US. So very small company, but it's a very large and very readily buildable asset. And so those are the 4 projects that are going to really drive our income statement over the course of 25 and beyond.
I love those slides. I see more and more of those. They're very helpful.
Rob, you know,
Great.
I was pulling up a chart and you know, just looking at the analog, and maybe I just, you know, kind of as we wrap up, what are your thoughts on lithium? You know, obviously we saw the peak. We're here. It feels like we've completely bottomed out. Like, thinking about an analog as iron ore, right? Is that a fair way to look at it? Like, you know, because we saw the similar thing happen to iron ore. Like, it really kind of, you know, overproduction. A tightness, overproduction come back, and we're back up. Like, is lithium kind of set up that way as well? Like, where a lot of that marginal stuff is going to go off?
I'm not an iron ore expert, but I know I'm familiar with the analogy you're referencing, and I do think some of the when you go to $80,000 a ton and $8,000 on hard rock, it just incentivizes higher cost assets to enter the market. When the prices have come off 85 or 90%, the economics just don't support those projects continuing. So I do think you're going to see these cycle off over time, and you're continuing to see demand. And Rio has a great deck on their Arcadium acquisition, and they think lithium's a cornerstone material. And I think their minimum compounded annual growth rate is 10% a year. And so you can do the math off 1.2 million tons at 10% a year. You get to 2 or 3 million tons in pretty short order.
Yeah, the important thing I think about is, you know, at 80,000, maybe some people are thinking of replacing lithium in a battery, but at 8,000, they're not thinking that. They're thinking about how can we get more lithium into a battery. So it actually supercharges demand to some extent. So that's one thing that's to be taken into account.
It's the one thing that, you know, I keep thinking about it in terms of commodity, that not too hot, not too cold. You want a industry that's producing a commodity at an excessive return on invested capital, that's not too high to bring in new entrants, and you just kind of milk that, and it just, you know, becomes a great revenue stream. It feels like copper is there now, and it feels like lithium is on the doorstep of that. And both those metals are important for the future. Rob, thank you very much, man.
Yeah, thank you, Rob.
I really appreciate you coming through, and we'll PDAC. We'll see you at PDAC. You got to come through to the Grizzle HQ. We're doing a fireside chat, not just any kind of fireside, not phony fireside, real fireside, a real fire.
You can get burned if you're not careful.
I load that up.
That
fire is real, and it's cold outside.
I will 100% be there, and I appreciate you guys having us on.
Oh, thank you very much, Rob.
Thanks a lot. That was Rob Weir, Lithium Royalty Corp. Thank you. All right, everyone, Commodity One-on-One. Hope you're having fun. We might be having too much fun, but we're excited to get to more guests and cover more commodities. We're going to take a quick break.
No, I think we can go right to Christian if we got that teed up. Christian Easterday, hot chili.
Let's do it. All right, everyone. Welcome back to Commodity One-on-One. We hope you've been learning a ton. We have been, as usual. We have more great guests coming up, so we're excited to talk to Christian Easterday. He's the CEO of Hot Chili. They're developing one of the largest copper projects not owned by a major. So let's bring up Christian. Christian, welcome to Commodity One-on-One. How are you, sir?
Yeah, very well over here in Australia, getting warm. How are things over there?
Very good.
A little chilly, but we'll deal with it. Now, Christian, we have a lot to talk about, so let's get right into it. Now, I wanted to start with some big picture stuff because you travel over the world. You've been in the copper industry a long time. You're a big picture thinker. S&P just released a copper report that showed the average new project took 17 years from discovery to first production, and that compares to 13 years back in the mid-2000s. Can you just help us understand the major driver or drivers of elongated development cycles nowadays?
Yeah, no, great research from S&P, and it's something that we've been seeing for a long time. Mines are getting harder to build, and they're taking a lot more time. This is really about internal factors and external factors, the things that you have little control on. The regulatory side is one of the key drivers for those timeframes. If you take just the securing of water assets in the Atacama for Hot Chili, for our large project that we're developing, that took 10 years. And we're actually still through that permitting process to add another water concession. So probably a 12, 13-year process. So those are the kind of external factors. Obviously, commodity price, bringing projects on at the right time in the right funding environment is really at the forefront of most CEOs' mindsets. But then there's also the internal factors. Most of these copper projects are skewed to the right. The copper sector is a bulk commodity sector. They're large drill outs, and this is about availability to capital.
Now, just wanted to start at a high level on Hot Chili. For people who are watching that don't know your company, can you just take us through the long-term vision and how your recent acquisitions and drilling will help you get there?
Yeah, sure. Look, we have 1 billion tons of resource base put together on the coastline of Chile. It's a very different project to the very few peers that sit in this space. I think there's only 5 of us that have projects capable of 100,000 tons per annum of fine copper production outside of the majors. So look, we're in a pretty exclusive club, but we're certainly the only one that sits down on the coastline in the middle of infrastructure at low elevation. So that's firstly a key differentiator. We've been investing in this project for a good part of 14 years. Doing all the necessary early permitting work. And what we're really trying to establish is a project that will sustain a 20 to 30 year mine life and probably at elevated production levels to what we put out on that PEA about 18 months ago. We're about to put out a pre-feasibility on this project. We're also pushing down the throttle on some exciting growth at the moment and really trying to plot a pathway forward to double this project and really establish ourselves within the tier 1 space of the copper sector.
Great. Yeah, you got a lot of exciting things going on. Now, we know how important access to funding is for an explorer. You guys are lucky enough you haven't had trouble raising the cash you need to push the project forward. Have your major shareholders played an important part in your ability to keep raising money, would you say? Or is it just like your grassroots getting the word out and the asset itself?
Yeah, look, and that it's always been a strength of Hot Chili. We've had fantastic major shareholders that have supported us through a very long journey. We started this company in the last cycle. Unfortunately, not the best of timing getting a discovery as copper's coming off of its highs. But those large shareholders incubated and protected the company so we could hold the asset, reinvent ourselves, quadruple the resource base, and be positioned where we are now. As one of very few projects that's capable of this scale production coming into the end of the decade. So Glencore is our largest shareholder, contributor in the last raising. Our former chairman, Murray Black, and his group, which I'm associated with, have continued to support the company. And that's been a real key strength of Hot Chili. But now as we get very meaningful, we're into the pointy end. Institutional support has been very strong since our dual listing about 3 years ago. And now that's opening up to options as we start to advance project financing in the next couple of years following our bankable studies. So yes, financing is absolutely key in this commodity space for a junior to be able to succeed and get as far as Hot Chili has. Not many make it.
Great. Thank you for that color. Now I want to move on to your resource. So you have more than 4.3 million copper equivalent tons currently. You've grown that a lot. You were at a much smaller number a few years ago. Just wondering, what's the resource number you want to see to ultimately develop the Costa Fuego project? I know you've mentioned you're looking at upping the production amount, the size of the project. Would you like to see bigger resource numbers? Are these numbers enough to keep going the way they are? What's your feeling right now where you are?
Yeah, absolutely. 1 billion tons are put together at the moment, 85% indicated. So the hard work's been done in terms of the expenditure in ground, and that's supporting a mine plan which is moving towards 20 years at around 100,000 tons of fine copper and 50,000 ounces of gold. That, for us, is a stage one project. It's something that we can commit our timelines to deliver that finance investment decision in the back end of 26, possibly early 27, and get this project into production, into construction. So that is what we're committing on. But what we are doing is layering on a new level of growth. We are hoping to take this project towards 150,000 tonne per annum scale and build that mine life towards 30 years. But we're not letting any success on that front and any parallel investment change those timeframes. So any growth that we see, expansion of capacity or expansion of mine life, that will be coming in similar to what the guys at Teck are doing with Quebrada Blanca. They had a QB1 and now they're moving to a QB2 upgrade. We're taking a very similar approach. We'll have a Costa Fuego 1. That's what we're committing to at the moment, so we can get exposure to copper price in the latter part of this decade. That's where we see big things happening with the copper price and therefore our leverage formula. And any growth that gives us further exposure will be taken on as a Costa Fuego 2 development and upgrade.
I like that. So you're pushing hard towards a certain date, so you have cash flow coming, but it just depends on how big the project's going to be ultimately.
Exactly, and that may well give us a very, very nice tailwind to be able to scale this up in the early parts of the 2030s. But certainly, what we don't want to do is see any of our final permit application for an environmental impact assessment that'll be submitted mid next year. We don't want to see any delay to that. Once that goes in, it sets our time clock, and we're on a pathway to project financing. So then it's all about how we skin that cat, and that is the probably not the $1 million question. That's the $1 billion question. And so, key growth drivers around our water business and how we monetize that asset to effectively fund this copper project. That is probably the biggest differentiator that the company is now possessing.
And maybe, and just on that, I would love for you to expand on that water asset. But this is something that's not talked about in the mining world, right? And it just the importance of water, and maybe just helping our audience understand how you can monetize and the value around it.
Even having these rights, It's not like every project has water rights.
No. And if you're lucky enough and you're in the world's largest copper producing country in Chile, and most of that country, that copper production comes from the Atacama. And over the last decade, we've moved from, water stress to now, a situation which dictates that no new mining developments or existing mining developments are all moving to water extraction from the sea. And in most cases, about 75% of projects will require to desalinate that water to be able to process. We're in the lucky basket where our ore bodies produce better copper recoveries just using saltwater processing. So that's a fantastic situation to be. Fantastic that the company made that decision over 12 years ago to apply for its own maritime concession. But we find ourselves in quite a unique area of Chile. We're in the Huasco Valley, where we don't have large mines around us that 20, 30, 40 years ago secured their maritime concessions, and we have multiple water distribution networks in this area. We're in fact the holder of the only maritime concession. 10, 12-year lead time to secure a maritime concession. So we can supply water to ourselves in hopefully 2028 on a seawater supply basis, but we also potentially can supply desalinated water to this entire region, which is hosting 6 major undeveloped copper projects. Our partners, CMP, largest iron ore producer of Chile in the area, needing further desalinated water supply. So we're in this very, very unique situation where everyone needs our water to be able to develop their projects unless they want to wait 12 years and make their applications now. So that puts us in the box seat to be able to consider, things that are going on in Chile. Maybe the world's not watching this closely enough, but a lot of big projects are outsourcing their water supply. Most people don't know that BHP operates its Spence operation, one of their major copper producing business units in Chile, and they don't actually supply their own water. That's supplied by a third party to BHP, and that is continuing. Chile, Antofagasta, as I've mentioned a few times, recently sold their water rights to their Centinela operation for $600 million US, and that allowed them to reduce the capital required for their upgrade by close to $400 million. So Hot Chili is very much not inventing this or setting a precedent. We're just following what the industry is doing. These water rights are so critical to be able to actually build a project now in the Atacama, but most importantly, they offer us the ability to drive what is one of the lowest capital intensity projects in the development pipeline even lower. We can pull out about another $150 million of capital outside of the $1 billion that we were requiring to build this. And most importantly, we have a lineup out the door of major tier 1 water investors that are looking for exactly these type of projects to be able to purchase, to be able to finance, and to be able to build and then supply water on long-term contracts. What's really, really unique here is that we are actually the offtake partner ourselves. So we control the ability to be able to monetize this because we hold a 20-year offtake agreement that we will require for Costa Fuego. And that's pretty powerful. I don't think the market really understands what we're about to do. And so I imagine the monetization of this asset will add immediate accretive value to the company. Probably
like it will be a surprise.
Well, yeah, you're getting a 2-for-1, right? In HCH shares, right? And you know what? So
Correct.
I was going to send you. So there's a BlackRock water ETF, and their top holding is like a hotel company. I'm like, put Hot Chili in there. They've got a hotel company, and who knows how that gets in there. But it's the BlackRock water ETF. I'm like, put in Hot Chili. That's a real water
you got to
pitch
the PM there.
We're gonna that I thought that's the first place we go with this. I'm like,
yeah. Look, I mean, there are a lot of options that are available to Hot Chili, and discussions around royalties on their water supply. There's a huge amount of discussions going on with all of the parties that are in the Wasco Valley that are now very, very aware of what we're holding. It's of huge interest to all of them, particularly around their development timelines and what that might provide for them for early development optionality. But most importantly, we've been surprised with the customers that are coming out of the valley itself, from the communities to the government to the local community groups that we're dealing with, as well as agro-industrial players in the valley. So, this is looking like a potential enabler for a dramatic investment push in the Wasco region. And if you were up in the Copiapó region and you were Hayden Black sitting there with Marimaca, another fantastic copper developer in our space, he's up there and he's blessed with the fact that the Copiapó Valley has a number of major mines. And so it has a number of water distribution networks that are available, that are being shared between projects. So projects like that, they also probably need to thank their lucky stars where they found their assets. But for a greenfield project in an area that has very few operating mines and no water licenses established, we're a first mover in this area, and it's exposed us not just to the copper business, but to the global water business. And that's really unique now in our story.
Yeah, well, hopefully it's less of a surprise now after Commodity One-on-One.
That's right. Yeah.
But now, Christian, you have a lot of stuff going on. You're a busy guy. There's a lot of stuff going on at Costa Fuego. Could you just help kind of crystallize what the upcoming catalysts are and which you think are the most important that investors should be watching for?
Yeah, look, we're getting really close now to our key catalyst delivery. 2 pre-feasibilities that have been brought into parallel now. We delayed one slightly, we pulled one forward slightly, and we're looking to deliver those both into Q1 next year. So going into the end of the year, that's pretty exciting. Our teams across both of those studies, and we also have a contribution on a port study going on also with our partners at Porto Los Lozos. But all of those studies are pushing pretty hard into the end of the year. A lot of the gloss will be put on all of those things as they're prepared and go through their final stages of risk assessment. But, we're pushing towards those key catalyst deliveries in Q1, which then leads on to the submission of our EIA mid-year. But in terms of driving alpha for the stock, because certainly the copper price environment, as you guys said rightfully, while we're in a good copper price environment, we're not seeing those lofty heights of $5.20 a pound that briefly were exposed earlier in the year when we had a short squeeze on copper. But what we are seeing is sort of depressed equity market conditions. At the same time, Hot Chili was really pushing through a lot of the hard work, the part of the Lassonde curve that no one really wants to be trapped in, and you often find that companies will try to offset that by introducing exciting news flow or alpha, what they say. And so that's what we've been waiting very patiently on our consolidation efforts to be able to secure. So we brought in La Verde. It's a fantastic piece of the puzzle. We've been waiting, and we've been developing a relationship over 6 years with the private owners of that lease. It was never previously held outside of that family. Hud Bay, in fact, surrounded that area, had drilled some holes around it. We're very excited about it, but they just couldn't get their hands on the center of what is a porphyry footprint that's equivalent to the size of Cuerpo 3, our largest porphyry at our cornerstone asset, Cortadera, 30 kilometers to the north. That's a porphyry that delivered 500 million tons for the company. So we've finally got our hands on it. We've got our hands on all of the land around it. It's taken us a long time. We've got drill rigs turning. We really like what we saw coming up in the initial drilling, and those drill rigs. That drill rig hasn't stopped. We'll be drilling all the way through to Christmas. Hell, we may even continue that drilling. But at the moment, we're about to, unveil our new growth asset, and that's very much about plotting our pathway from 1 billion ton towards 2 billion ton. We're not finished on the consolidation efforts. As you know, 30 kilometers to the south of where we plan to centrally process is our big push. It's the Dameco Porphyry District, and there are multiple high-grade historical mines that have been privately owned, exploited for copper oxides, and never touched for their sulfide potential. That's very exciting for us, and we really see this entire district hosting a 2 billion ton copper hub, and that's something that is very exciting, and that news flow will start to filter into the market very shortly. We started drilling about a month ago, so I imagine those first assays are not very far off at all.
Perfect, Christian. A lot of catalyst rich and exciting copper development, and you get a water play in there. You get the 2-for-1. Christian, thank you so much as always. That's Hot Chili Copper, one of the premier copper stories. Christian, thank you.
Thank you. All right, everyone. Commodity One-on-One keeps on rolling. Don't go anywhere. We'll have more great guests. Welcome back, Commodity One and everyone. We're live. We're hoping having fun. We're having a great time. So coming up next, we have the CEO, Taj Singh of First Nordic Metals. They're a very interesting gold play out of the normal places you would look that you hear about often. So that's why we wanted to bring them on. So let's cue up Taj. All right. Taj, welcome to Commodity One-on-One. How are you?
Taj, how are you?
How are you guys? Good to see you.
Last time I saw you, we were drinking at a restaurant. I think we shut down the restaurant.
Having some great fish. That seafood was amazing.
Yes, it was good. That was like a big bass. It was beautiful. That was Taj. Always great seeing you.
Yeah, good to see you too, guys. Great. Yeah.
Taj, let's kick into it. So in a previous conversation, you said a clear long-term strategy was critical for mining companies to gain the trust of investors, and you laid it out very well. For anyone listening who isn't familiar with First Nordic, can you briefly lay out your current strategy and your long-term goals?
Yeah, I kind of the idea, the philosophy, the way I operate is kind of like, you've got a story, you lay out your 3-month plan, your 1-year plan, 6-month, 1-year, 3-year plan. And as you deliver on the 3 and as you deliver on the 6 and the 1, people start going, everything they're saying they're delivering on. So I think it's important to clearly articulate a really good business plan that makes sense to investors and just keep hitting and hitting and hitting it. And so for First Nordic, it's coming more into focus. Every month we move forward, it's coming more into focus. We're focused on the Nordics. Sweden and Finland particularly, we think that they're kind of the last frontier for gold exploration, one of the last kind of untapped frontiers for gold exploration. That's big scale. We think they're 70, 80 years behind the Abitibi in Ontario and Quebec, which means they have huge potential. Again, that just needs to be worked on, and modern systematic exploration needs to be applied to it. And then it's just a great place to work. It's a tier 1 jurisdiction, amazing low cost power. People know how to mine, long legacy of mining. So our focus is to basically, we've got 2 large land packages, one in Sweden, one in Finland. Our plan is to build 1, if not 2, of the next gold camps of Europe.
Amazing. Now you mentioned quickly, why Sweden and Finland. Could maybe just expand on that a little bit, maybe from like a geologic perspective, operational, if there's anything political you'd want to mention. And I'll throw up that great chart you guys have. I think it's comparing the Abitibi to the line belt where you are.
Yeah, I touched on it in the first question, guys, but like to go a little bit more in detail, security of tenure is huge. And right now, honestly, the things that are going on in the government, we were there a couple of weeks ago meeting with high-ranking government officials, extreme kind of support here for mining and for business generally in Sweden. I think they're following Finland's kind of move on things, and Finland has become a hotbed for M&A in the mining sector, and it's still getting a lot of attention. Sweden's catching up very quickly. They know what's going on. Taxes are extremely low. I'm talking 20% corporate tax rates when you do get into production. All types of incentives to move projects toward production as well. And again, geologically, I noted it before, but yeah, these are the same rocks generally that you're seeing in other greenstone belts in the world. And the one that it's most likened to is the Abitibi, as I mentioned. And I think that slide you're talking about shows about 100-kilometer strike, which is what we have in Sweden, for example, 100-kilometer strike of this gold line belt. And in the Abitibi, you'd have 12 companies on it and 8 operating mines and 100 million ounces of production plus, and probably another 50 sitting there of resources. So these deposits go deep, kilometers easy. Usually it's 2 kilometers plus. And they're just good. They're mines that majors love eventually. Like they'll go on for decades.
That's great. That's very helpful. Now, the Barnsley project is a JV between you and the mining giant Agnico Eagle. They're one of the best. Can you help us understand what their plans are for drilling and development? Do you have any feel for when a pre-feasibility study would make sense from their point of view? I know they can earn in more on the project if they do that. Do they need to hit a certain resource number? Like, what do you think their thinking is at this point?
Yeah, we interact with Agnico very regularly on the Barsley project. So a lot of these plans, etc., we're working on them together mostly. And right now, it's like you already have a 2.5 million ounce resource. And if you look at comparable deposits that have been put into production, these deep underground greenstone belt deposits, that's kind of the number where you take it towards production, because you know it's just going to keep going, right? So you'll drill out the rest of the stuff of resources as you drill, as you are sort of gain production. But I think what the plan is right now, and has been for the past couple of years, it's slowed down, but they're looking more regionally. It's a huge land package just at Barsley, 25,000 hectares. They have there's a hypothesis there that there's some very high grade gold-rich base metal deposits, VMS style deposits, which Agnico loves, in the north, because they actually connect to another belt that Boliden, a mining giant of Europe, their base metal company, that's that style of deposit. So I think there's been some work done there that there's something going on here, and kind of regional to the resource a little bit to see if there's extensions of the resource has been done in the past couple of years. That's kind of been the strategy, but not really on the resource. I think what probably makes sense now is gold's moving up, and this is obviously in our opinion a mine. This will be a mine, is to put some deep holes in and show this has the potential to go well past a kilometer, which could in theory take the deposit to over 5 million ounces, as long as the mineralized zones can continue. I think that's the way forward, and there hasn't even been a PEA yet, guys, on this. So you could probably go PEA first and then PFS, right? You want to show some value. So all of these things are kind of a work in progress, and we're trying to figure things out. And we're actively, involved in kind of a lot of these decisions and discussions with Agnico.
Great. Now, exploration in the Nordics, it works similarly to the Abitibi Greenstone Belt of Canada due to glacial till, but not everyone might know what that is or how it works. Could you just explain what glacial till is and how you have to modify a typical exploration strategy to deal with it?
Yeah, glacial till really is kind of like gravel / hardened soil sitting on top of the bedrock. And obviously in this part of the world, you're going to have it. In northern Canada, you have it as well. And you kind of, it helps you in till sampling when you till sample, but that stuff has been transported for sure, but allows you to vector towards the source. And it's actually quite easy to start your sampling that way. But the next step of that, which you might not need to do if your bedrock was outcropping, is you need to do base of till drilling. So that's the extra step. It's relatively low cost extra step, but you're using basically a percussion drill, really cheap holes, $1,000 a hole, to put 100 or so holes into a target on a grid. And that's actually testing the bedrock. So it's a drill, but it's effectively a method of sampling. So that's an extra step you need to do. You need to also be pretty, make good use of the geophysics, right, in the area. But it's a proven method they've been using for 50 plus years, whether it's B2 Gold, Kinross, Agnico, all the stuff that's in North Canada where Agnico also is. It's a proven method, and it works. And to be honest, in a lot of kind of desert climates, Mexico, Australia, they use these percussion drills to help them cut costs down on their diamond drilling, because they'll kind of refine their drilling by using this cheap drilling to go, oh, wait a minute, this is probably the best area. So a lot of places are using it, and it's something that's been used in the Nordics extensively, and really is a helpful tool. Rupert used it very effectively to build out their deposit, and we're kind of following that model, as well as the model that Agnico used to, well, we kind of discovered Barsley. Agnico used it to continue to grow Barsley, but tried, tested method, and not too far off of what you're seeing in Canada, actually.
Yeah, that's a great explanation. I just wanted for everyone to understand, some of the nuances of where you're operating, and, Canada's the same, obviously. Now, some big news from you guys. You just raised $11.5 million for further exploration. So
cashed up. Taj is cashed up.
Must be a good feeling.
The bank is full.
Gold chains with a dollar sign.
There you go.
You got to show up like that next for the next conference. Right? We're accepting nothing less.
We are a gold company, man.
That's right. As long as it's not Bitcoin on the medallion, right?
No chance.
Only gold. Now, I'm sure everyone's interested. So how do you plan to spread that money out among your opportunities, if at all? And where do you want to be once the money's spent?
So we're gonna, as you know, Barcelona is fully carried by Agnico. I just wanted to reiterate that. So they spend all the money. They have spent all the money. It's upwards of 60 mil now US over the past 5-6 years. But on the other projects, remember, we own basically 40, 50 kilometers of strike on the same belt that hosts Barcelona to the north, and 40 kilometers, 50 kilometers to the south. All kind of basically untested. There's several sniffs. A few deposits have already been found, but we own basically the whole belt. That hasn't been tested. So that our focus for this money is now, let's go find some more Barcelonas. That's it. We've always said it. Now we can do it. We've done all the groundwork needed to do it. So right now we have 4 drill ready targets, guys. Like we're just finalizing the base of till drilling I talked about, that percussion drilling. We've already done it on one of the properties on Klippen. We're expecting results soon. We moved on to a second property, the Nippes target, which is in the north of Barcelona. Then we'll do it on the southern properties, which is Aida, which already was a discovery on by Goldline, one of the predecessor companies of First Nordic, as well as Harpsund, which is a little north of that. So 4 huge multi-kilometric targets. All the layers of information are showing that there's a high probability for gold, and we just got to test it. Those are ready to go. So those funds are going to be used for diamond drilling those projects on the gold line belt. And we're aiming for, say, about 30,000 meters, and we'll probably still have at least $3-4 million left that we can use if we wanted to advance something even further or move it into 2026. But we're in a really good position to really drill test these targets, and that's what it's going to be allocated for. So $6-7 million out of that money will be used for this 30,000 meter drill program, making it one of the largest drill programs in Europe. Mic drop. So we're really excited.
So when are you? I know I'm going to ask you a question about your milestones, but when are you estimating that program will run through?
So this base of till drilling will take us up until Feb or so, and those are all going to give results, right? You're going to start going, okay, wait a minute, there seems like there's something here. We also actually have some geophysics and sampling we did kind of in the summer, fall. That's going to come out. That's all going to be like, okay, this target looks extremely interesting. Right. So, and then the diamond drilling will start, say, March-ish, Q1-ish, and basically go through the whole year. Like you're going to have drill results for the whole year. Every 3-4 weeks, we'll be putting out news. Super newsy for 2025.
Great. That's excellent. Now, some other news, actually. You're soon to list on the NASDAQ First North Growth Market in Sweden. Now, I'm curious, was this in response to requests from Swedish investors, or is it a move that you believe will just significantly expand First Nordic's European stock ownership?
It's a bit of both. So it's listen, we're Sweden's largest gold deposit, second largest undeveloped gold deposit in Europe. We go there and we get a lot of attention and a lot of investor engagement. They like to support homegrown projects just generally in the Nordics, but now this is specific to Sweden, which is even more so getting love. But yeah, like we already have several hundred, I'd say, shareholders in Sweden who have been buying the TSX stock, but we think we're just going to get way more uptake by being listed on the Stockholm exchange. And to be honest, it's based on what's on the Stockholm exchange, other peers, it's scary to think what our valuation will be. But it always ends up normalizing between the two exchanges. But honestly, it's just increased exposure. We want people to know that this is a super important project for Sweden that's going to bring thousands of jobs, and it's going to put Sweden on the map for gold exploration. And to be honest, if you find 1 or 2 more Barcelonas, this thing it's going to be world class. And I think it just was the natural, obvious thing to do. And then having it there in Sweden makes it, really helps the push.
Hey, Taj, is this going to be part of the Sweden 100? Is there equivalent? They probably this has got to be that market is interesting, right? But you like getting a giant in there in a sector. You do get high value there, right? Because there's that scarcity value.
100%. Like you've got explorers in there with not even close to what we have, to be honest, explorers and developers, and they're trading at 50 million US market cap, 40 million US market cap. Like, it's us trading at probably 90 Canadian market cap here on the venture. It's I think we're going to get a definite kind of lift on that side. And then what it does is anyone's guess, but it's we're just doing it to increase exposure and allow people to and other Swedish investors to get exposure to the name.
Well, I think what we were talking about, you're telling us too, right? It's like, you've got a big fan base there. Give them a list, give them a ticker, and you're doing that.
Exactly.
I let you know, I only do this once a conference. I put mic drop alert in the chat.
now we need a sound effect.
You got to signal it.
You're going to be the only mic drop in the conference.
Mic drop. We give one away at conference. Goes to Taj right now.
Or you just leave the whole
Taj,
you just leave in the middle of talking. You just boom and just leave.
We wouldn't fault you if you just walked off.
Just leave the gold chain behind. We'll collect.
Hey, well, Taj, this was a great conversation as normal. I mean, First Nordic, you guys are doing some big things, and so we're excited to see where you go in 2025. Seems like it's going to be a big year for First Nordic. So thanks for stopping by Commodity 101.
Oh, without obviously for our PDAC, you're going to have to come by the real fireside chat at Grizzle HQ. So don't forget to put that on your calendar, Taj. And please bring that 100%. Gold medallion too. Would appreciate it.
100%, man. No, I really always a great time chatting with you guys, and looking forward to seeing you guys soon. And 2025 is going to be big. This year, 2024, was for launching effectively a new company, and it went well despite the tough markets. And excited about 25 with all the news coming.
Yeah, like, you know what, we have it's been an interesting market. You know, we had a great keynote in Leigh Goehring, but I always think that, you know, the stocks that work, I've always found, you know, once a stock bats off a great year, there's a serial correlation there, and that's not by coincidence. And, you know, anyone who's been in the market long enough knows how that works, right? You know, we have Power Nickel, you guys, like, these great years and we're thrilled to have you guys on, all the big winners as well on the show. I appreciate it.
Fantastic. Thanks, guys.
Thanks, Taj.
All right. Thanks, Taj. That was Taj Singh, CEO of First Nordic Metals. All right, everyone, Commodity 101. Hope you're having a good time. This has been excellent. A lot of insights here, a lot of insights to come to across the commodity spectrum.
Mic drops happening real time.
Yeah, hope you didn't miss that mic drop. That was a first for a commodity conference. So coming up next, we have Tracy Shuchart. She's founder of Hilltower Resource Advisors. We're going to bring her up in just a minute. Commodity one-on-one. We got surprised here.
We got a surprise here. Well, listen, we just had a mic drop. The first mic drop of the conference, and funny enough, one of our favorite guests who's been here since day one. We actually, you know what? The thing we really like about the resource conferences is that we go with the OGs. Warren's been there since day one. Leigh Goehring and Tracy Shuchart, Hilltower Resource Advisors. Her show, Mic Drop Markets, is right after the mic drop. It's only apropos. Let's get her up here. Tracy, as you know. Tracy! Thank you for
I heard
joining
the Mic Drop Markets. I was like, did they just steal my podcast title?
He set you up.
We didn't. These things have, I believe, there's serendipity that happens in these things that just was meant to be. Trace, we actually have to now all come on your show and relive it. We're gonna do a Mic Drop Wednesday, and just to relive.
I'd love to have him on the show.
Yes. Trace, always a pleasure. One time we're going to have to do this like you're going to have to do, because I know we've talked about it, but if you haven't done it, you have to come to Toronto for PDAC. This March. I know you're in Florida, and it's nice, and it's beautiful there, and it's not nice.
It's not any of those things. Not any of those things.
I'll come this year. I swear I'll come this year.
Thank you.
Come for the warm fire and the good vibes.
Yes.
Of Grizzle backyard.
Exactly. Listen, early March in Toronto, it does have it's it's got nice bits, and it's in the Grizzle HQ. It's at the fireside chat. So Trace, we need you there.
All right, I'll come. I'm done.
Good.
I'll be
because you know what? Because we've talked about it many times. So we're gonna actually do it, and you know what we're gonna do? We're gonna do a live show in person with everyone there. That's what we got to do.
Yeah, that'll be fun.
Love it.
Trace, Grizzle, Hilltower brings you PDAC.
I like it.
Trace, thank you.
My luck, there'll be a snowstorm the day I get there.
There will. Yeah. There's no luck involved. There actually will be a
get a Canada Goose.
We'll get you suited up. We'll get you the Canadian Canada Goose is basically like the military attire for civilians.
Yeah, it's how you get across the border, I heard.
That's right. Oh, Trace, thank you so much. Trace, you've been a structural bull on silver. The commodity's been viewed as a high beta play on gold. That's kind of its natural historical view. The way 2024 is playing out, it's kind of a bittersweet, right? While we've had a solid year-to-date gains, there's no question about that. But the problem is that for silver bull, it's been in line with gold, right? And so you're like the beta kind of isn't there. Now, there's been moments through the year that the beta's shown up, but then it's gone away. So on the flip side, both gold and silver have handily outperformed the Bloomberg Commodity Index. Why don't if you have a moment, we can pop that up.
Yeah, we have a chart on that, I think. Yeah.
Oh, there we go. Okay, good. Okay, so I've got this Bloomberg. Sorry, I'm going to tee you up, Trace. So we got this Bloomberg Commodity. So basically, this shows us, listen, the white line here is silver, right? And so you enter the year. It's been obviously a good year for both silver and gold, but what you want to see is more of that white line, right? Like that beta to the blue line. But, let's be frank here. Both have done incredibly well relative to the market, check, and relative to the broader commodity index. So we can kill that chart. So maybe, Trace, could you talk about the sentiment among silver investors right now? Are they happy with the kind of, are they kind of like, why isn't my beta here, but still outperforming any other commodity? And do you think we're on the cusp of exuberance returning to the silver market? Long-winded question, but I wanted to set it up.
Right. Well, I think we do. I mean, if you look at the history of gold bull runs versus silver bull runs, what we have seen is kind of a lag in the silver. So what I wouldn't be surprised is we see some sort of consolidation happening in the gold market And then we suddenly see silver catch up and we hit $40 very quickly. And I know, we hit that $35 area, we pulled back, but we're still holding that $30 area, which is very important, particularly for the junior miners. So having that price hold, which is above kind of the previous high that held, I think is going to be do very well. And again, throughout history, if you just look at any gold bull run, silver has just lagged. But there are plenty of opportunities, particularly, again, like I said, I still big fan of junior silver miners.
Right.
That $30, I think the last time I came on, I said, we just hit that $30 area. And I said, if we can hold this area, junior silver miners are going to do extremely well. And since then, we have seen them perform well, still lagging, not lying, but we need a little bit of time for this area to hold. And again, I think that it's just a lagging market compared to gold, but it's still performing very well. And I want to stress that I think that. Go ahead. Sorry. I want to stress that I think I needed to ramble on some more. So first I want to stress once again that people need to realize that this is not only a precious metal, right? I mean, we have, 45%, over 45% are used for industrial purposes. You have another 25% for medical use, which I would consider industrial purpose. And really only 27% is considered a store of value, or what the market considers a store of value, of people kind of holding it as solely for it being a precious metal. And, we have a lot of things. I know we saw a pullback in silver once Trump got elected, because a lot of people were thinking, well, he's kind of anti-ESG, meaning anti-silver and windmills, which require a lot of silver. And so we saw an immediate pullback. But I think what the markets are really forgetting is that that's not the main component of silver demand. In addition, the United States demand for solar and wind is minuscule compared to the rest of the world. So even if we pull back from those, and also, I just wrote something up on what people don't realize is the amount of silver you need for nuclear, which until a couple of years ago, until COP28, did the West finally jump on board, and this has become a trend. And so there's a lot of silver demand, and it definitely looks like this new administration and cabinet members, if they're approved, are very pro-nuclear. We look at the new energy secretary, if we look at commerce, everybody's pretty pro-nuclear. So I think people forget that there is a demand in that.
Great points, Tracy. And I don't know if you got some thoughts on yesterday. I know we haven't touched base, but yesterday, China, what they're doing with their rare earths. But that's clearly that's got to be, if you're Trump, you've got to be much more geared up to get domestic production. Is that a fair statement?
Oh, absolutely. Oh, no, absolutely. It's going to be about domestic energy security for North America in general. We have to include Canada and Mexico in this, obviously, because we have
Tracy, don't tax our barrels. Don't tax our barrels, please.
We're not taxing your barrels. It's all a threat. You know that. It's a negotiating tactic. It's never going to happen. We need Canadian barrels. Our refineries are tooled for heavier grades. Where else are we going to get it? So it's not going to happen.
Tracy for Energy Secretary, please. Can we get a voice of reason in the room? Maybe you don't have to be seated next to Trudeau. I wouldn't do that.
You're in the right state.
She's
already in the right state.
She's in the right state.
Yeah.
We have to send a convoy for you to the Mar-a-Lago to explain this dynamic.
No, it's not. It's not going to happen. I think it's just a negotiating tactic in general. I think even if there were to be tariffs for some reason, I definitely think energy would be discluded from that group.
Yeah, perfect.
It's just fact.
Fantastic. Wow, that was fantastic. So coming back to silver, sorry, because we talked to good insights there on just how you're thinking about it, and then talking about critical metals. But now silver's unique versus gold. Like when I think about gold, I think let's be frank, right? There's a huge jewelry. It's predominantly monetary, right? Like it's store of wealth. And then you have a jewelry component, but it's small relative, right? But silver is unique in the sense that you really have an industrial application, and it's set up differently. Would love to, maybe you can share with us how you're thinking about silver demand and relative to silver supply. We've seen there's strong demand, but we just haven't seen the response on the silver side with respect to production and supply.
Exactly. We're heading into our fourth year now of a deficit as far as silver supply. We have growing demand. This year, the Silver Institute has us at 265.3 million tons in deficit. And this is our fourth year of deficit, and it's growing every year. I think most of the reason why we haven't seen kind of a price reaction to this is because people just aren't paying enough attention to it. I mean, when we look at, here are some examples of silver used in technology that maybe you're not thinking of. Everybody knows the solar and the wind story, but you got silver in electronics. Literally everything you turn that has an on and off button uses silver. It's your computer, your phone, whatever has an on and off button in your house, it has silver in it. You have in brazing, in soldering, you have in silver bearings that are used in engines. You have silver in water purification methods, which is water is becoming a very scarce resource. And we know that water purification is becoming more and more important. Nuclear, which I just mentioned earlier. So there are a lot of, and there's a new medical application. They're looking at to coat body implants in silver. You have Samsung right now using silver in battery technology. And so there's a lot going on, and there's a lot of demand outside of what you normally would think of silver as a use for.
So Tracy, I have a question for you, which you kind of highlighted for me, right? Because we're sitting at 30, right? Silver's silver. It's not cheap, right? It's the price is high, but I never, for all those applications I never hear about someone say, oh well, if it gets too high, you'll substitute. I never hear about that. You always hear about it in copper, but it's a critical component, but it's a small price piece of the whole thing that it doesn't move. Maybe you can give me some insight. Is there a substitute? It doesn't feel like it. No one talks about, the next best silver. There isn't one. Maybe I'm wrong.
No, there isn't a substitute like there is for other conducive materials, because a lot of the applications are solely made just for silver. And there is no substitute for silver. It's not like you can say, in catalytic converters, for instance, they use palladium, but when palladium prices got high, they substitute it with platinum. Silver doesn't work that way.
Yeah. That's a great point, right? What we got to do one time? We have to do with the substitute conference. We'll have to do. We should do a mic drop on that. Talk about substitutes, because I know you follow aluminum closely, and that kind of there's a substitute. There's a substitute bid that comes into aluminum, right? When other metals get too expensive, you always talk very insightfully about aluminum, but that's a great example, right?
Absolutely.
Yeah. Now moving to gold, we're seeing a clear increase in demand from both international central banks and consumer demand. How are you viewing the metal in the current macro backdrop? And do you envision a world where Bitcoin materially competes for gold for global central bank reserves, right? And I'm not talking about peripheral countries like, like I'm not, like El Salvador. I'm talking about,
I think
listen, I'm a big fan. I'm a big fan. Everything Bukele's done has been fantastic, but let's
my
just
God,
say he's not
amazing. I agree.
incredible, right? But he definitely is going to have an impact on the Bitcoin price in the smaller market. But him leaving the gold market, no one there's been no impact, right?
Did you hear? I mean, El Salvador has a ton of gold, and they're going to mine again, right? They've had a ban on mining for the last 7 years. He's lifting the ban on mining, and they have huge amount of gold. So he's not against gold at all. He says we should use our resources. There's no reason why we have a ban on mining. And so that's a really interesting area as far as gold mining is concerned, as soon as that ban is lifted. So something to keep in mind for everybody that's looking at investment opportunities. I'm sure there are going to be a plethora of companies, particularly in Canada, because Canada had the most, prior to the ban, Canada had the most had the largest presence of miners, gold miners in that country. And so that's something to watch, you guys.
Tracy, that's great insight. I was just,
thank you.
I thought this guy was a Bitcoin maxi, but lo and behold, not the case. Apparently, that's great. I'm glad we kind of went there because I'm glad I threw out El Salvador because this is why Resource 101. It makes a lot of sense because you get great insights from Tracy, and the conversation just goes to places where you're like, hey, that's fascinating. Trace, that's another episode we need to do. A mic drop El Salvador. It's more than Bitcoin, right? Like that's
absolutely.
Okay.
And I'm sure that Canadian miners that had a presence there before, they still kind of have a presence, but they can't really do anything. So,
yeah,
definitely something to watch.
Now, Trace, just with it wouldn't be a proper commodity one-on-one if I didn't ask you about oil and just wrapping up the just big picture here. It's been a tough market to be a constructive oil bull. Reduced Chinese demand, looming OPEC risk of barrels, potentially U.S. supply. What's the market missing here in terms of what could surprise to the upside heading into 2025?
I think there's absolutely just no interest in oil right now. We see this in open interest. We see this in, there's just no interest, any kind of geopolitical risk has already been factored in. The market doesn't respond to headlines anymore. I think it's kind of one of those, everybody feels like it's left for dead because now we're all into nuclear now. That's what it feels like to me. But that said, as long as we, hold this, $70 area, oil companies are still making money, and it's not bad to have non-volatile oil markets. Like nobody wants to see it go from 60 to 100 to, those are just crazy markets. So it's a boring market, but, oil companies are making money. Absolutely. And so I think that's totally fine. Do I think, I think OPEC is absolutely going to keep barrels off the market. I've said this, time and time again when everybody said it's all going to fall apart. U.S. is producing too much oil. What we're producing is we're producing not really much more oil, but a lot more condensates, in which people don't really know the difference about, which are just natural gas liquids. But somehow it's all lumped into, one number that is, the highest it's ever been. But, really, if we look at shale, everything's becoming lighter and lighter. I don't think we're going to see the growth in shale that we have seen in the past, as far as oil is concerned. I'm using that in quotes. So I think, oil is probably going to be a boring market next year. But as long as we kind of hold this, I'd be happy at, 70 to 90 if we do Brent and WTI. You got to fit them all in there. And I think oil companies will still perform well. Your Exxons are still going to do well. You're going to, it's going to be fine.
Yeah, so just to kind of, if I'm understanding, if you had to make a bet next year, you would own the oil producers that are dividend paying, and those dividends could increase versus a commodity, which may be up, maybe down, maybe flat, but you've got like this, you're making cash flow at these levels, and why not own the cash flow maker? Is that a fair take?
Yes.
Yeah.
Mean, that's not where I would, if I wanted to own oil companies, which I do, go for dividend earning. Don't go for anybody crazy. They'll have slow and steady growth. That'll be fine. You get a dividend, you're paid for holding it. It's fine. As far as where I think there's opportunity next year is a different story.
Yeah. I'd love to hear just what you're thinking for next year. So if you had to kind of I'm cleaning the table, what commodities are you have to pick 3 commodities to have that that you kind of need exposure to, either the physical or the equities, interchangeable a little bit. What are your top 3?
Top 3 is midstream, U.S. gas,
nice.
Right? So I want, that includes, for people that don't know, I like, operating facilities, pipelines, managing exports, storing natural gas, etc. I think that's going to be a high growth area. I also like junior uranium miners, particularly in North America. I think we're going to see a lot more opportunity. In fact, we just saw Governor Abbott in Texas say that he wants to pursue nuclear energy and open up lands for lease for mining. So I think we're probably going to see that in a lot of other big states, as well as, you have the Athabasca region up in Canada. So I think junior miners will probably perform very well. Whereas in the past, we've seen kind of the Cameco, the big guys have performed very well. I think junior miners will outperform. So I would go there on uranium. And I also like palladium or PGMs. I said, let me do palladium and platinum together. I'm more on the platinum side. So PGMs, I think, will perform very well. Great. I like copper too. But I feel like I always say copper.
So just to recap for our viewers, top 3 pieces that you'd own going into 2025: midstream gas, U.S. gas, junior uranium miners, and PGMs. Love it.
All right.
Tracy, thank you so much. As always, thank you, Tracy. Always a pleasure.
Absolutely. Thank you, guys.
Thank you. So we're getting a firm commit then for PDAC 2025.
Yes, I'm coming. I got it. I'm coming.
Great. We'll get you.
We'll have your parka waiting.
Exactly. That's right. Tracy, thank you very much.
Thanks, Tracy.
Thank you, guys.
All right, commodity one-on-one. We ain't done yet. We're going to keep on rolling. So we're going to take a short break, and then we're going to be back with our next guest. Kobo. All right, everyone, Commodity One-on-One, welcome back. As you've seen, we've been talking to miners who aren't in the typical jurisdictions you're used to. We have another one coming up. They're in West Africa. You're going to hear a lot more from Kobo Resources. We have the COO, Paul Sarjeant, coming right up. So let's bring up Paul. Paul, welcome to Commodity One-on-One.
Good to be with you guys again. Thanks for having me on.
Yeah, great to have you on, Paul.
Now, Paul, to kick things off, can you give us a brief overview of Kobo's assets, where you operate, and why you chose to join a company exploring in West Africa over North America or South America or Australia, for example?
Sure. Our assets are based in Côte d'Ivoire, as you guys had mentioned earlier. It's a great place to be exploring for gold, tremendous potential. It's really the crown jewel of West Africa at the moment. And the reason I got involved was a number of factors, primarily opportunity. I met my partner through our current chairman back in 2014. He had actually had access to an alluvial play in Côte d'Ivoire. He's a lawyer, so he didn't really understand the geology. So I ended up going over and meeting with him there. And what struck me when I got there is that we were literally 10 kilometers from an operating mine, the Perseus Ure mine. The ground was open. He had an alluvial target that we looked at, was sort of understanding where all the gold was coming from, and we made a pretty significant discovery in what we call our road cut zone, which we had 18 meters of 4.6 grams per ton. So I knew there was an opportunity there. 2 years later, we formed a company, 2016, a private company. And since then, we've been going full bore on the Kossou Gold Project, which is our primary asset. I will mention we've got a couple other concessions in country that we've done a little bit of work on, but it's been sort of all efforts towards this Kossou Gold Project for the past number of years.
Right. That's great. So you recently announced a large strategic investment from an international conglomerate, Mota Engil, I guess is pronounced. How will this strategic partnership benefit you as you advance the Kossou project?
Yeah, it's been a really important development for the company. We were like every other junior out there. Even though the price of gold is up, it's still difficult to raise money, especially in an early stage project. We met the guys from Mota Engil, and actually through their private subsidiary called Luso Global Mining, which was created about 5 or 6 years ago. Mota is a large EPC company. They're the 15th largest company, I believe, in Europe. Over 50,000 employees. They've been in Africa for 78 years. They're a mining contractor for, I think, 8 or 9 different mine sites in Africa, 4 of which are in Côte d'Ivoire. They build roads, they build dams, they build buildings. So they have a lot of expertise in that in West Africa, and particularly in Côte d'Ivoire, where we're located. So it was a great opportunity. They wanted to come in for a number of reasons. They really liked our Kossou Gold Project, which is, again, our primary asset. But they also liked what management was doing and how we were performing. We had a lot of conversations with them, what they're looking for. They want to be more aggressive in acquiring projects and actually not just being a contract miner. They want to start developing projects from the ground up. They saw an opportunity in Kobo and our management team and our projects that they liked. And we salted the deal. They put $3.5 million into our most recent financing. We raised a total of 7.5 just back in July. And in fact, we had to cut them back. They wanted to put in a $7 million, but we thought that was a bit too much. It would have given them 20% of the company, and we certainly didn't want the market to sort of see us as being sold, quote unquote, to these guys. So, it's a great alliance. We're going to be able to utilize their expertise, a lot of their contacts for, heavy equipment, procurement and rentals. We just talked to them today about, getting our own diamond drills on the property. So if we can do these things, it's really going to lower our cost of exploration, which is already pretty good, honestly. But, if we can be more efficient with shareholder money, that's going to be a big win for everybody, in our opinion.
It sounds like that's a great resource. Thanks for that overview. Now, I wanted to move on to the political situation in Côte d'Ivoire because people ask when you talk about Africa, how does it compare to neighboring African countries? And could you also help us understand some of the benefits of exploring in emerging markets versus, say, trying to find a new discovery in Canada, for example?
Yeah, I mean, it's a good question, and I think it's interesting. I'm in London right now at a conference, and so we're talking to a lot of European and UK investors. And when we talk to them, there's virtually no questions about Cote d'Ivoire and West Africa. I mean, people understand the problems that are happening in Mali, Burkina Faso. Cote d'Ivoire is not that at all. I think there's 53 countries in Africa, and people kind of lump all Africa together into one ball, and it's really not the case. Cote d'Ivoire is a great country. The government has committed to making mining the number 2 GDP driver in the country. We were just in Cote d'Ivoire last week at the very first mining and resource extraction conference that they've held in the country. It was very well attended. A lot of big names were there. Really well put on a conference. When we speak to American or North American investors, there seems to be this misconception. It's Africa, so it's not always easy. But it's a stable country. They've had rule of law and a governing group there for 12 or 13 years. Another election coming up just in the next year or so. Another almost 11 months from now. The political waters seem very, very calm. We've been traveling around there since 2015 and never had any issues with people, being out in the field, doing our jobs. The government is supportive. The country is growing at a clip of 6 to 7 GDP. Had a bit of a downtick during obviously the COVID years. People are generally happy with the government. They've just instituted a new national healthcare system, which everybody is very pleased with. It's a booming economy and things are moving forward. There's been an incredible change since 2016 when we first came here to today, where it's just a different place to be. Second part of your question, why the ease there?
What are some of the benefits?
Yeah, the government is again very, very supportive. There's no real permitting required at an exploration stage. When you get to the mining stage, you have to do obviously a lot of the permitting. So it's very, very quick to work. I mean, basically we got our cash when we went public back in 2023 in March, and within about 3 months we were drilling on the property. And most of that time was just filled with getting our access roads put in. So it's a really good place to explore. The opportunities are boundless there, particularly in Cote d'Ivoire. Again, it's underexplored compared to most of West Africa. And so we're in the heat of the action at this point in time. There's a lot of bigger companies coming in now. We're seeing competition for projects. But I think the biggest thing is, like, our Kossou project is a great example. This is a brand new discovery that is within, like, as I said, 7 miles or 7 kilometers of a head frame. So we're doing head frame exploration, but everything is on surface. There's not many places in North America where you can do that. I mean, there's some great opportunities in Canada and the US, but they're not at surface, and they're not off a paved road by a 500,000 person city with all the infrastructure you could ever ask for. So that's the opportunity that we've been able to exploit and will continue to exploit within Cote d'Ivoire over the coming years.
Now, I want to expand a little bit. You mentioned that there's that mine nearby. So as we think about the potential of your project versus your close neighbor, the Yare mine, can you remind us just how large the resource is there and the current production of that facility?
Yeah, it's a great mine. I think last year they produced in the 275,000 ounce range. I believe they went into production with, I think, about 1.6 million in reserves. They've been adding to that, just around their pits. They've developed an underground target that's sort of, I think it's in the 500,000 ounce range at around 3.5 grams per ton. So overall, I think they're kind of brought that 1.6 to in the 2.2 million ounce range. They will be depleting their pits by 28, 29, I believe, and you'll see their production profile drop off from the current range of, as I said, 275,000 ounces a year down into the 110,000 ounce a year range, mainly because they will be processing less or none of the open pit, and they'll be processing this underground deposit, which they just can't mine quite as quickly. So, our proximity to them is, I think we've got an opportunity there. I will stress that our job, though, is to find as many ounces as we can. And with Mota and Gilles now as a partner with us, it does give us the ability to develop this project on our own if we choose to do so. And I think that's the tact we're taking. We will drill this thing off. We will come up with a resource estimate, and then we'll see where that takes us. And again, with Mota on board, we know we've got the expertise to help us take this to the development stage if that's what we choose to do with it.
Excellent.
Yeah,
excellent.
Paul, I remember when we were first talking, obviously, your proximity was a huge advantage, but then now with Mota on, it kind of, really, it fortifies the story, for lack of a better term, right? And if that's a fair statement, right? You've got two real access points for capital, and you've got it's development is always the hardest part, but you've got pathways in two different ways.
Well, and again, the biggest thing, and what we talked a lot with Mota or Luso, their mining group, is just access to capital. I mean, they basically said, we can fund you guys to the tune of $20 million a year over the next few years, and we don't need that right now, but that's a huge advantage for us to have. But yeah, on the other front, it just gives us a massive opportunity, a massive optionality in terms of what we do with the project as we go forward. We don't know what Perseus is going to do. We can't get inside their heads necessarily. So yeah, it's a great opportunity for us and the shareholders, and we're going to work hard to make it come to pay.
Man, that's a great situation to be in. I mean, it's hard enough to raise some money from someone who's just a financial backer, but to have someone strategically that can help you in the ways that Mota and Luso can is unique for sure.
Yeah. I mean, they get it, right? They're mining guys. I mean, they're a big engineering group, but they become very aggressive on the mining side. And of course, they love gold, and they love West Africa. They love Africa in general.
Yeah, it really is a big vote of confidence for the region and what you guys have discovered, right? Like that. Now, I wanted to ask a question around West African gold production. We don't have the slide, but I know, and you'll probably know it like the back of your hand. Just the different countries: Ghana, Mali, Burkina Faso, and how much ounces they've discovered. And Cote d'Ivoire is just, it's clearly, it's been lagged because there hasn't been exploration. How do you is there among those other countries, is there an example where one of those other countries was lagging and then you caught this big catch up? Is that kind of is there an analog for Cote d'Ivoire? I wanted to ask out loud, do we get to this phase where you guys are now, as a country, you just kind of, that next leg just gets
M&A wave.
It just accelerates, right? Once you get to a certain hurdle, the next rung almost just kind of supersizes, if that makes sense. If you know what I'm trying to say, once you get a critical mass in the country, your next million troy ounces is much easier than your first.
Yeah, and I think that's beginning to happen again. When we first got here, there weren't many other junior. In fact, we were probably the only real junior exploring at the time. And now there's, you see more Canadian players. You're seeing more Australian juniors come into the market as well. You're seeing some mid-tier groups come in. You're seeing larger groups come in. I mean, Newmont's here. Barrick is sort of tickling around. They've got a mine site here, so they're actively involved in the country. B2 Gold has projects now in the country. Ashanti just bought Centamin. That was a big deal, right? They've got a couple of projects, the Doropo, which is a 4 million ounce deposit they're going to probably put into production. They got another one called ABC that's over 2 million ounces. Not sure what's going to happen with that one, but yeah, what's happened with West Africa is that everybody was in Ghana for years, right? It was always known as the Gold Coast. Historically, then Burkina Faso and Mali became the next sort of big hit places. Obviously, there's political issues there. People are pulling out of those two countries. Ghana is explored. I mean, there's still ground. There's still discoveries to be made there. But everybody kind of avoided Cote d'Ivoire for some reason. I mean, there was some political unrest back in the late 90s, and I think that's really what kind of did that. But there's more of the potential host rock in Cote d'Ivoire. There's 35% of the Birimian formation, which is the formation everybody looks for. Yet they had a tenth or even less of the gold production compared to Ghana. I mean, Ghana's got, I think it's 18% of the Birimian formation distribution, and they've produced 130 million ounces in the last 25 years. So there's just this huge disconnect. But you're seeing it now, right? You're seeing more junior activity. You're certainly seeing more development. We have a great map in our presentation that shows the number of mines in Côte d'Ivoire in 2014. They came out with a new mining code in 2015. They were producing, I think, 22 tons of gold. They're now producing 62 tons of gold. There's going to be 10 operating mines by the end of this year, early next year. There's probably another dozen or so development projects. The wave is happening. We're at the forefront of it. It's going to be an exciting, I think, next 10 to 15 years in Côte d'Ivoire.
You know what, Paul? I think about like in commodities, getting using it. I like the analogy because it's true. It's getting ahead of the puck where the puck is going, and you guys
Yep.
clearly saw what was going to happen, and the real value creation is getting there before everyone else, and you've got an incredible land package. It's exciting.
Yeah, no, exactly. That's, we were sort of first movers in some respects. I mean, it was difficult. We were private. Trying to raise money is always difficult. We missed a couple of opportunities that we would have liked to have gotten our hands on, but we just didn't have access to capital. Again, I think that issue is behind us. So it's full steam ahead at this point.
Yeah, so you're obviously moving as fast as you can to find ounces. I wanted to talk a little bit about the drill program. You're in the middle of a 10,000 meter drill program, pretty substantial. Now, you keep hitting gold wherever you turn, basically, but if we step back a bit, what are the results telling you so far, and what's the ultimate goal of this drill program?
Yeah, I mean, it's been a great program. We had a smaller program, about 4,500 meters earlier in the year. We took a bit of a break, raised the cash we did, and we've come back strong with this 10,000 meter program, which we hope will be finished mid-January. We just brought another drill onto the property. That's how positive we are with things. We've been drilling our main target, which we call the Jagger Zone. We've now exposed that over in diamond drilling over about a 600-700 meter strike length, and it's still open to the north. It looks like it might be getting a bit closed off to the south. We're still in the shear zone. We're getting lower grade gold down there, but maybe not economic at that point. We're still open at depth. We got a great intercept on one of our holes. We drilled a fairly deep hole. Ended up hitting about 175 meters below surface, an intercept that was 8 meters at 3.8 grams per ton. So that's a pretty significant intercept. It fit into our model exactly what we were thinking was going on. So it was, a great success. And I will mention above that hole, we had a number of intersections as well that were, very, very positive, and I would call quote unquote ore grade. I mean, got to be careful using that terminology, but there are certainly, width and grades that will be, I think, mineable. So we extended the mineralization about 250 meters to the south from our last diamond drilling program, and now we're working to the north. We actually just finished that. We've got about 4 or 5 holes from that area that are waiting to come back. We should have those results pretty soon, but visually things look quite good. We moved to the Katy zone, which is another zone that's relatively new to us. And again, visually, we're getting some good results there. And then the second drill just started on what we call the road cut zone, which again is an 800 plus meter long soil anomaly that we've got some diamond drilling on, and we've got some pretty good results on that. So yeah, I mean, basically, every single drill hole I believe we've drilled on this project, where we've really targeted the soil geochemistry in our trenching, has given us, gold values. So it's a unique situation. Again, we really haven't hit a bunch of terrible holes, and it's, again, as I said before, it's sort of full steam ahead.
Yeah, Paul, fantastic overview, and congrats on all the success thus far, and a great partnership created this year. Paul, thank you so much for joining Commodity One-on-One, and we hope to see you at PDAC. We'll have a big show at PDAC, so looking forward to that. So we'll connect at PDAC, and wishing you a happy New Year and a Merry Christmas into the year end.
Thanks, guys. Same to you. And yeah, we'll definitely see you at PDAC. We'll be finished that drilling program. Hopefully we're going to be starting a new one around that time, even bigger. And we'll get more into a sort of, I think, more of a resource definition drilling program at that point in time.
Fantastic.
Excellent. Looking forward to it.
Well, what the market wants to hear. Paul, thank you very much.
Thanks, Paul.
All right, guys. Take care. Thanks.
Thank you.
All right, Commodity One-on-One keeps on rolling. We got more great guests. Don't go anywhere. We'll be right back. Commodity One-on-One. Thank you, everyone who's tuned in. We hope you've loved the show. We've been having fun putting it on. Remember, live show. Put questions in the comments. Maybe they'll get asked to the guests.
Yeah, indeed. So that's on YouTube and Twitter. Man, massive audience on Twitter. Love it. Love to see it. This is the largest commodity show that's live.
Give us some likes, some exclamation points. It powers us up right now. We're gonna keep on going.
Man, X showing up. It's always good. It's been a heck of a show so far. Scott, what we got?
Yeah, so we got Ian Harris, CEO of Libero Copper, another really interesting copper play in the right spot geographically. So we're going to bring him up. Ian, welcome to Commodity One-on-One. Good to see you.
How's it going?
I have this vision of you guys celebrating in some freezing cold location right now.
That's right. Oh man,
the snow's blowing into my left.
Yeah, that's right. Oh,
well, so Ian, great to have you here. So I want to start with some high level questions because you have some great views on copper. So you've been.
Hold on. Before anyone. Hold the train. And so, in case anyone's listening, we did a phenomenal Twitter Spaces with Ian, which which ultimately we finished this. And for those who don't know, Twitter Spaces is the recorded conference call, and it's out on podcasts as well. You can find it on iTunes. But it was a rules of thumb for a mining a production and like a mining resources. It was fantastic. So for those who haven't listened, I just kind of want to plug that.
Yeah, thank you. Yeah, definitely some good tidbits in there for investors. So now, Ian, could you help us understand why it's so hard to fund a small or medium-sized copper project when all we hear about all day is this looming copper shortage? It doesn't make any sense.
Yeah, it's fascinating, the bifurcation that is in market right now. And I think it's the biggest reason is you've seen a consolidation within the larger players, right? They've been avoiding bringing on new projects and have been acquiring each other for additional production. So it only makes it more difficult to make movement on their balance sheet, right? So they're not interested in looking at smaller projects. They're looking at projects of scale. And so therefore it makes it a little bit harder to get attention around a smaller project, right? And I think that's the easiest way to. I know it's more complex than that, but that's the reality.
Got it. No, that makes sense. Now, just a follow up on that, kind of what's the sweet spot for a copper project to number one be on the radar of investors, and then number two be on the radar of the majors?
Yeah, and when I say this rule of thumb, I'm thinking of the future. I've seen some of the mistakes that were made in the past trying to bring in really large projects right from the beginning had been very difficult. There have been a few success stories, but there's been lots of failures, right? So I think that majors are looking for two things. Well, I think they're looking for number one thing. Their one thing is they don't want to get fired, right? So you just remember that is the major motivation, especially when we saw such a culling, back in 2000 and I guess from really 2008 through 2015, there was a significant culling. Is that eventually they know they're going to have, today they're saying just make more money and we'll leverage our eventual price increase to copper. We have that exposure, but how fickle investors can be, and eventually they'll be making calls. Where's the growth going to be coming from? Right. And so I think the sweet spot is, again, a 30,000 ton per day startup project, and I'll explain why, and that 150 plus size potential per day. Right. So 30,000 tons per day. Why? Because you're at the biggest SAG mills, biggest trucks, and these are round numbers, right? So obviously it's a order of magnitude type thing. But 30,000 tons per day is the biggest trucks, the biggest SAG mills, the biggest ball mills, the biggest stuff, right? So anything above that, you're starting to lose the cost advantage of just scaling up, right? And it's also manageable. It's also like, there's been a lot of 30,000 ton per day copper mines built, the designs are on the shelf and et cetera, right? So that is 200 million tons of a mineable resource, and not to be confused with just a resource. So when it goes from a resource towards reserve and gets into a reserve, you're going to lose some of that resource, right? So you obviously want a little bit bigger than that, right? But with the potential to go to 150,000 tons per day, you're talking a billion tons, right? So you're looking at for a resource with a little bit bigger than 1.5 billion tons, right? So it's your cake. You can have your cake and eat it too, because you start with 30 and then you can expand to 60 and then go to 90, then go to 120. And it's an easier bite size, right? It's not a massive amount of capital. It's still a lot. We're still talking probably $1 billion plus, but then we can go to the ability to have your cake and eat it too, right? And I think that is probably the most attractive project. So it's a very nice starter project, very attractive, right? And unfortunately the problem, and so you're basically looking at most likely a copper porphyry, maybe an IOCG, but you're also seeing this little piece of it too that's better than all the rest. That would be the best place to start. So I know it's very, very, and it's a rule of thumb, and maybe I have a very fat thumb, but that's a good starting place.
No, we'll take any thumbs. I mean, those rule of thumbs are what makes the industry go round.
Totally.
So it's very helpful.
Totally.
Now, I want to talk about.
Go ahead. Let's go ahead.
Are you sure you don't have another tidbit for us?
Yeah, another thumb.
Well, it's not a tidbit, but we have to understand that we work in a very dynamic environment, right? We are trying to navigate. Say you have and when I look at it, I want to see a project that can become a future mine, and that's not, minimum. That's 5 years, right, or whatever, right? But sometimes it can be 10 years, 20 years, exactly, right? So I imagine you're on a gigantic ship that you're trying to navigate safely, right? And so these rule of thumbs allow you to get your head around how to manage things moving forward, right? Because the dynamics change. I base on the direction I want to take the company based on where the market is today, with an understanding that it can change.
Right. Makes sense. Okay. I want to talk more about Libero's copper assets. So why should commodity investors be paying attention to Mocoa? And we have a map we can put up while you're talking to that.
Yeah, I would say that today it's for a couple of reasons. The big one is there's a bifurcation in valuations of copper assets, right? And it is because it's sort of like you're in the cool club or you're not the cool club, and I call it a Class A and a Class B asset, right? And you see some assets, Filo is a great example, especially because they've been sold, so I can talk a lot about them. Right, their valuation per pound in the ground, right, was in the cents range, right? And then you have a lot of other really good assets, but because they're not moving forward or some issue with them, et cetera, are not in that club. And then some of the valuations are like 0.2 cents per pound in the ground. And the reason is market is right now awarding the best of the best, right? And Mocoa demonstrated, especially when we did get the chance to do one hole in 2002 before presidential elections, it demonstrates it can bat like the big boys, right? It can put out the results that get attention. And it also has the ability to get to those secret numbers that I was saying. It's already over 600 million tons. It already contains 4.6 billion pounds of copper. And you can see a pathway where it can get over that billion ton. So based on our evaluation where we are today, we are now restarted drilling. We announced drilling, mobilizing in September. We started drilling in October. That once those news gets out, I believe there's going to be a re-rating, and that it will be more properly valued that project. That's reason number one. Reason number two, I think, is the big change this year was the bringing on or the movement of Libero into the Fiore group and Frank Juster coming on as a principal shareholder. And so that sponsorship, I heard it a little bit mentioned a few times. Sponsorship is very important in this market. And that means that there's a bigger, we have a unique experience, and I can dive into that, but we have a unique experience advancing very large projects to get them until the start of construction, which hasn't been done very often in the last 20 years. So plus sponsorship, plus a great asset. So I think there is a short-term, medium-term, long-term value proposition associated with the company. And we're kind of at that starting point after many, many years of work to get to this point where we are today.
Excellent. Yeah. So my next question was actually about Frank Justra. So he came in for 11% stake in your last capital raise. How does Frank operate? I mean, it sounds like he has a longer time horizon. So when he comes in, it's not like I'm just putting money in and what are you going to do for me now? He's willing to take a long-term view because he likes the asset and what he sees, and he's going to help you get to those next steps. Is that how I should understand it?
Yeah, but I would also think that that Frank also thinks in transaction, and something that's been a great learning experience for me. I say Ernie Mast, who's one of the directors of the company, and myself have been project builders, right? And very big projects, but they're still project builders. And then where Frank he's a visionary and thinks of company building, right? So he sees that pathway, like I just described, of taking a valuation, especially when there's a bifurcation, creates an opportunity, right? If you can get into a different valuation compared to other assets that are there, but he's seeing a bigger picture. And he also has obviously had several conversations with groups, not just majors, but nations that want and are fearful of production chains, or they're becoming less dependent upon oil, or see a less dependence on oil and need that new industry to be built around it. So he sees multiple pathways, and he is one of the big supporters of consolidation. And because less money is being spent on G&A and more money is being spent on advancing projects. And then in the copper space, the scale matters, because that is what people want, right? They don't want to build 5 projects; they want to build one project, right? Kind of philosophy. So he's been amazing to work with over this year, and has been, it's been very exciting, very exciting.
Yeah, that's great. Sounds like a great partner. Now, so if you look at your project, you're currently at a resource of 2.9 million tons copper equivalent. Curious, what's the resource you want to hit that opens up strategic options, mine financing opportunities, kind of as you look at like longer term?
So this is where I come into one of the issues, right? And the issues is that, and again, these are rules of thumb, right? But there is a stage of a project, and I won't talk about the discovery phase because that's extremely emotional. But when you get to a resource stage of a project, you're normally valued at some dollar or cents per pounds or ounces or X in the ground, right? And there's, it's this number for inferred and this number for indicated, and there's, but it's basically you're being valued for the resource that you have in the ground. Then there's the stage you get into a project development. You have a PEA, you have a PFS, you have an FS, et cetera, and there's some valuation that is normally based on some factor of NPV to your NAV, right? Based on the stage of the project, and there seems to be a little bit of bifurcation there. Like if you have a 15% IRR, you're in the class B, but you get a really nice humming project, you get a better valuation or a better multiplier, right? And so then obviously one is when you're producing, right? So when you produce, you get it on your EBITDA, and there's some multiplier, et cetera. So those are kind of the stages of valuation, and they're pretty good rules, right? There's range within those rules, but they're pretty good rules. So it's how the companies are looked at. And so when I talk about this 30,000 versus 150,000 tons per day, if I'm looking at a junior company like myself, I want to get the highest value for my shareholders possible. So that means that most likely I would like to develop and go down that production profile starting at as high production. Because if it takes you 10 years to go from 30 to 150, the discounted cash flow, you don't see that in your NPV. You don't see it in your IRR, right? So you're kind of forced to come out. I mean, you're kind of forced to come out with as big of a project as possible because that's what your valuation is. And then so then I come up with I'm coming up with a 150,000 ton per day project, and then market goes, how the heck are you going to raise $10 billion? Right? So, right. So it's like, you're damned if you do, if you're damned if you don't. So you really need to have your cake and eat it too. So we're going to be looking at least for strategics and internally looking at an optimized version where it would be a startup at a 30,000 and doing the work so that if we got to that type of conversations, it's there, but also preparing for market. And so if I say I would like to have a project that's over 150,000 tons per day, then I'm looking at over a billion tons of resource. And at a PA stage, the good news is you can do it off of an inferred resource. So you get a little bit of leeway. So that's why I think you can see the stepping stones. Makoa has about 26,000 meters of drilling to it to date. We currently have planned a 14,000 meter program where I would like to expand that program within next year. But I would like, the internal goal is to double the drilling on the project. But if you were sitting at 600 million, we'd like to get over $1 billion. You can see that in a quick fashion, we'll be getting into project development. Because I also want to avoid what I've seen in other projects. You have amazing projects and they drill and they have great results and drill and have great results and drill and great, but then there becomes a desensitization to just great drill hole results, right? And because there's a fear of going into that next stage for some reason, right? Lack of experience or bad advice, I don't know, but you eventually do want to make sure your valuation is underpinned based on an NPV.
That's excellent. I can tell you're a student of the psychology of markets as well as a miner.
Well, you see, I put it into rules of thumbs because I'm a mining engineer, so I have to still make it some sort of math and calculation in my brain to make it all work, right? So I'm forced to understand emotion, right?
Yeah. Now, I wanted to talk just a little bit, help people understand the politics and regulations in Colombia for anyone who doesn't know the country. So have there been any important changes to regulations or permits that you'd like to call out? And just in general, what's the environment like there?
So everyone has to recognize that a little over 2 years ago, in August 2 years ago, well, I guess it was November when he actually came in. But we saw the first leftist president in 20 years. And I think Petro has some big ideas, especially being one of the first leftist presidents, wanting to change the things. Where lots of rhetoric, a very strong anti-coal and anti-oil stance, right? And I don't. Some people call me a bad luck charm, but I was in Venezuela for the elections of Chavez, and Bolivia for the elections of Evo, and I was in Ecuador for the elections of Rafael Correa, and I was in Colombia for the elections of Petro. But I guess my point is, I've seen this. So strategically, how do I think? And I'll get back to that the slide, but is that you normally have. Right. And it's why we stopped drilling, because you come out and it's very emotional and you don't have, the president doesn't have all the information, doesn't really understand potential, et cetera, and might make some strong decisions based on what I think would be a popular decision. Right. And mining is demonized. So we have to recognize that mining is demonized. And so it's a pretty nice target. Right. So I didn't want to be the target. That for sure. But we're seeing a change now, right? You can only run for one term in Colombia, and it's a 4-year term. And so he's getting into a little bit of a lame duck stage, and you're seeing a political will starting to build. You're starting to see more pragmatic individuals within the executive branch. And so from that, and so I am less legislative, right, than I am about creating political will. And let's be fair, I was in Mirador in Ecuador and started the construction of the project. The project became the first industrial scale mine in the history of Ecuador. And you had a new constitution, a new mining law. There was a suspension of all mining it ended up being, I think, multiple years. It was supposed to be, I think, 6 months, and it lasted 1.5 years before we were the first project that restarted in that country. And you had a constitution that said minimum 51% for the country, right? And besides this, right, when political will was there because there was a need, right, to show investment, to show the economy moving forward, all those obstacles were overcome because there was political will to get it done. So it's hard because it's much easier to read a law and say, okay, what does this mean? And what, et cetera. And you need to do a permit. Well, how do you do a permit? And okay, you do the permit, right? But you have to understand, especially a project the size of Makoa, it will be the largest scale metals project in the country, right? And so that means it's going to be on a national level, and it's going to require political will, and creation of political will is more important. And that means having, and simplified, the people locally love you. It's not that they love you. They're a part of the project. They feel ownership. They feel part of it. So it's something they would be willing to defend because it's partially theirs, right? And the other piece is...
Go to this chart, right, a little bit.
Yeah, is national reputation. And one of the reasons we took the decision to restart is, there was a ranking with the national authorities, government authorities, and with municipalities, the reputation of mining companies. This was at a big Congress, mining Congress. The president of Congress was there, Congress of Columbia. And we were the second highest ranked exploration company in the country. And we hadn't even drilled a drill hole. The only one higher than us was AngloGold Ashanti, which is a multi-billion-dollar company. And in municipalities, we had the number one highest ranking at 12. All the others are producers. And a lot of those are actually aggregate companies. So we knew we had established that reputation within the country. And that is what's important, because you get support local and you have a positive national reputation that will drive political will. Because at the end of the day, pragmatic plus votes is equals to decisions, right? As an example, if the people like you and you need the advancement of the economy, then bang, those things come together. And it also aligns with those timelines that I was talking. I would like to be able to have a project definition by the time elections happen in Colombia on the next round. I want to be part of the solution.
And Ian, yeah, exactly. Well, it sounds like you have a very strong vision for where this company's going, and obviously those rules of thumb are very helpful. I think anyone should bookmark this segment here if you're a copper investor or a mining investor. So, Ian, wanted to thank you for your time. This is a great conversation.
Yeah, Ian, and Ian, bookmark this in your calendar. Grizzle PDAC. We're doing Fireside. You got to be there. You're going to be at PDAC.
We'll be there, of course. I'll come up to the cold.
We'll help you stay warm.
I also want to say that there's some great smaller projects out there that I do think are going to get built, right? There's robust smaller projects that will find a way to get them across the line. And so my strategy is focused on a different market, and the market being nations and large mining companies. So I don't want to throw whatever it's called. I'm sure there's some term here that there's other projects can't get there, right? Shade. That was the word I was thinking. Sorry, my brain works in Spanish a lot.
Too much sun in Colombia. That's the problem. You ain't seen shade.
Too much vitamin D.
That's right.
Yeah. But again, we are looking at our expertise is in developing projects post-resource and getting them across the finish line. It's a unique experience, and it is a unique perspective on how we approach projects.
That's an excellent way to put it. Ian Harris, CEO of Libero Copper, thank you for joining Commodity One-on-One.
Thank you, Ian.
Thanks for having me, guys. Nice to see you again.
Thank you.
All right, everyone, Commodity One-on-One, chugging along. We're getting close to the end, but this isn't the end. We have some great speakers coming up on different topics. We're going back to some other stuff.
Yeah, so I think we can tee it up. We've got Blind Squirrel Macro up next. Great insights.
Take a quick break.
Yeah,
we'll be back.
We'll be back.
All right, everybody, welcome back to Commodity One-on-One. Train keeps rolling. We're excited to talk now with a macro and commodities specialist, Rupert Mitchell. He's the author of Blind Squirrel Macro, so let's bring him up. Rupert, welcome to Commodity One-on-One. Great to have you.
Yeah, that constant reminder that I need to update my headshot.
It's
forever young, forever young.
A few more chins and a few less follicles.
I think we all need to update our headshots. Let's be honest
with
here.
AI, I'm just doing one as a 12-year-old kid, and then let it generate for the rest. This is what I would have looked like. the other side of disheveled.
It's going to become sci-fi, right? You're actually 100, but your picture's
Totally.
20. So it's
Totally.
fine.
Rupert, thank you so much for joining us. You're really excited. You've got a fantastic Substack. Lots to talk about. Let's kick it off with, you've got a unique vantage point with commodities, having spent a significant part of your career as an investment banker, specifically IPOing Chinese companies. Can you talk about the insights you gained seeing the commodity cycles from that perspective? That's a really unique vantage point from a North American, Canadian perspective, Australian perspective. You see it in a different light, but seeing it on the Chinese side, would love your take there.
Yeah, so the first big China boom sort of starting at the tail end of the original .com bubble was a pure steel and commodity and build things and new cities. And then we saw a similar repeat performance after the 08-09 financial crisis, where that fixed asset investment led stimulus was a massive deal for the commodity complex. I think it's a mistake to think that this time around it's going to look exactly the same as those prior to. And certainly I'm certainly a China bull right now. I arguably was early but stuck with it and doubled down over the course of this summer. And I think there are a few trapped late longs in the China trade from the Tepper spike. But I was in early enough to be comfortable with my basis. But I do think that this time around, the flavor of stimulus is going to be much more focused on getting consumption going in China, rather than massive fixed asset investment that leads to sort of jumbo commodity demand. But it's a different type of cycle.
For sure. And with respect to your outlook on the Chinese economy, particularly as it relates to commodity consumption, and point well taken that it's not going to be the same kind of jumbo consumption. Maybe you could talk to that. And is this a clean, are we looking at a clean handoff from a commodity perspective, demand perspective, to India, or is this is that demand slice just too big to replace that China slug?
Well, I think in terms, you've got to look at it and you've got to break it down, to be honest.
Yeah.
I mean, you've got well, let's start with crude. Let's start with energy, right? It's very clear that the big bet that China made on electrification is paying off in spades right now, and that does translate into longer term, lesser crude imports for China. They've got plenty of coal, they've got plenty of renewables, and the penetration of EVs, and more recently things like LNG trucks sort of taking out the diesel demand, is changing the long-term energy demand picture out of China. But that doesn't really change my sort of baseline sort of confidence, and I wouldn't say bullishness at this stage, but baseline confidence about longer term energy demand in the rest of the world. If you look at per capita consumption of crude in India, in sub-Saharan Africa, these guys are still consuming fractions of what we consume in the West on a per capita basis, and I see those kind of markets picking up the slack from the reduced demand out of China. Then in terms of food, in terms of grains, I mean, China will continue to be a net importer of food commodities. I don't see that going away anytime soon. I think the trickier one is, the fixed asset investment type. So the iron ore trade. I mean, it's if you look at the way in which the RBA down here in Australia is looking in terms of sort of, and the government, the Treasury is looking in terms of how much they're going to get for our iron ore out of Australia. Very, very difficult to find too many very bullish calls above $100 around right now, and I sort of kind of understand that as a move. I guess the next thing, we've obviously got what is China going to do domestically, but what is the potential implication from a sort of another round of trade wars with the new administration coming in the US? I mean, I think it's important to make the observation that versus Trump 1, the percentage of Chinese exports to the US as a percentage of GDP is less than half. If you just compare now with 8 years ago, so Chinese exports are largely being redirected elsewhere. I mean, I was eyeing up BYD is launching their pickup truck, their Ute as they call them down here in Australia, the BYD Hybrid Shark, right? This is a massive sort of F-150 style build truck, and it's coming on the road. This thing's going to do 1,000 miles on a tank with the hybrid engine. It's coming on the road here at less than $45,000, right?
Oh man,
that's insane.
I mean, that's so China is finding alternative export markets other than the US. I think is my bottom line there.
That's really fascinating, Rupert. In terms of
to take your point, because you mentioned India, and I'm actually pretty negative on the outlook for Indian equities. I see them as massively expensive. The asset allocators have got themselves into a real pickle. They've been telling their clients for the last 4 years that China's uninvestable, and that you should be moving all of your eggs into the India basket. That market's got spectacularly expensive. It's an exchange rate that is a serial devaluer over the years, and I think that devaluation of the rupee has really only been sort of stalled over the course of the last few years since the start of the Ukraine war because of the Russian energy dividend, which has been a big bonus to the Indian economy. I then look at other forms of foreign currency. I mean, they go back to it. I mean, normally India's a big net energy importer. They don't have as much of their own. They've got plenty of coal, but they're a net energy importer. They, in terms of their exports, now 30% of India's exports are IT services, right? And I don't know what that business looks like in a growing world of AI. So, I think that if we do see a return of capital to China, it's going to come at an expense of a very expensive Indian market, in my view.
Yeah, it really is an interesting dynamic where you've had this literally 2 one-way trades, right? One being underweight China and one being overweight India in the emerging market context, right? And I think we've got a great chart. If we could pop this one up. Yeah, I like this. This is a classic macro squirrel original. Could you talk to this one? Because for those watching, these are shares outstanding for ETFs. But Rupert, why don't you talk through this? But I think it's a pretty profound chart.
So EEM is the classic iShares emerging markets ETF, and what you've got with the red part of the chart there is a sort of collapse in the shares outstanding since the first quarter of 2022, while on the bottom you've got emerging markets ex-China, which is just it's a perfect illustration of that sucking sound of liquidity out of China into non-China EM. And the bros hugging was a soppy squirrel point. This is I have a thing about the Olympics in that I elect not to watch any sport for which the Olympics isn't the pinnacle. So I have no interest in watching soccer or golf or tennis at the Olympics because that's not the pinnacle of the sport. But give me speed climbing any single day of the week. And this was This was the U.S. Climbing star embracing his Chinese competitor, and it was a bit of summertime hope that we weren't going to be dealing with too much ongoing conflict between the superpowers.
So you, that chart is a pretty profound chart because it's displaying what you've just said in an empirical way that this from an allocator perspective, it's just that's the way these things move, right? They just move where you're seeing literally money come out of EM, including China, going to 1x China. And so like maybe the question I have, and I thought you wrote a really funny on point line. Nobody owns Chinese equities. They are the untouchables of the investment world. A two-part question. What's the constructive bull case for the Chinese equities? And B, if we don't see a revival of if we do see a revival of Chinese equities, wouldn't developed market proxies, i.e. commodity producers, be better risk reward? But I think you kind of answered that earlier, but maybe just the first part about it. Yeah.
We'll touch on that, and I think so. In terms of the constructive bull case, I mean, valuation in isolation is never an answer, right? Things can stay cheap. How many morose value investors do you know, Tom, right now? I mean, it's value can be a what feels like a permanent state of mind sometimes, but the what I would argue is, and we talked about institutional, sort of Western institutional flows. Now, given what the number that the allocators have done on their clients over the last few years, I wouldn't count on anything other than sort of trading type flow out of the West. But then let's figure about, other sources of demand for Chinese equities. And I see recycled petro yuan, out of the global south. I see Chinese exporters, which have been hoarding cash onshore. And, if that market starts to work, they're momentum traders at heart. And we're seeing a very clear desire by the authorities with China to shift the investment culture domestically away from pure real estate into what we've seen first with fixed income and the fixed income rally onshore in China. And I think that's ultimately going to cross over into equities as well. You're seeing huge amounts of account openings going on at the domestic brokerage houses, both in Hong Kong and onshore. So it doesn't need the big pension funds of Europe and North America to start massively reallocating back into China for those equities to work.
That's great. And I just, one follow-up question before I touch on lithium, but surely the ones that are so cheap, they've got lots of free cash flow. What could return of capital? Think about dividends. Like, is that a lever? Like, that clearly should be a lever that they could use and should use.
This is an increasing theme. Actually, I'm writing about it this weekend. So thank you for bringing it up. So this is in terms of capital allocation in China. You're seeing more frequent dividends. So you might even see a sort of a transition towards potential quarterly dividends. At the moment, they're mainly annual and semi-annual. Buybacks are less of a theme, but certainly yes, amongst the sort of the big China tech players, the Alibabas and the Tencents, who kind of look at how well buyback strategies have worked in the financialized world of US equities. And so you're seeing big buyback programs coming from those guys. But I think general capital allocation policy is going to be a big supporting sort of tailwind for these markets as well. It's very clear that the Chinese Communist Party wants Chinese equities to work, right?
Yeah.
It's they want that wealth effect that drives consumption, right? In a world, particularly with the hukou system in China, which is people are making noises about the reform. This is the residency-based system in China where, unless you're from one of the big tier 1 cities, you don't get to benefit from healthcare and education. You've got to fund all of that yourself if you come from somewhere else. If they, that obviously overnight would be have an amazing impact on consumption activity because everyone's sort of having to protect themselves right now. But have no doubt that, if a wealth effect can be created within financial assets within China, that's going to be very helpful in terms of driving the consumption angle for the China recovery.
Thank you, Rupert. That is a solid case for China right there. Now, I want to touch on lithium. Important. So Rio Tinto's recent acquisition of Arcadium Lithium, it's revived spirits in the sector that we've truly seen a bottom. Just wanted to, you wrote about it in the Macro Squirrel. What's your view of the current landscape? And, are we early, are we still in the early phase of the lithium consumption trend? In iron ore, we saw a bump and then came down and then a second move up. Maybe you could talk about just the opportunity in lithium ahead and also lithium equities.
So I mean, just by way of background, I think you're aware, Tom, I spent 3 years working in industry when I left banking, and I worked for a Chinese electric car startup. So I was in the industry during the craziness of 2020, 19, 20, 21 with the EV and lithium boom. And ultimately, way too much capacity was brought on, and the crash back was inevitable. But we're now seeing real discipline coming back into that marketplace. Now we've got headwinds in the form of EV penetration ex China, and ultimately, I think the role of hybrid technology hybrid vehicle technology is going to be significant. I'm a platinum metals group bull for that reason. I think the end of the catalytic converter is the demise of the catalytic converter has been brought forward too rapidly. But I think that with various projects being put into care and maintenance and the desire to safe shore the lithium supply chain in the West, I think there's a bull case to be made for high quality lithium production outside of the China supply chain, if you like. So I own a basket of what I would call sort of Western lithium plays, predominantly the sort of 800-pound gorillas of Albemarle and SQM down in Chile, but a focus on the Americas. I think that the discipline in production capacity is going to give rise to a supply-demand imbalance that can see lithium track back up, maybe up to the sort of 25 to 30K by the end of the decade. I don't think that we're going to see too much craziness again. Lightning doesn't always strike in the same place twice, right? But I think there's reasons to be cautiously bullish around supply discipline.
Fantastic, Rupert. And man, that time just flew by. Rupert, can you tell everyone where to find you? A fantastic Substack and the types of things you cover, and where they can find you.
Yeah, I'm an unashamed generalist, but you can find me at blindsquirrelmacro.com. I write a free letter every week, which is about sort of 40% of my content. The rest is for my paid subscribers. So that's at blindsquirrelmacro.com. And there's also a weekly 10-15-minute podcast, which covers a different theme per week. I mean, we can be anything on a macro topic, or lithium one day to EVs the other day. I get everywhere, and I just go where the interest is.
Rupert, thank you so much. And I had Tesla on here, but we're gonna get you back for our growth and tech conference because that's obviously a hot button one. Rupert, thank you so much. Blind Squirrel Macro, thank you.
Thank you. All right, guys, Commodity One-on-One keeps rolling. Don't go anywhere. We'll be right back. Did you miss us? Commodity one-on-one. We ain't done yet.
Oh, the marathon keeps going. Wow, man, this has been a heck of a insight download. And you know what? We've got one of the most fascinating products on deck. Like it's fantastic. But gold and Bitcoin, but long both at the same time. Scott, who do we got on deck?
Yeah, so we're going to talk to David Dziekanski. He's founder and portfolio manager of this fund. And so we're going to talk a lot about Bitcoin and gold and specifically how the fund works with its unique strategy. So let's bring him up. David, welcome, brother.
How's
it going, guys? Thank you so much for having me.
Thank you.
So,
first off, congratulations, man. What a heck of a run for this ETF. It's just
coming out the gates hot. I like it.
Well done, man. Well done.
We always targeted the election as a date we were trying to launch for, and we had no idea how big of a movement it was going to be in the crypto world, but we're definitely very fortunate for some lucky timing. So
amazing.
Yeah, that definitely helps. So, David, I wanted to start in the macro level. Is the macro setup still bullish for both gold and Bitcoin in your view, or is one slightly better positioned than the other to outperform from here?
Yeah, thank you. I think long term, we are bullish on both asset classes. It comes down to a very simple equation of scarcity of replacement value. Bitcoin mines at less than 1% a year, gold at less than 2% a year. Paper currencies around the world print at much higher rates than that. And in the short term, we think it really depends on if we have a continued expansion in the equity market or not. The way we look at it is, at least right now, post-election, Bitcoin is the higher beta equity and gold is the higher beta bonds. But both offering more scarcity than their underlying competitors. So we like both of those asset classes better than stocks and bonds. But in the short term, I do think that the divergence between Bitcoin and gold are going to very much be based on, are we going to see continued equity expansion, or do we see some sort of volatile environment that actually causes treasury yields to contract considerably, which we quite frankly haven't seen in a very long time. So we like to think of it as almost like a better 60-40.
Right.
Amazing. Good way to put it. Now, I wanted to talk about the correlation between Bitcoin and gold, because that's a big part of the story. So I looked back in history. It was close to zero, surprisingly, from 2011 to 2021. But since July 2022, the correlation has been positive and is running closer and closer to one. And we'll bring up a chart on that. Now, I'm curious what this behavior tells you. Is Bitcoin maturing? Is this vindication of the argument that Bitcoin is digital gold? Like, how do you look at this?
Yeah, I mean, so while Bitcoin and gold's 1 year correlation might be a little bit high, it is a number that fluctuates quite drastically, as you can see from the chart here. It can go as high as over 50% to as low as negative 30%. We've actually seen a huge drop in the correlation post-election. So I do think these two assets might get a little bit more correlated as the trade thesis behind them starts to align in the debasement trade, which you've seen from a lot of the biggest banks across the street. But because it's not consistent, we actually see a lot of value, as alluded by the fact that we launched a product with the two together, in mixing the two, because the correlation is not actually consistent at all. So in certain timeframes, it will spike up. That tends to be very momentary. You can see here on this chart, we've outlined like when some of the crypto winters were, et cetera. That is actually what we look at the most, is when Bitcoin is very, very volatile, especially on the downside. That's actually when the correlation seems to hold up the most. So that's what we're most concerned with in the construction of this product. This is a new form of leverage ETF, STKD Bitcoin and Gold ETF, ticker BTGD. Leverage for the long run. These are not daily use leverage products. They can be, but they're leverage products that are designed to have less path dependency because you're stacking two things on top of each other.
Right. And I want to get to how the fund is actually put together, how you achieve that leverage.
And just for a simple understanding, right? So if I'm just theorizing here, David, and you can help me if I'm on the right track. I'm throwing out numbers, right? Let's just say in 2024, gold finishes at plus 30, Bitcoin does plus 100. The return from this product will be something like 130, something like that. Is that fair to say? Like that's
precisely. Yeah, it should be 130% minus the cost of financing. which is very cost effective using futures right now. So just a little bit over short-term rates.
Got it.
Okay. No, that makes okay. You've kind of answered that question. First, I want to start with Quantify KS Advisors, though. You guys are sub-advising the stacked Bitcoin and gold ETF, ticker BTGD. Now, I know you just launched your first fund, so maybe getting ahead of myself, but I'm curious, should investors expect a particular theme to the exposures and strategies you'd like to launch from this fund?
Absolutely. Obviously, we can't talk about any products that are not yet filed, but what I would say is the concept of stacking two assets is 2 or 3 years old in the ETF wrapper, and we think it's a category that's going to grow very, very quickly because, as we alluded to before, these are leverage ETFs that are actually designed to be held for a little bit longer because there's less path dependency. So WisdomTree's in the market. WisdomTree has a couple of capital efficient strategies. Our partner here with Quantify Funds on the stack lineup, which is the return stack folks, Resolve and Newfound, they have the series of hedge funds stacked onto broad equity exposures, broad fixed income exposures. So we think this is a way for RAs and individuals to get cost-effective leverage on their portfolio and do so with less path dependency and potential decay using the traditional leverage ETFs that they've been accustomed to.
So is that where the benefit?
More, we just unfortunately can't disclose it until we file. So,
yeah, definitely. No, that was a helpful description, though. Now, I want to get a little bit more into the ETF, how it works. So you've mentioned a bit about what the benefits are. Could you just kind of give a quick run through of what the benefits are that you're trying to achieve and offer to an investor overall?
Yeah, first and foremost, we're trying to limit one choice from your day. There's too many choices in this world, and everyone's trying to figure out how to protect their portfolio with some sort of scarcity asset. And the two of choice, at least right now, seem to be both Bitcoin and gold. And so one, we just alleviate an option for you, and you don't have to choose between the two. But the idea is an institution will run their portfolio with an optimal basket at a specific leverage ratio that makes sense for the level of risk. And these are tools that allow you to do the same. And specifically here with Bitcoin and gold, we do the hard rebalancing between the two assets. There are many people who are allocated to both Bitcoin and gold. And I always ask them, it's like, great, how many trims did you do since Trump has been elected? They're like, none. I was like, so you didn't sell any Bitcoin and you didn't buy any gold, right? One went up, like 40, 50, 60% versus the rest of your portfolio, and one is down 10%. And you'd be surprised how many people don't actually do the hard trades. And so the whole thesis of the lineup is to pre-package these vehicles with the trades included in them to make it more efficient for your portfolio, allow you to have that optimized little bit of leverage on your overall portfolio, which allows you to allocate to these things without deciding if you should take down your equity exposure. It allows you to make room for other things in your portfolio without without costing you the choice of either or on other things in your portfolio. So we've seen a lot of advisors use something like this alongside a market neutral strategy, a hedge fund like strategy. This allows you that allocation for more diversification.
Now, do you guys target a certain split between Bitcoin and gold? Is it 50-50?
Yep. So the fund, you can think of it, the fund as for every $1 invested, you get a $1 exposure to gold and $1 exposure to Bitcoin. Also can be thought of as a 50-50 portfolio between Bitcoin and gold times 2. So that's the way to conceptualize it as like a traditional leverage ETF. It's a 50-50 mix. So we do target a 1-to-1 exposure between the two. It is an active product. It is not a daily rebalancing product because sometimes that can just kind of erode returns on trading costs. So we're really trying to actively target 1+1 and also keeping cost considerations in mind. That might be rebalancing on drifts of 5 to 7% between the two, or just on new creates coming in and allocating that cash to get it back to 1-to-1.
Oh, interesting. Great. Now, from a technical perspective, how have you chosen to offer investors the leverage, the $2 for $1? And why'd you choose that instead of, say, buying, if you're using futures or anything else, why'd you choose that instead of owning any physical?
Yeah. We wanted to access this leverage point so that we could offer exposure to both at once. And in these asset classes, the absolute cheapest cost of financing is through the futures markets. You can't get that kind of leverage on the physical. You can get some swaps on some of the exchange traded products that hold Bitcoin and gold. That also can be a little bit costly as well. So this was just the lowest cost of leverage that we could access in both of these asset classes. We think by offering a 1+1 offering here, it also allows it to be easier to allocate to. Some of our competitors out there, for example, WisdomTree, have like a 90-90 model or a 90-60 model. And I think sometimes the easy math that this provides allows you to really fit into your portfolio pretty seamlessly.
Great. Awesome. Now, okay, so we talked about active management, how that plays a role here. Now, maybe I could just ask you, if people want to learn more about, the strategy, your asset manager, all that stuff, where's the best place to find you and to find information?
Yeah, you can find us at quantifyfunds.com. You can find us at Quantify Funds on LinkedIn and Twitter, soon to be on YouTube as well. More information there. We have some research papers coming out on Bitcoin and gold. We have some research papers coming out talking about some of these charts we've discussed today, specifically looking at like some of the drawdown numbers between Bitcoin and gold and leveraging the two together. We think this is one of the most ideal pairs because when the most volatile asset of this mix has drawdowns, the two have actually really benefited each other through strong negative correlation. And we're excited to see what else is to come in our stack lineup in the future. But thank you guys all for your time today. Yeah.
Oh, I know you sent us a chart that's really interesting. I want to hit on it. Do you want to do the one that was the drawdown chart, or maybe the last?
I like the drawdown one. That, if you talk to that,
the drawdown gold versus Bitcoin.
Yeah.
So that was the third one you sent, I think.
Yeah,
maybe you can talk.
We're just gonna get that popped on the screen.
Yeah. So that chart is
the other one. Yeah, talk to this one. Sorry.
No, this
talk to this one.
This is good.
This is a great one too. So this is the performance of gold and Bitcoin and a back-tested strategy of Bitcoin futures and gold futures minus the cost of financing during the two crypto winters. So you can see here, Bitcoin was down 83 and I think 79% over those two time periods. Gold was down 1.8% and 4.7% over those two time periods. What's most notable is that gold was actually up for the first half of both of those crypto winters, showing you the benefit of having this rebalancing mechanism between the two. And when you add the two together in a 1+1 format, as you see on the bottom here, the drawdowns are really not much more substantial than just Bitcoin alone. So we like to think of it as, Bitcoin with the side of gold, but you got to be careful because compliance is always watching. But the idea here is that gold has held up exceptionally well during the last crypto winters. And quite frankly, if you see the movements that are occurring today, while we don't anticipate there being a crypto winter in the near future, and last I checked, we were almost rounding 99,000 on Bitcoin again. So we'll check.
I was hoping we get to it right here live, but
maybe
we might have to wait a bit
live. Let's see.
Oh man, that would have been the cherry on top on the conference, man. If we hit that,
it's 98.9 right now. But I do think you're seeing the negative correlation today between Bitcoin and gold, and no one expects Bitcoin to go down, but if Bitcoin were to take a big drawdown in the next 2 or 3 months, just based on how gold is performing right now, I think it would actually do quite well again in a theoretical next crypto winter. And that's why you mix these two hard assets and you do the harder balancing between the two. I find it so fascinating how many people have both of these in their portfolio, but I've never even considered rebalancing between the two on events such as what we've seen in the last 4 weeks.
And so, and just kind of final question, because, we have a lot of advisors who watch our show, right? And I think, I'm going to throw it out there because you traditionally would have, I'm going to say between 1% to 2% in gold. Like I'm talking, an advisor, historically, you'd have some sort of kind of, maybe 1% or 2%, maybe someone who was a little more of a gold bug having something more than that. But let's just call it 1% to 2%. But that's 1% to 2% that you can't put in equities right now. So what if you then took 1%, and so instead of your 2% weight, you go 1% this gold Bitcoin, so, we've now entered the world of Bitcoin. So now they go 1% gold, 1% Bitcoin. So is the way they think about it now, let me free up, instead of putting 2%, I can go 1% in your vehicle and I free up that 1% for the rest. Is that the right way to look at it? Because for advisors, I just want to make sure that's kind of way you're utilizing that.
You take two allocations and allocate it into one, and that frees up dollars in your portfolio for everything else. That alleviates the need to draw down equity further to allocate to these two asset classes. That's exactly it. That's what this whole concept of capital efficient strategies are. And again, unlike traditional leverage ETFs, you can actually build this into a model portfolio. This doesn't have a daily use warning on it like the other leverage ETFs out there. Your clients aren't going to get prospectuses that say, why am I holding this for a month when it says I shouldn't hold this for a month? And we think that's very, very impactful. But that's just it.
No decay fever dreams.
Yeah, and I don't want to say there's no decay. There's significantly less decay. It is much less of a drag on overall returns. I do think that currently, and you're hearing really intelligent people such as like Bob Elliott make comments like this, gold seems to be almost a better allocation in your portfolio than bonds. Its correlation has skyrocketed with treasuries, but it just has much less supply. There's more scarcity in gold than there is in treasury bonds, right? And sometimes people overthink it, and it just kind of is as simple as that. And we also think this is a great vehicle if you are in gold and you've never considered Bitcoin. This is your first foray into Bitcoin, or vice versa. If you made a lot of money on Bitcoin and you want to hedge it, but not necessarily take down your exposure to Bitcoin, this is a good way to maybe move in a tax efficient account, move some of your assets over to this. You don't decrease your Bitcoin exposure, but you get gold for free on top, which, as you've seen during the last two crypto winters, does a very good job of holding up. So it's almost like a freebie allocation on gold. So hopefully compliance doesn't hate me for that
one. We'll scrub it all. Don't worry. David, thank you very much, man.
Yeah,
that was a fantastic download. For people who, it's publicly traded.
BTGD.
Yes, BTGD.
Yeah. So congrats on all your success and wishing you a lot more, and happy holidays.
Congrats on an amazing conference, guys. Thank you for having us on. Thank you.
Thank you, David.
Bye.
All right, commodity one-on-one, everyone.
Scott,
we did it.
This wouldn't be possible without our partners. Yeah, let's get our partner slide up there. There we go. 314 Research, GNR, but we got things to tell you about our partners.
All right, so 314 is the next generation of investment research. They're home of the full cycle trend ETF. If you want to learn more about that, go to 314smi.com.
And the ticker is FTCE.
FTCE. Goehring and Rozencwajg, you heard from Leigh Goehring, what a legend, natural resource investors. If you want to find more of their quarterly notes and their research, go to GoRozen.com. Blokland Smart Multi-Asset Fund, one-of-a-kind fund invested in scarce assets, high-quality stocks, and then gold and Bitcoin on top, BloklandFund.com. West Red Lake Gold Mines, the ticker is WRLG. They're restarting the high-grade Matson mine in the heart of one of the most prolific gold districts in North America, Red Lake, Ontario. Next is Power Nickel, PNPN, developing what is turning into the polymetallic discovery of the decade in Canada. And Ecora Resources, ticker ECOR, royalties on high-quality assets targeting the critical metals of tomorrow. Hot Chili, or HCH. Hot Chili owns one-of-a-kind water rights and is developing the largest copper project not owned by a major miner. And Hilltower Resource Advisors, expert insights on commodity markets. Visit hilltowerresourceadvisors.com to learn more.
Fantastic. Woo! All right, guys, you know what? This has been a heck of a road, heck of a journey.
All right, everybody, we're back. Sorry. Dropped out for a bit.
Oh,
the computer couldn't handle commodity one-on-one.
No. Guys, well, I want to thank everyone from Grizzle's family to your family to thank you so much. This has been a heck of a marathon, a heck of a download of
Thanks for logging in. Thanks for hanging out with us for all this time. Hopefully you got a lot out of it. You learned a lot about commodities and the forecast for what's going down the pipe with a Trump presidency and everything else going on in the economy.
Yeah, guys, everyone, thank you so much. If you want to find out our research, research.grizzle.com. There you can read our work, and that's research, Grizzle Research and Quant, and you get our partner, Chris Wood's fantastic weekly macro. That's at research.grizzle.com.
And quant-driven stock ideas as well.
Exactly. So hit that. I want to thank all of the participants today.
And one other I got to mention, if you want research on ETFs for your portfolio, we also have bidaskresearch.com, which is covering all the different sectors of the market. It's doing deep dives you're not going to find anywhere else. So that's been helpful for us to put together portfolios, and it should be helpful to you. That's bidaskresearch.com.
Yeah, exactly. So hit both those. But all of the details with respect to everyone who's presented today, you can find on YouTube, the links, but also we'll have, if you sign up for research.grizzle.com, you'll get show notes, and show notes will be out shortly by the end of the week. So guys, thank you so much for joining the only Grizzle Commodity One-on-One. Thank you.
Happy holidays.